$1,000 every week. Virgin Radio pays your way. Also available on the free iHeartRadio app.
Welcome back. It's time for First Call, when the viewer gets an opportunity to put a question directly to an investing professional. Our investing professional today is Alan Small, Senior Investment Advisor at IA Private Wealth, the Alan Small Group at IA Private Wealth. Amin is calling from Ottawa. Amin, thanks for calling.
Hi, good morning, gentlemen.
Good morning.
I had the Magnificent Seven stocks, and I sold them before Trump came to power. I made a lot of profit. I have $500,000. I've started reinvesting in the Magnificent Seven, and I have already invested half. I still have half. Is it advisable to do so? Thank you.
Well, congratulations on selling them at a good time. That definitely, I should start with that. To me, I don't know if I would go into all the Magnificent Seven. Perhaps a lot of the names, maybe 6 out of the 7, I think can be looked at, with the exception of Tesla. I still believe Tesla is expensive, even at these lower levels. But again, as I said earlier on the show, I think tech in general, big cap tech, has been ground zero for a lot of the market pullbacks. The NASDAQ's been hit the hardest. I think if you have a long-term time horizon, the big cap techs, the Mag 7, some of the names of the part of the Mag 7 definitely can be looked at, whether it's a Meta, an Amazon, a Google, or Alphabet. I think these names, to me, make a lot of sense. These names, perhaps a little bit more than Apple or Microsoft, which I think don't make as much sense, just because I think these other names are better opportunities, better buys. I think they're cheaper. I think they have better prospects going forward. So I don't know necessarily if I'd be a buyer of all the Mag 7, but I definitely think you could take a look at some of the Mag 7 today.
Okay, thanks, Amin, for your call from Ottawa. Let's go to Anita in Markham. Hi, Anita.
Good morning. Thank you, gentlemen, for taking my call. I'm a very conservative and long-term investor, but that didn't shield me from this downturn. And my question to you is, should I be buying on the dip right now, or should I be clinging on to my cash and wait for more dip? I'm really lost at this time. I need your advice. Thank you so much.
Thank you,
Sure, no problem. And I have to say, you're like many other investors right now, trying to figure out whether this is the buying opportunity of I heard a generational buying opportunity, some people have said. Some have just stayed away. And so I just don't think you can actually time this kind of market, trying to catch that falling knife every time. Over the last at least week or so, investors have tried to buy into this market. It's been kind of getting in front of a freight train coming right at you. So I would say that, again, depending on your time horizon and what you want your money to do for you, I think it is an opportunity to grow your wealth over the longer term. In the short term, extremely bumpy. I think there's always a bull market somewhere out there, and whether it's in gold right now or whether it's in somewhere else. Right now, it's just difficult to find. But I think if you do buy some of these good quality names on the cheap, I do believe at some point there will be some negotiations out of the White House with these countries, such as China and others. And I think the market will rebound. It's just a matter of when. And I think, as I said, if you have a longer term time horizon, I think you can start to take at least nibbling at some of these really cheap, good quality names.
Should an investor like Anita, who is considering buying the dip, wait for volatility to ease? Wait until we stop seeing these huge, I was going to say huge swings. Right now we're seeing huge declines in market, but should she be watching things like the VIX index and looking for a more calm market when the daily changes are less severe?
Yeah, and it's a great point. And to me, I just don't think anyone should be in a rush right now. It's not like you have to buy things at 9:30 this morning. I've been kind of sitting on my hands for the last few days for sure, and a few weeks even. I haven't been too active because it just seems like things are kind of getting a little bit worse rather than starting to improve. And so for many people, they're going to want to see a little bit of improvement before they step in. And I think that can make sense for certain individuals. Again, it just depends on the type of investor you are. your time horizon, what you're looking for your money to do for you, more so than deciding on based on age or anything else. What do you want your money to do for you? Are you looking for growth? Are you looking for income? Are you looking for capital preservation? What is the most important thing you need to do? And I think that's how you decide whether you should jump in now or maybe wait a little bit. Either way, I think you're going to make out okay. I just think those that are panicking and selling at this point, that could be the wrong move, especially after the large declines that we've seen.
Here comes another caller, Nadia in Oakville. Hi, Nadia. Thank you for waiting on the line.
Hi, thank you for taking my call. Actually, mine has to do with my kids' RESP, which they will be needing to access within the 4 years, which is pretty much the whole term of Trump's presidency. Majority of the exposure is to the U.S. market, and now I've seen that it's tanking. So I'm kind of concerned and worried. I'm wondering, do I sell that entire RESP portfolio, take the gains that are still sitting there and maybe park it into a GIC, or do I just leave it and ride it out and see what happens, or even maybe buy some more shares now that there is a dip? So I'm a little confused as to what to do. And
okay, we've got guidance. Just under 90 seconds to answer that question, Alan. Good question from Nadia.
Yeah, great question. And so here's a situation where we do have kind of a defined period of time. I think you said 4 years. And so this is a question that now we have to figure out, what are you comfortable with? Do you still need to grow the RESP? How large is your RESP? Is this something, do you have enough money saved in the RESP at this point to support your children or child going through college or university? Is this already done and now you're just, gravy, growth and now at this point is just gravy on top? If it is, maybe you do want to put a bunch of that money into something a little bit more conservative, whether it's utility or pipeline or some sort of fixed income product. However, if you still need to grow, if your RESP is nowhere near where you want it to be, then yes, you're going to have to make decisions and make moves so that you can grow your portfolio more over the next 4 years. And that will mean perhaps putting more money to work in this market.
Nadia, thank you very much for your call. And that is it for us on the street today. We want to thank Alan Small most of all. Thank you very much, Alan, as always, for being with us. We're going to launch the Open right after this. As we go, here's a quick look at the S&P TSX market site, or I should say the TSX market site, trading set to begin in just over 32 minutes from now.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
To prove these underwear don't ride up, they don't bunch, and they stay in place all day, we're putting them to the ultimate test. Go! They didn't move. 200 kilometers an hour. They didn't bunch up, they didn't ride, and they stayed in place. Incredible.
Looking to maximize your monthly income? Our Yield Maximizer ETFs combine your favorite sectors with a high-yielding income-first strategy to help you meet your goals. More income every month from Hamilton ETFs.
Focus on your goals. Trust in our ETF experience. BMO has been offering ETFs to Canadians since 2009. BMO ETFs. Build on trust. Learn more at bmogam.com/ETF.
A revolution is happening in sports nutrition, and investors are taking notice. Sizzle Brands is seizing a fast-growing market, delivering premium hydration and nutrition worldwide. With a retail presence growing by the minute, Sizzle is expanding rapidly, outpacing all new brands and market share growth. Now trading on the CBOE under the symbol CZZL. Sizzle Brands is quickly shaping the future of sports nutrition.
Welcome to the Open here on BNN Bloomberg. I'm Paul Bagnall. Thank you, of course, for being with us. The markets are our top line story. Futures are getting hit once again in the U.S. There you see declines of about 2% apiece in the major market indices following big declines of last week. The news is more severe elsewhere in the world, where Asian markets and European markets have plunged. Donald Trump digging in. He is defiant on tariffs. He says that they will remain in place on most key trading partners. There's a look at the Asian trade. Look at the Hang Seng Index, down by 13%. As that market prices in a tariff war involving China and the United States. The Hang Seng, which was in positive territory until today, is now in negative territory so far in 2025. We're also watching oil prices. There is West Texas Intermediate crude. It has plunged substantially through all of this market turmoil. Crude now falling to $60.88. It has been sub $60 earlier this morning. In the meantime, let's get to some stories that we're tracking for you here in the BNN Bloomberg newsroom. China is accusing the United States of unilateralism, protectionism, and economic bullying. That's its response to the U.S. tariffs. China is also calling on representatives of U.S. companies, including Tesla and General Electric, to take concrete actions to resolve the issue. Last week, U.S. President Donald Trump put an additional 34% tariff on Chinese goods shipped into the United States. That's on top of 20% tariffs earlier imposed this year. China, of course, has retaliated by implementing 34% tariffs of its own on U.S. goods headed to China. Just this morning, the province of Ontario has announced that it will provide $11 billion in relief and support for workers and businesses in the province affected by U.S. tariffs. Ontario Premier Doug Ford says as a first step, the province will defer some provincially administered taxes for 6 months, including the employer health tax. Ford also says the province will break down internal trade barriers by speeding up timelines and approvals for development, as well as diversifying Ontario's trade partners. Activist investor Simpson Oil is proposing a full overhaul of Parkland's board in the latest development in the fight for control of that company. Simpson is also proposing the removal of Parkland's long-serving chief executive officer Bob Espey. In a letter to shareholders, the investor blames Parkland's board and management for a deeply flawed capital allocation strategy and aims to fix what it calls chronic underperformance. Parkland says the move is an attempt by Simpson to seize full control without paying a control premium. Back we go to the markets. It's our top story, of course. There you see the U.S. futures down by roughly 2% and change apiece. On Friday, the Dow fell by 5.5%, the S&P 500 fell by 6%, and the NASDAQ Composite fell by 6% as well. Here's a look at the S&P TSX. There's crude oil, rather. We're going to get to the TSX. There's the TSX. 23,193 is the level. Keep in mind the high was 25,000 plus, so we are well off the high now. The TSX Composite fell by nearly 5% on Friday. Here is crude oil, $60.79, a decline of about 2%. Here's gold. Gold, its advocates will tell you, is doing what it is supposed to do. That's holding value in a time of broader market turmoil. Here's the Canadian dollar, down by about 1/5 of a U.S. cent right now. It has been pushed higher than 70 cents recently. That's a result of the weakening U.S. dollar. The U.S. dollar has weakened significantly on the tariff news, and that's given a boost to the Canadian dollar as priced in U.S. currency. There's Bitcoin, meanwhile. Decline there continues. It is certainly a risk asset, and it has stumbled badly with the tariff news as well. It's now at $77,000 US per coin and change. Well, as we look at the U.S. futures market, let's bring in our first guest of the hour. David Nelson is a familiar face to viewers of this channel. He's also chief strategist at Bellpoint Asset Management, and he joins us right now. David, good morning, first of all, and thank you for being with us. I know this is a busy time for you, so we appreciate your time. One question investors are asking themselves is, when does the so-called capitulation stage get reached? A lot of investors would consider that perhaps to be the time to move some cash into these damaged markets.
We are hitting that phase right now. You're starting to see VIX levels, approaching COVID levels, where there was real panic. And you really saw some capitulation on Friday, because on Friday, investors ran out of places to hide. For the last couple of weeks, they've been hiding in consumer staples, maybe utilities, stocks that paid high dividend. On Friday, everything was for sale. In large part, I suspect a lot of money came out of index funds. Around 2 o'clock, it started to accelerate. That's when fund managers probably get a message about how much money's coming out of their fund. So everything was for sale. And at the end of the day, a lot of PMs, even like myself, were thinking we didn't sell enough.
You say in some recent commentary, some notes written just this morning, I believe, that the velocity of this decline is reminiscent of the early days of COVID. And this is the part that I find interesting, most interesting, and it signals deeper undercurrents beyond geopolitics. What do you mean by that? You seem to be saying there's more at play here than concern over a tariff-driven trade war.
Certainly this tariffs are the bigger part of this, certainly in the near term right now. But we're already starting to see some cracks in the system. I think the DeepSeek moment really started to unwind the AI trade. We started to learn that maybe here in the United States, we're spending maybe too much capital, where they're finding maybe a better widget. And perhaps that had forced, this pullout of like data center stocks, the Dells of the world, a lot of the semiconductor companies. Perhaps we were overbuilding. I think there was some cracks there, but we're also running debt and deficits that are massive at this point. And even, some well-known people, former hedge fund manager Ray Dalio, have come out and said the United States is really just one step away from a financial heart attack. And that's in part and parcel why some of this is happening right now, why this tariff economic war is taking place.
Another very prominent hedge fund manager, Bill Ackman, has said that while he's broadly sympathetic with the administration's desire to correct some imbalances in U.S. trade relationships with its partners, is alarmed at the way the administration has done it. It is calling for a 90-day truce in which perhaps calmer heads prevail and other options for pursuing these objectives are pursued beyond the wall of tariffs that the U.S. has now erected. What are your thoughts on that, on this alarm that we're seeing from people who are very market knowledgeable?
I would take it a step further. I would say that we need a new Bretton Woods, because that's where all this really started. It started 80 years ago in 1944. Tariffs are an economic weapon. There's no other way to look at it. It's mutually assured destruction if everybody's doing it. Back then, the United States was the strongest economic powerhouse coming out of the war, and it made sense for the United States to let other countries tariff us more than we tariff them. 80 years later, with the United States running debt and deficits this large, that's problematic. Now, where I would agree with Bill is the following. For CEOs, the uncertainty here is what's really playing havoc with the market, because even if you wanted to onshore your manufacturing capacity back to the United States, what the president wants, if you're a CEO, you're going to do nothing, because the president may, in the next couple of months, eliminate the tariff on that country, in which case you made a mistake. That uncertainty is playing out in real time, and that's where I would agree with Bill.
Let's return to our original conversation. Are you seeing opportunities now to put money to work, and if so, where?
Well, they're all over the place, but we could buy something today down 2, 3, 4, 5, 6, 7%. It could be down another 10 tomorrow. Until the capitulative phase has run its course, I suspect the first couple of rallies out of this will be significant. But there'll also be opportunities for a lot of people to sell things that they didn't get an opportunity to on the way down. Until this market repairs and goes back to another all-time high, which is likely not to be anytime soon, the market is going to be suspect for some time.
What are your thoughts on U.S.-China relations at this point. That's where the tariffs are the highest. China has responded angrily and with tariffs of its own. What are your thoughts on the U.S. trade relationship with China?
You know, I found it comical because China put out a statement this morning saying that you know, the United States is manipulating trade. You know, it's something they've been doing for the last 30, 40 years. My guess is they're going to attack, and they're going to probably try some political advantage here, try to make some deals with the EU. That could be likely to come. They could also devalue their currency dramatically. They could also use the ultimate weapon. They could start completely eliminating or start completely ignoring intellectual property and starting to sell some things like Microsoft Word at $5. Just ignore it all. Those are weapons that they have. So this is not over at this point.
Okay, why don't we finish with gold? It's a bright spot in the markets these days, and as I've said a couple times on the station so far this morning, advocates of gold, investors who believe in gold, will tell you it's doing exactly what it's supposed to do right now, and that's hold its value.
You're right. I mean, it is doing exactly what it's supposed to do. It's a place that you go to in geopolitical uncertainty, and maybe some of the Bitcoin, alternative. Bitcoin being an alternative to gold isn't really playing out as many had thought, because that's been proven to be a risk-on asset and is going down as hard as NASDAQ right now. So it is a safe place. I suspect the metal is a safer place right now than the actual stocks, the paper asset, although I own both.
David, thank you very much for joining us. As always, David Nelson is Chief Strategist at Bell Point Asset Management. Thanks, David. Well, U.S. President Donald Trump has extended the deadline for Chinese firm ByteDance to sell TikTok's U.S. operations by 75 additional days. We'll have more after this break.
The Open is brought to you in part by Canaccord Genuity Wealth Management. Wealth Management Reimagined. Discover more at wealthreimagined.ca.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
We all need fiber for our digestive health, but most Canadians only get about 50% of the fiber they need. Good thing Metamucil gummies are an easy way to get plant-based fiber. 3 gummies have the same amount of fiber as 2 cups of broccoli. Metamucil gummies, the easy way to get your daily fiber.
Most men over 40 look into the mirror and see this, when they could be seeing this. Most men over 40 look into the mirror and see this, when they could be seeing this. Most men over 40 look into the mirror and see this, when they could be using this. Particle 6-in-1 Face Cream for Men. The first of its kind anti-aging cream designed specifically for men. Fights the look of eye bags, dark spots, and wrinkles. Visit particlemen.ca and use the promo code on your screen to receive 25% off your entire order. Plus, we've got free shipping and a 30-day money-back guarantee. www.particlemen.ca, because seeing is believing.
Welcome back. U.S. President Donald Trump has extended the deadline for Chinese firm ByteDance to sell TikTok's U.S. operations by a further 75 days. Let's talk to somebody who's tracked this story very closely from its beginning. Jim Anderson is Chief Executive Officer of Beacon Software. Jim, thanks a lot for joining us. This story obviously has been overshadowed by the tariff story. Does it fit into the tariff story? However, the U.S. and China are now angrily throwing tariffs at one another. Where does ByteDance fit into this?
Yeah, Paul, it's kind of crazy to think that TikTok, as popular as it is, one of the most valuable social networks in the world, companies like Amazon, Oracle desperately would love to have a piece of it, but it's a pawn on the chessboard of the larger U.S.-China relationships. A very important pawn, maybe, if there is such a thing. But clearly, there was a deal about to be done. It was going to be done by last Saturday, but the tariffs just threw that up in the air. And of course, the Chinese government has to sign off on any deal, and they're not going to sign off in the middle of these kinds of tariff negotiations. So hence another 75-day extension, probably not the last of the 75-day extensions.
What was the nature of that deal? Tell us about it.
Well, it's interesting. There's a lot of reporting on it. There was not anything definitive. The deal was not awarded, but Oracle was widely reported to be in the lead. Amazon wanted a piece of that. And again, these big tech companies, they see this not just as a massively popular application, especially with young people, but a source of AI training material. Remember, the world is headed towards artificial intelligence. If you could get your hands on the data associated with TikTok, train your algorithms accordingly, that's long and the short of why companies like Oracle and Amazon are so interested in that.
Where do Apple and Alphabet fit into this?
Yeah, Apple and Alphabet, of course, they both run the app stores, right? Apple runs the iPhone app store. Alphabet runs the Android app store. They're the ones that are actually the enforcement mechanism. The law banning TikTok in the U.S. requires the owners of app stores, and for all intents and purposes, it's just those two companies, to basically take them out of the app store. Then the U.S. Justice Department came in and said, well, you don't really have to follow that law. And at least seemingly for now, both Apple and Alphabet are content to follow that guidance. But they could decide that the politics might change on this. I mean, they are actively failing to enforce what's required by U.S. law under the guidance of the U.S. Justice Department. What happens moving forward and whether they continue to be comfortable not enforcing that law is an interesting question, because they have to think not just about this administration, but the next administration that might come in that might not look so favorably on the fact that those two companies have not been enforcing the law. You
referred to TikTok as the most profitable social media platform. How much do we know about its financials and its financial performance?
Well, we know very little because it's a private company and it's owned by ByteDance, which is a Chinese-owned company. So there's not a lot of transparency there in terms of TikTok-specific financials. It's just a division of ByteDance. We just know that they've got 170 million U.S. users. That's U.S. alone. They're a massively popular global platform. And, of course, they're advertising supported. And what do advertisers most covet? Young people. And what's the most popular social app among young people? It's TikTok. So, you could say it's one of the most valuable applications in the world, right? And not just today, but for where it goes moving forward. So it is massively important. But again, in the context of global tariffs and potential trade war, just one piece of a much larger puzzle.
How is it fundamentally different than other video apps? YouTube has been around for a long, long time, and there are other video-oriented apps as well. Why did TikTok prove to be such a game changer?
It's the algorithm, right? That's the secret sauce, and that's what really has been at the heart of these debates. Do you get control of the algorithm? And for all intents and purposes, the Chinese government is not going to let a U.S. company have control of the algorithm. It's massively valuable. We don't know exactly what they did, but they've done something. If you've ever used TikTok and you go on and you start scrolling, all of these apps, social and video and otherwise, their goal is to capture your attention, right? The longer they can keep you scrolling on your phone, looking at that, the more they have the opportunity to monetize that attention. And TikTok has done that better than anyone else. And people just sort of know it and they see it and they feel it, but they don't know how they do it. And that's the secret sauce behind TikTok's success.
And the concern is, of course, that under Chinese ownership, the app would become a tool of Chinese surveillance or spying on the U.S. population. Are those concerns legitimate in your opinion?
They are. And not only could that be the case, it might have already been the case. We would have no way of knowing. That's what led to such bipartisan support for the ban to begin with. Remember, Congress, which is remarkably fractious in the U.S. right now, agreed and on a bipartisan basis to pass this ban because of concerns about what the Chinese government might do. And, of course, everybody's insisting the Chinese government has not done that. Maybe they haven't, maybe they have, but the concerns are there just like they were when the law was passed, right? At any moment, if the Chinese government goes to ByteDance that says, we want you to do this, it's not really a request. ByteDance has almost no choice but to adhere to the wishes, accede to the wishes of the Chinese government. And, you know, that presents a remarkable risk when you've got 170 million Americans spending close to an hour a day on an app. If they put their thumbs on the scale of what those people are seeing in whatever way they choose to do it, I mean, that's a legitimate concern.
Jim, thank you very much for your insight on this story. Jim Anderson is Chief Executive Officer at Beacon Software. Coming up, according to the latest Nanos poll, the Conservative Party of Canada is closing the gap with the Liberals. We'll have more on that after this.
The Open is brought to you by Enterprise Mobility. We find roads that take your business new places.
At Canadian Gold Resources, we're building shareholder value three ways: assets, projects with double-digit gold grades in Quebec's high-grade Gaspé Gold Belt, and highly prospective interlocking faults. Innovation. Our upcoming bulk sample is projected to deliver $9 million, enabling substantial year one and subsequent dividends, rarely seen in juniors. Execution. Led by Ron Gauguin, founder and former chairman and CEO of Major Drilling. Canadian Gold Resources, breaking new ground in gold discovery and yield potential.
How's your fixed income fund performing? Compare the 9-point diversified bond fund, ranked in the first quartile in the Morningstar Global Fixed Income Market category for 1, 3, 5, and 10-year performance. 9-point, your advantage.
BMAX is Canada's first enhanced multi-asset ETF with high monthly distributions. BMAX blends multiple equity and fixed income strategies all in one ETF. BMAX on the TSX.
Doubleview Gold's Hat Project is potentially one of Canada's largest porphyry copper gold projects, with 477 million tons inferred and 150 million tons indicated copper gold resources, and a significant potential for scandium, an in-demand critical mineral.
When I acquired the project, the potential for copper was totally overlooked, but my belief was so strong that I actually mortgaged my home to drill it. We hit in the first year.
Doubleview Gold Core, the one to watch.
What's up? You seem kind of sluggish today. Things aren't really moving. You could use some Metamucil.
Metamucil's plant-based psyllium fiber helps keep your digestive system moving.
Now you're moving. Looking good. Feeling good.
Metamucil keeps you moving.
Gold standard. Gold dust. Pot of gold. Solid gold. Golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Closed captioning of this BNN Bloomberg program is brought to you by RBC Global Asset Management. Let our global reach take you further.
We're joined now by CTV's Scott Hurst to talk about, among other things, the most recent polling in the Canadian election campaign. Scott, thanks a lot for being here with us, as always. Tell us about the latest CTV Globe and Mail Nanos poll. What's it showing with respect to the Conservatives, the Liberals, and the NDP?
Good morning, Paul. Now exactly 3 weeks to the day until voters make their choices official on Election Day. But what we're seeing from the latest Nanos polling is that it appears to be getting a little bit closer between the Liberals and the Conservatives. That gap that the Liberals had opened in the middle of last week tightening just a little bit, showing that the Liberals and the Conservatives are getting a bit closer when it comes to who Canadians are looking at to vote for in the next election. So the numbers show that the Liberals, according to Nanos, are sitting at about 43%. The Conservatives now about 38%. And so that is the Liberals shedding almost 3 percentage points in the 3-day rolling sample by Nanos ending yesterday, while the Conservatives picked up almost 2 full percentage points. So let's look regionally to see where those votes potentially may be coming from. And the Conservatives are making gains in vote-rich Ontario, according to Nanos, now up to 42%. in that province, compared to the Liberals dropping back to 49%. The Liberals also showing some vulnerability in Quebec. The Conservatives are remaining steady, but the Bloc Québécois picked up a few percentage points in that province. And so when we break it down regionally, it's some of these vote-rich provinces like Ontario and Quebec where it appears now 3 weeks out. Once again, this is a snapshot of where it sits right now through the past couple of days. The Liberals are showing some vulnerability and showing that gap closed between the two frontrunners right now, Paul.
The issue of our relations with the United States and our response to the tariffs is clearly the election issue. How is the Trump factor playing in to some of these numbers?
Dealing with Donald Trump is, of course, one of the main factors throughout this entire election. The Trump tariffs are, of course, looming large over everything. According to Nick Nanos and the research that he's done on this, it shows that the Carney Liberals have quite the advantage when tensions between Canada and the U.S. are high. And we saw that play out in the middle of last week when Trump had that big flashy announcement of tariffs at the White House on Wednesday. But since then, we've seen the gap close a little bit. So it shows that voters potentially are showing interest in some of the other issues that weighed heavily on the Liberals for the past couple of years when their poll numbers were sinking. Of course, jobs, cost of living, houses, building homes, taxes, and dealing with crime. Those numbers, those issues we've seen the other parties focus on as well. So, of course, dealing with Donald Trump will continue to loom large. But if we're not focused on one particular day, like middle of last week when he announced those punishing tariffs, that is when other issues come into play. And that is where, according to the Nanos polling, we're showing the Conservatives able to close some of the gap with the Liberals.
Scott Hurst, thank you so much for keeping us up to date. That's Scott Hurst at CTV News. Let's check in on the futures market again and some of the key market barometers. We'll take a look at the U.S. futures, the volatility index, as well as oil and gold. There you see the futures markets down substantially. There's the volatility. That tells you how that essentially takes the temperature of investors. There is a lot of volatility in the markets, a lot of panic selling, to be sure, across the world. That's the Chicago Board of Exchange S&P 500 volatility index, clearly spiking to its highest level over the past year. Here comes crude oil. At 10 o'clock Eastern, we'll be speaking with Halima Croft. She is a recognized expert in oil and more to the point, the geopolitics of oil. So we'll talk to her about the looming trade war, the tariff war, and the price of crude oil, which has cratered over the past several sessions from almost $72 a barrel to $60.63 at the current time. And here comes gold, a rare green arrow on traders' screens today. You can see gold is up by about $10 US per ounce. That takes it to $3.45 US per ounce. Opening bells are right after this.
Are you sitting at home living with osteoarthritis? Maybe it's in your hands or your back or your hips. Osteoarthritis symptoms include joint pain, swelling, and stiffness. That's why there's Omega XL, a one-of-a-kind natural joint relief supplement created from the green lip mussels of New Zealand. It's small, easy to swallow, and it's backed by more than 40 years of clinical research that shows it's effective at helping relieve the symptoms associated with osteoarthritis. I'm taking it, and it really works. Just ask anybody who uses it. The results are undeniable.
Last week, I walked 6 blocks. I was so proud of myself. I ordered Omega XL. It's been the best thing that I did because it relieves a lot of pain. Everything changed for the best. I can go out. I can hang out with my sisters. I can go anywhere, clean my house. Now it's let's go, baby. This product is the best thing. You will remember what did it to you, and it was Omega XL.
Our investigation has shown us the truth on Omega XL and how it offers the hope needed to live a better life. You've trusted me for the last 40 years. I'm asking you to trust me now. I'm taking Omega XL because it works for me. And if it didn't, I wouldn't be backing it.
Try Omega XL today. Pick up your phone and call the number at the bottom of the screen right now for a special offer.
Buy one bottle of Omega XL and get one free. Call today and you pay only $39.95 in US dollars. And it's backed by a 60-day money-back guarantee. If you are not satisfied, just return the unused portion for a refund of the purchase price.
Try Omega XL and see the difference it can make in your life.
Call or go online right now to get this special offer. 2 bottles of Omega XL for only $39.95 US dollars. Call now.
Every April, something magical happens. This isn't just golf, it's the Masters on TSN. Presented by Mercedes-Benz and the all-new electric G-Class.
Here are the opening bells in New York and in Toronto. At the NASDAQ market site, Dollar Tree celebrates its 30th anniversary. At the New York Stock Exchange market site, Travelers celebrates the 15th anniversary of its public policy division. And closer to home here in Toronto, Evolve ETF celebrates a new ETF listing. Time now for the first 15. This is BNN Bloomberg. I'm Paul Bagnall. Thank you so much for being with us. At the market open, trading is just getting underway. Let's take a look at the markets in the first moments of trading. And you can see those markets are down, and they are significantly deeper in negative territory than the futures markets were just a few minutes ago. We saw 2%, 2.25% declines in the futures markets. Now we are seeing something very much in line with 3.5% to 4% as the market declines, including 3.7% here in Toronto. Here's a look at some key Canadian sectors. There are the energy stocks out of the gate. MEG Energy, Cenovus Energy, and Suncor all down by 5% plus, so the declines are very, very substantial. Crude oil is down, and these stocks will be down in harmony with it, and perhaps reflecting trepidation about further declines in the price of crude oil. Here comes Canadian technology. Celestica, Shopify, and BlackBerry all down very significantly. Shopify was down in double digits last week and begins this week with a decline of nearly 7%. Celestica has also fallen a long, long way from its peak. And BlackBerry, the Canadian software company, down by now 4.2%. Here comes the copper miners. The giant of the sector in Canada, of course, is Teck Resources, the largest publicly traded miner in Canada. It's down by 3%. First Quantum Minerals down by 2%. First Quantum's problems in Panama perhaps being overshadowed by the broader economic environment now. What investors are concerned about in copper is a global slowdown that would cut the demand for copper, and that's why we're seeing these stocks come off. Capstone is down by 4.2%. Let's go to the gold stocks and see if we see anything brighter there. We don't really, despite the fact that the price of gold is higher. The equities are selling off. Agnico Eagle down. Barrick Gold down. Barrick is contemplating a name change that would take the word gold out of its name. It could be renamed Barrick Mining. The decision not yet finalized. And B2 Gold down by about 2%. So the declines are broad-based here in Canada. For movers south of the border, we're joined now by Bloomberg's senior equities reporter, Bailey Lipschultz. Bailey, thanks a lot for joining us on an extremely busy day. What are we seeing on your side of the border? Let's begin, first of all, with the tech stocks.
Yeah, Paul, we're seeing a lot of selling off. So S&P 500 on the brink of entering a bear market if it ended today where it is right now. And also just want to call out, with you mentioning tech numbers, the NASDAQ right now having its worst 3-day drop since March 2001. A lot of that selling pressure driven by Tesla, driven by Apple, driven by NVIDIA. We've seen this entire group really rallying since the election back in November. No more. Most of them trading at the lowest levels and call it 11 or 12 months, depending on the stock. As you can see, a lot of pain. These are big moves for trillions of dollars of value. As you can see, though, again, investors getting out of some of these companies, whether it's supply chain tied like an Apple or just overall risk appetite. NVIDIA, one of the best performing stocks among big companies over the last few years, or Tesla, which has been seeing a number of issues, whether it's the Elon Musk aspect from the White House or overall sentiment potentially if we have a recession here in the U.S. How does that impact demand for the cars? But as you can see, big tech really leading the way downward, Magnificent Seven in quite a rut. But again, when you have someone from the Trump administration saying this sell-off is a Mag 7 and not a MAGA problem, it does seem like those are areas that people no longer can hide out in.
Okay, let's go to the banks. They, of course, are exposed to the entire U.S. and to a great degree global economy.
Yeah, we're seeing this, again, not quite the selling pressure that we saw for the Mag 7 names, but as you can see, 4%, 2.7%, and B of A just under 1%. As you mentioned, if there is a recession, there is uncertainty. Obviously, a lot of people bid up financial stocks on the wake of that election with expectations that we'd see an IPO boom and we'd see a surge in deal making. So far, not the case, and even more so if we are on the brink of potentially entering a recession, or even if we're just going to see depressed levels and a number of volatility spiking up. That's going to be a key factor on companies wanting to strike deals. Obviously, the consumer and the state of the consumer will also play into that. So as you can see, the financial sector, which again was one of those outperformers from November through early January, giving back a lot of those gains. But again, not quite down as much as big tech, but still a lot of selling pressure.
Jamie Dimon, the CEO of JP Morgan, urging a swift resolution to the tariff situation. The price of cryptocurrency is down. Certainly Bitcoin is down. What is happening to the share prices of stocks that are crypto exposed?
They're getting hit even harder. So we're looking at companies like Robinhood, the broker that has even increasingly leaned into cryptocurrencies. MicroStrategy, which does businesses strategy, also down about 10%. Coinbase, as you can see, down more than 6%. We are really seeing now the volatility and the sell-off leaking into the crypto industry. That's something we hadn't seen at the tail end of last week, certainly over the weekend. Now that we have Bitcoin under some more pressure over the weekend and into today, the big question going forward is how are investors going to value some of these companies? If you look at a Robinhood, they benefit from more activity, but if people are going to have to tighten down their investing and not trade as actively, that's going to dent the bottom line. And again, this could also just be investors trying to pare back and dial back some of that risk. High-flying companies that had been rallying, they're smaller, less predictable cash flows. They're getting hit, and as you can see, again, the entire crypto ecosystem, if you will, under some pretty sharp selling pressure again today as we extend this three-day fallout.
Bailey Lipschultz, thank you a great deal as always. After the break, the stock market sell-off, as we've just seen, continues this morning. For more on how to navigate a difficult environment, we'll be joined by Adam Johnson, founder and author of the Bullseye Brief.
Quotes about money. Every advisor in every old financial institution has one. Like this gem. A wise person should have money in their head, but not in their heart. What difference does it make if it doesn't end up in your pocket? So, how do you get yours? The answer is zero. Questrade thinks you deserve more zeros. So they changed the game again with zero commission trades. Now go get yours.
Explore tastes of tradition with modern notes and food as vibrant as the scenery. Explore more flavors. Visit Malta.
Get more from Canadian banks and insurers with HEB and HFN. Exposure to Canadian banks and insurers with 0% management fees until January 2026. HEB and HFN on the TSX. From Hamilton ETFs.
Welcome back. As you can see vividly on your screen, the very steep declines in North American equity markets look like they will continue for another day. That's what the opening 18 minutes looks like on the S&P TSX Composite here in Toronto and the S&P 500 and NASDAQ Composite Index in the United States. Let's speak with a veteran portfolio manager and market watcher in the U.S. Adam Johnson is a familiar face. He's also founder and author of the Bullseye Brief. Adam, thanks a lot for joining us. I've read some of your notes. You've been a market bull throughout over the past couple of years. I believe you see this as singularly the fault of the U.S. administration. Do you see any prospects for the administration to reverse its tariff policy?
Well, I'm certainly hopeful, Paul, because what they're doing right now is a total disaster. No matter how you slice it, no matter who you talk to, from businesses here in the U.S. to countries abroad, to people like Jamie Dimon, whom I'm sure you've been talking about, or Bill Ackman, well-known CEOs and investors, et cetera. The problem, Paul, is that I think all of us initially thought that the Trump administration goal was to just level the playing field, get everyone to the same tariff number, and ideally, in a perfect world, that would be zero. We would be a free trade zone, right? And then you would have goods and services moving efficiently across borders. As it turns out, I don't think that's his goal. I think his goal is trying to erode the trade deficit that we have with practically every country out there. The problem is, the reason we have a trade deficit is we consume more than we can make. Just look at oil, something that we here in America and you in Canada certainly appreciate. We in the United States consume about 20 million barrels of oil, crude oil, per day. We only produce 14. So by definition, we're at a deficit. By definition, we need to import. And so that's, I think, where the Trump administration is really wrong-headed. They're going after the wrong metric, a trade deficit. We need deficits because we need products. So I'm hopeful, Paul, that the administration is starting to realize the error of its ways and pivoting. As I'm sure you've been reporting, 50 countries now supposedly have reached out to the United States and said, hang on, let's negotiate this thing through. So I'm hopeful that we will get some sort of progress over the next couple of days. But, you know, the clock is ticking. We can't just keep waiting and keep watching everything implode.
So the big question for investors, and we're getting questions from our viewers on this, is should I be buying these dips? Now, why don't you take that question? Is this the right time to buy?
Here's my iPhone. I just called my trader before I came on air with you, and we're buying the open. So it's really hard to do, Paul. Buying in the hole is an awful, gut-wrenching feeling. And yet, I remember back in 2020, in March of 2020, when the indices were down actually more than they are now. And we did a little bit of nibbling. We weren't trying to be heroes, but we did do some buying. Buying in the hole is very hard to do, but it's generally the correct thing to do. Now, I would also say that if you're on margin, you've got a real problem because you're getting squeezed. So margin is something to avoid, but if you have cash and you can deploy it, there's some amazing companies. Look at all the AI companies. Take a Celestica, ticker CLS. I think it's trading, which is sort of a half Canadian company, really, when you think about it, half US, half Canadian. They assemble AI infrastructure ecosystems. And, they buy the chips, they wire them together, they buy storage devices. All of a sudden, you're in business with an AI platform. Celestica is trading down around, depending upon which moment we look at the screen, probably 10 or 11 times earnings, a fraction of the S&P 500, with probably 3 to 4 times their growth. NVIDIA is trading cheaper than the S&P 500. Supermicro Computer, on and on. But you know what, Paul? We could talk about practically any name. A Delta Airlines at 4 times earnings. A Ford, right at the point of this whole trade battle, trading at, assuming the earnings are real, 5 times earnings with a 6.5% yield, actually 7, assuming they don't have to cut the dividend. So there's a lot of uncertainty, there's a lot of pain, but if you do have some cash, you can deploy it into high-quality companies. The Magnificent Seven, they're not going anywhere. Salesforce.com, #1 for customer resource management. Palo Alto Networks, #1 for cybersecurity. These are big, chunky companies. They make a lot of money. They're very profitable, and they're down a lot. These are the names you can buy. The ones on the fringe, let's let the market steady first. But the ones that are big and chunky, yeah, we should be buying these, Paul.
Or in normal times, investors think about stocks with the economic the state of the U.S. economy in the background. And you seem constructive on the U.S. economy. I see a list of factors in your recent commentary called chill out #1, chill out #2, and chill out #3. You think the U.S. economy is doing just fine?
So that's the irony of this whole craziness, Paul. It's totally self-inflicted. We were doing great until this whole tariff thing came out of nowhere. I mean, think of the declines just in the past 4 or 5 days, because no one thought that anyone, that would be the president, would be stupid enough to do what he has done. We have GDP growth of 2.4%. That's pretty good. We have inflation that has come down, and we'll get more inflation data later this week, CPI, PPI. We have inflation that has come down to, on average, about 2.5%. That's pretty good, down from 9 to 11% 2 years ago. We have an economy that is enjoying virtually full employment, 4 to 4.1% employment. We have the most number of people ever making the most amount of money ever, and they are spending it. God bless them. So the economy has been doing fine. We have earnings growth, by the way, Paul, or at least in the previous quarter, of 12% that's expected to accelerate to 13 or 14%. And that, by the way, is with 13% profit margins. That combination of growth and profitability is the best we've seen in 2022. So yes, I sort of tongue-in-cheek, when I wrote it Friday, said chill out, chill out, chill out. And now all of a sudden this morning we're down again and we don't have a resolution. And I feel like chill out is not only cavalier, but almost tone deaf or brain dead. And it's just mind-boggling. Again, these are self-inflicted wounds. The economy has been doing great. And what the White House is pursuing is mind-boggling. They're driving us off a cliff, Paul. And I say that as a proud American who runs the American Ingenuity Fund. This is not a proud moment for any of us down here.
Adam, thank you for your candid commentary on a unique market day. Adam Johnson, founder and author of the Bullseye Brief. Up next, we'll check in on the energy sector amid the tariff battles. We'll speak with Halima Croft, and Bart Mellick is up next.
Closed captioning of this BNN Bloomberg program is brought to you by RBC Global Asset Management. Let our global reach take you further.
Interactive Brokers pays up to 3.83% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
If you're looking to invest, Capital Direct's One Income Trust could be right for you.
Our track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards.
Find us online.
Call today.
CapitalDirect.ca. Explore the world the Viking way. From the quiet comfort of elegant small ships with no children and no casinos. We actually have reinvented ocean voyages, designing all-inclusive experiences for the thinking person. Viking, voted world's best by both Travel and Leisure and Condé Nast Traveler. Learn more at Viking.com.
Max out your RRSP.
When it comes to finance, everyone thinks they're an expert. Our guests actually are. Money Talk with Kim Parlee, brought to you by TD Wealth.
This is Grace Sloan Memorial. Is there anyone there?
Help me get her to OB.
Oh my God, how the hell did this happen?
You okay?
I still have a job to do. Will you stop walking out on me?
Grey's Anatomy, all new, Thursday at 10, 8 Mountain on CTV.
Welcome back. The price of crude oil has been hammered over recent trading sessions. Let's talk about it with Bart Mellick, Managing Director and Global Head of Commodity Strategy at TD Securities. Bart, thanks a lot for joining us. As you point out in some recent analysis for TD clients, tariffs are not the only headwind facing the crude oil market. OPEC Plus and its commitment to raise production quotas, another headwind. Why don't you sum it up for us?
Well, it's great to be here. Well, you know, we are already experiencing a pretty lackluster demand environment with China's demand growth really slowing down this year versus the previous several years. And we're looking at maybe 900 to a million barrels a day of growth. Now we have those tariffs, which could bring that down significantly lower. But that's not the whole story. We've got OPEC Plus continuing to overproduce. They're saying they're going to get back to, their quotas. But on the other hand, they also announced just over 400,000 barrels of new production, going forward. In our opinion, this is going to bring that market into a pretty significant surplus. It could be 600,000, 700,000, 800,000 barrels a day for the next few quarters, and fairly large accumulation of inventory. That has traditionally been very bad for prices. In fact, when we look at the derivatives market, the CTA, algorithmic traders, they are quite short here. It's debatable whether they want to go more short, but for the foreseeable future, it doesn't look great. The demand side is weak, and we continue to see not only OPEC, but non-OPEC suppliers increase output as well.
What's the likelihood that OPEC rethinks the strategy of increasing production?
I think the likelihood is pretty good. Historically, they've always tried to match supply with demand, and at some point, if we see prices go into the mid-50s or even lower, they will judge that the market is oversupplied and act accordingly. Now, there is a school of thought out there that they may very well be pursuing market share, and if that's the case, that may take a little longer than normally. But I'm quite convinced that over the next quarter or so, they will start maybe backing down on this, if, of course, this whole tariff mess doesn't get resolved.
What's your take on the copper market? Copper prices are still, I think most people will call them high, historically high. I think we're at about $4.10. We're at $4.27 US per pound right now. But the plunge has been dramatic, and copper markets are clearly pricing in a slowdown on the global economic front.
Well, they sure are. And, and U.S. prices are a little higher because of the expected tariffs under the 232 provisions, as was aluminum and steel. If we weren't for that, we'd probably see still lower prices. LME has dropped quite a bit, the global benchmark. And we're looking at a situation where, given this tariff environment and the very recent retaliation from China, aggregate demand for manufacturing products that contain copper are going to be weaker. And that's just the reality. And if we were looking maybe at a small deficit in 2025, now we have to start confronting the possibility that we're going to have a surplus. And anytime there is a surplus, prices will gravitate lower here. And if we're, in a recession, like some people think may very well happen, of course, if this tariff business doesn't get resolved, then we could still see some downside. We've seen copper prices drop 40, 50% during recessions. We've corrected quite a bit, but there still could be some room to go if the macroeconomic environment doesn't improve very much, the outlook, that is.
Is this environment broadly negative for the entire commodities complex?
I would say broadly, with the exception of maybe gold here. Gold, I suspect, will tend to continue to do very well. We were trading well over $3,000. We've eased a little bit with the massive volatilities we've seen in the market, and that could be just a function of people adjusting their VAR. And maybe some profit taking. But down the road, we really like gold, mainly because we expect the Federal Reserve to probably start easing. And looks like the market is pricing in a much more aggressive easing than we did before the tariffs. And the implication here would be higher inflation, maybe at around 4%, and a Federal Reserve that is adding stimulus at that time. And that traditionally has been a very good environment for gold.
Bart, thanks a lot for joining us as always. Bart Malik is Managing Director of Commodities and Global Head of Commodity Strategy at TD Securities. Coming up, a look at some early market movers on the Toronto Stock Exchange. The Open will be right back.
Need fiber for our digestive health, but most Canadians only get about 50% of the fiber they need. Good thing Metamucil gummies are an easy way to get plant-based fiber. 3 gummies have the same amount of fiber as 2 cups of broccoli. Metamucil gummies, the easy way to get your daily fiber.
Introducing Best Buy Express. It's never been more convenient to discover the possibilities of tech. What if the greatest tech was always within reach? Imagine that.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
The Open is brought to you in part by Canaccord Genuity Wealth Management. Wealth Management Reimagined. Discover more at wealthreimagined.ca.
Welcome back. Let's keep you up to date on how the market is faring. Here is a look at the S&P TSX Composite Index. We're now almost half an hour into the trading day, 25 minutes in, and the S&P TSX Composite down by about 2%. Perhaps some investors are thinking right now it could have been worse. 2% is the decline on the S&P TSX, taking the index all the way down to 22,689 points. Here are some stocks that are moving. Large cap stocks. Shopify, one of the most prominent stocks in the TSX, down by 3% so far today. Strathcona Resources looks like it's leading the way down in the energy sector. That stock down by 2.25% to very close, if not exactly to a new 52-week low. Onex Corporation, the conglomerate and private equity investor, down by 2.7%, reaching its lowest level since September of last year. IGM, that's IGM Financial, down by nearly 3%. And Manulife Financial, the huge Lifeco company, down by nearly 4%. So those declines are very, very steep. Well, oil prices are down again, with the U.S. benchmark falling below $60 U.S. per barrel earlier today. Up next, a conversation with Halima Croft. She's head of global commodity strategy at RBC Capital Markets. That's coming up on the other side of this break.
Focus on your goals. Trust in our ETF experience. BMO has been offering ETFs to Canadians since 2009. BMO ETFs. Build on trust. Learn more at bmogam.com/ETF.
What's up? You seem kind of sluggish today. Things aren't really moving. You could use some Metamucil.
Metamucil's plant-based psyllium fiber helps keep your digestive system moving.
Now you're moving. Looking good. Feeling good.
Metamucil keeps you moving.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach, one that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
If you're looking to invest, Capital Direct's One Income Trust could be right for you.
Our track record boasts stable income, portfolio diversification, and compound growth.
Last quarter, Capital Direct's return hit over 10%.
Find us online.
Call today.
CapitalDirect.ca. Still up at 2 a.m. again? Tonight, try Pure Z's All Night to help increase total sleep time. Unlike some other sleep aids, our extended release melatonin slowly releases up to 6 hours. ZzzQuil Pure Z's All Night. Fall asleep, wake refreshed.
Virgin Plus is obviously the choice for affordable phone plans with lots of data. So is the selling power of a certified actor doctor really necessary? Does it help if 10 out of 10 pretend doctors agree it's easy on the wallet? Or that you get discounts on food, fashion, and entertainment? Your glasses aren't real. Do we need all this doctory stuff to convince you? We don't. Because when you're choosing an affordable phone plan, the obvious choice is Virgin Plus. Obviously.
Welcome to the second hour of the Open here on BNN Bloomberg, and thank you so much for sticking with us. Here are some top stories that we're following for you here in the newsroom. The federal government has initiated a dispute with the World Trade Organization regarding the 25% tariffs the U.S. has imposed on Canadian autos and vehicle parts. Ottawa claims the measures are not consistent with U.S. obligations under various provisions under the General Agreement on Tariffs and Trade. Canada has since imposed a retaliatory tariff of 25% on U.S.-made vehicles that do not comply with the North American Free Trade Agreement, or CUSMA. Activist investor Simpson Oil is proposing a full overhaul of Parkland's board of directors in the latest development in the fight for control of Parkland. Simpson is also proposing the removal of Parkland's long-serving chief executive officer, Bob Espey. In a letter to shareholders, the investor blames Parkland's board and management, for a deeply flawed capital allocation strategy and says it aims to fix what it calls chronic underperformance at Parkland. In reply, Parkland says the move by Simpson is an attempt to seize full control of the company without paying a control premium. Barrick Gold is proposing dropping the word gold from its name and changing its name to Barrick Mining Corporation. Barrick says that name change could reflect its changing production profile as it expands its copper mining operations. The Toronto-based company is advancing work on a giant copper gold project in Pakistan and is also expanding another copper project in Zambia. We've looked at the Canadian markets just before this break. There's a look at the U.S. markets, down about 2%. So the declines have eased somewhat from the early moments of trading when these markets were all down by 4 to 4.5% or so. Now the declines are in the 2 to 2 2/3 of a percentage point. The NASDAQ Composite actually down slightly less than 2%. Let's continue our conversation on the oil market. We're joined now by an expert in the geopolitics of oil. She's Halima Croft, head of global commodity strategy at RBC Capital Markets. Halima, always great to talk to you. Thanks for making some time for us. In your most recent note, you've taken a very close look at the OPEC Plus decision to bring forward production increases. A lot of people are wondering why OPEC Plus would do that in the current market environment. You say the answer likely lies in the idea of a warning signal to other oil producers in the world, correct?
Yes, I mean, it's similar to what we saw basically in March of 2020. Remember when they could not reach an agreement at the OPEC meeting, and essentially OPEC said, if you can't reach an agreement with Russia, we're going to put barrels on the market. This time it's a more restrained action, but it is a warning to countries like Kazakhstan, to Iraq, to Russia to a certain degree, that if they do not get their compliance better, if they not come into conformity with what they have pledged to do, then starting next month, OPEC is going to be bringing forth more production. So we do have a meeting on May 5. That will be an important meeting. They will look at the production levels of these three countries to see if they've managed to bring their production down. And I think they can then either pause that decision, go forward with that decision, reverse the decision. So it is essentially a 30-day warning about what is to come if these countries don't reverse course on production. I think also some key members of OPEC, countries like Saudi Arabia, wanted to disabuse other producers that they were so wedded to higher prices that they were prepared to continuously prop up the market to allow other countries to continue to cheat. So again, a warning shot. People I've spoken to have said this was not done to please President Trump, but President Trump is obviously very happy with the price action. Treasury Secretary Bessent was on the Sunday talk shows in the United States talking about lower prices. The real question, I think, when it comes to the U.S. is what type of calls are U.S. shale producers now thinking about making to the White House, because this is not good for their overall economic outlook.
How do you see, what do you think has caused the recent plunge in crude oil prices? The common interpretation is that the market is worried about a global economic slowdown and a plunge in oil demand, all of that arising from the tariff assault from the White House.
100%. You asked me what is the underlying driver of this decline in prices. It is a concern that we are going to see a significant contraction in global demand. But again, you layer into that as well. At the moment where we have heightened demand fears, we are also facing the prospect of additional supply. And so again, you can say the primary driver is a demand concern, but then the OPEC decision, I think, really exacerbated the price action. I think it caught a lot of market participants by surprise. And so now they're having to contemplate. Some are thinking, are we back to 2014? Are we back to 2020? I think it is a different OPEC strategy. Again, the barrels won't be coming till next month. And there will be a meeting on May 5 where they review the decision. But again, what you don't want if you want higher oil prices is a contraction in demand and then additional supply coming on at that precise moment.
You mentioned the U.S. shale producers a moment or so ago. Circle back there. What you say? The lower prices are not good for the U.S. shale producers, and that they may be making their feelings known to the White House.
I mean, we certainly saw this. We had a ringside seat for this in March 2020 when you had that OPEC meeting, end without an agreement, and then you had the Russia-Saudi price war in the middle of then what was the largest demand contraction in history due to the COVID pandemic. And you had U.S. shale producers, really being afraid that they would go out of business. And it's a little bit of a playbook of what we're seeing now. Initially, President Trump was out there saying in March 2020, this was great for the U.S. consumer. And then shale producers started calling the White House saying, President Trump, American energy dominance dies in a much lower price environment. And so, again, I've always been sort of interested in how this dynamic between U.S. producers and the White House would evolve, because President Trump on the campaign trail was talking a lot about wanting oil prices in the 50s. His advisors had talked about oil prices in the 50s. They now have, at least for today, oil prices now in the 50s. But we kept saying this was not a price that U.S. producers wanted. This was not something that was viable for the overall goal of American energy dominance. And so again, I think it's going to be if this price action continues, if we go lower, I do think there'll be calls from the producers potentially to the White House to say, we may not be able to, you have your tariff policy, but there's also an OPEC policy. Can you try to find us some relief on these fronts?
One thing politicians in any country love to see are lower gasoline prices. Are we seeing those now, or will we see them very shortly in the U.S.?
I mean, it has a bit of a lag, but again, certainly if we stay in these ranges, yes, U.S. consumers will be paying, lower gasoline prices. If we move into the low to mid 50s, yeah, you'll be talking retail gasoline prices, in the $2 range, $2.50 range. But again, that's, there are the other worrying signs about the global economy as well. So consumers will have to weigh that up. But again, a stated goal of this, administration has been the prolific growth of U.S. shale. They've really talked about wanting American energy dominance. And again, the current price outlook is not compatible with American energy dominance. And so something potentially has to give. You can't have everything everywhere all at once.
Halima, thank you so much for joining us today. Halima Croft is head of global commodity strategy at RBC Capital Markets. Coming up, with the market sell-off intensifying, our next guest finds opportunities in some Canadian names. Tim Regan at King West & Company joins us next.
Thousands of Canadian businesses don't have access to the support they need. BDC is committed to opening the way. Breaking down doors for entrepreneurs. We're on it. BDC, financing, advising, know-how.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF, Mulvihill.
We created these! We're 4 Canadian friends that quit our jobs because we hated our underwear. We couldn't take the chafing, riding up, and constant adjusting. So we spent 12 months creating our own. They're made with a premium modal fabric that's breathable like cotton, but it won't stretch out. And we designed them to contour and support the boys, preventing sticking. We also made it to Dragon's Den and received offers from 4 different dragons. So visit manmadebrand.com to experience ultimate crotch comfort today.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Welcome back. Look at the green arrows on the bottom of this screen. The S&P 500 and the NASDAQ Composite have pushed into positive territory. That happened just in the past 30 seconds or so. So there's a live look at the North American markets. You can also see the decline in the S&P TSX Composite is now only 1/3 of a percentage point. So buyers are stepping in. Let's speak with a professional investor, get his thoughts on when might be the right time to buy and how he's thinking about this market meltdown that we've seen prior to this morning. Tim Regan joins us now. He's at King West & Company. Thanks a lot for joining us, Tim.
Thank you, Paul.
How have you been thinking about this market meltdown? What have you been telling your clients as they worry about their portfolios?
As they worry, we've been through 7 business cycles at our firm before, so our clients have been with us for quite a few of them. This is not any different. In fact, it's more one man. It's not a global financial crisis. It's not a pandemic, and it can change on a dime, much like the markets did in the last 30 seconds. However, it's like a fog,
And you can't do anything in the fog. Once the fog's lifted, meaning tariffs, then you can review the landscape. So everything's kind of on hold.
I want to bring viewers a Donald Trump tweet. I'm not sure I can put my hands on it right now, but he has said recently that leadership in Japan has contacted him. The tweet seems to be that negotiations are beginning with some of these other countries. Might that be a reason for improved market sentiment?
Absolutely. It's only about what Trump is doing today. And he's created a problem. He has to fix his mess. And that's what you're seeing the markets react to. The markets were a little high in valuation, especially on the U.S. side coming into this. But this is really all about Trump.
Here is that tweet. Donald Trump on his, it's not technically a tweet, this is on his Truth Social account. I'll read verbatim what he has said. Countries from all over the world are talking to us. Tough but fair parameters are being set. I spoke to the Japanese Prime Minister this morning. He's sending a top team to negotiate. They have treated the U.S. very poorly on trade. They don't take our cars, but we take millions of theirs. Likewise, agriculture and many other things. It all has to change, but especially with China. So belligerent in the second half of that posting, but probably what the market wants to hear in the first part, correct?
Trump will talk tough. He'll cave. Right. We've seen it before.
Okay. Is this, for Canadian investors, is this a time to step in and buy some stocks that are substantially cheaper than they were just a week ago?
Well, I mean, if you asked me an hour ago, it would have been a different story than today. We're starting to see some of this lift. And right now, you know, we have 10% cash. We're still 90% invested. But you get a great bargain when markets go down like this on just solid, good companies with recurring revenues. So if you want to buy them today, and you're going to hold them for 5 or 10 years, great opportunity.
Let's please show that North American market board again. This is a real moving target. There's a significant upswing in the markets going. Look at, in only the 90 seconds or 2 minutes that we've been talking to Tim Regan, the NASDAQ composite has gained about 1.5 percentage points over that period of time. So there's a very significant market rally going on, at least for now. Okay, one stock you like is Sun Life Financial.
Sun Life Financial, yes. We're talking about companies that are great businesses that have recurring revenues, and there's a chart right here. We've owned Sun Life for quite some time. It has about a 4.3% yield. It trades at around 10 times forward earnings, and you've seen it go from 84 and just plummet to 77. Nothing to do with the business, all to do with tariffs. These are the great franchises you can buy at decent prices today.
Okay. Another one you like is a consumer staple, Empire & Company, one of the big publicly traded grocers in Canada.
Well, as I like to say, even with tariffs, people will have to eat. As you can see, that the chart's moving quite along. There's a lot of different things going on with Empire. Their margins are improving. They've lagged their competitors, Loblaws and Metro. But once again, we saw it up, 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 boom. It drops down with the tariffs. Another great thing to buy that's a solid franchise.
And why don't we move on to Cigna Group, another stock you like?
Cigna, where is Cigna today? Yes, Cigna is one of the largest health insurers in the U.S. In fact, it's one of the top 2. Health insurance doesn't go away. Really, with Medicare, Medicaid, they're really not involved in that game that much. And we're looking at another company that today, and we've owned Cigna for over a decade. I think we originally bought it at under $60. And if you go back, it's a great long-term franchise. And today, valuation-wise, I'll say again, around 10 times forward earnings on a great company with recurring revenues.
If investors are going to buy some of these names, how do they do it? Do they edge in? Do they move in gradually?
You know what? If you have 5 or 10 years, you can just get in. But, you know, nobody likes to catch a falling knife. Mm-hmm. And so come in gradually. The stock market, I don't think, is too gradual today, which is a good thing on the upside, but not good on the downside. Mm-hmm. Now I'm kind of shocked looking at the numbers.
Yeah, let's bring that board back, please. It is remarkable. Look at the numbers now on the NASDAQ composite, the S&P 500, and the S&P TSX composite. All of this has unfolded in the past 5 minutes or so. This is a very dramatic upswing in markets. What's the market thinking here, Tim?
Well, I guess I'm your good luck charm, though, here today. But I think what the market is thinking, they were focused just on tariffs. And they were focused on Trump finally coming and saying, I've got to deal with these countries. He probably had a month or 2 month window before it would really affect the economy. Now he is. And he's doing it in typical Trump fashion. And you'll just see all the dominoes line up and go down. And of course, Trump then will say, when the markets are up, I push the markets up.
This is volatility, though, correct? Volatility involves some green arrows as well as red arrows, correct?
Right. I mean, this is why you have to remain invested in the market. As much as I said we had 10% cash, I was at the beginning of the year looking for new ideas. We're 90% invested for our clients. Ride it out. Have some cash on the side to take advantage of great opportunities, which maybe they didn't get down far enough in some cases, but this is what the markets do.
Tim, thanks a lot for being here.
Paul, thank you for having me.
Tim Regan, Managing Director and Portfolio Manager at King West & Company. Coming up, we'll have the latest with Bloomberg's Vince Signorella right after this.
The Open is brought to you by Enterprise Mobility. We find roads that take your business new places.
Power your portfolio with Global X Canadian Oil and Gas Equity Covered Call ETF ENCC, Canada's largest energy covered call ETF. Backed by energy built for your future. Get invested with Global X.
Still up at 2 a.m. again? Tonight, try Pure Z's All Night to help increase total sleep time. Unlike some other sleep aids, our extended release melatonin slowly releases up to 6 hours. ZzzQuil Pure Z's All Night. Fall asleep, wake refreshed.
Earn more from investing in Canada's largest banks and life cos. Get high monthly income and enhanced returns with SBC and LBS. Over 15 years of proven performance. SBC and LBS on the TSX.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters, the core of a portfolio. They're meticulously crafted to endure. Capital Group, actively different.
Looking for a smarter way to mop? Try the Swiffer Power Mop. An all-in-one cleaning tool that gives you a mop and bucket clean in half the time. Our cleaning pad has hundreds of scrubbing strips that absorb and lock dirt away. And it has a 360-degree swivel head that goes places a regular mop just can't. So you can clean your home faster and easier. Goodbye hassle, hello Power Mop. And with TerraCycle, you can recycle your Swiffer pads.
Welcome back. Markets dived at the open this morning and have since rallied into positive territory. Let's talk about all of this with Vince Signorella. He's the voice of Bloomberg Global Macro Squawk. Vince, thanks a lot for talking to us. Most recently, in the past 10 minutes or so, we've seen a significant upswing in markets. Why don't we begin there? What do you think's going on here?
So we saw some comments from Hassett from the White House said that Trump is considering a 90-day pause on all tariffs, with the exception of China. And this drove markets from the red into the green. We're starting to pair those gains right now. S&P cash still hanging on up about 58. But you got to take this with a little grain of salt. Yes, it's definitely positive, definitely something to rally on. The machines are really going wild this morning. I have to tell you, it's been tough keeping up with them. Watching this thing, it's been like a tennis match. My head going back and forth. But the Dow is now just going into the red. the comments are Trump is considering delaying the tariffs, and while that is a good feel in terms of the tariffs not being enacted, obviously this week, if that were the case, that's going to give us 90 days of more confusion and 90 days of more comments, 90 days of more volatility. And risk swinging from the red to the green and the green to the red. So I don't know if I would put all my chips on the table in this one. Maybe dip your toe a little bit and thinking that potentially things could turn for the positive. But be ready for a lot of volatility and a lot of swings, I think, in the near future.
President Trump has also put a post out on Truth Social in which he says countries, in the plural, are approaching us with tough but fair parameters. In other words, he's sending the signal, Trump is, that a process of negotiation may be beginning. Is that another potential positive?
Yeah, it did lift markets as well early on, but then you get somebody like Navarro coming out earlier this morning and saying, in response to that comment, that the bigger problem is non-monetary tariffs. So he cited Vietnam, for example, who said they're willing to bring tariffs down to zero, but then there are these non-monetary tariffs that Vietnam imposes that made for other considerable roadblocks to free trade. And Sefcovic of the EU this morning on the tape as well, basically saying we're willing to negotiate with the U.S. We haven't been at the table with them. There's no sign of negotiation. And when we get to that table, we're not giving up on VAT, and we're still going to take a hardline stance. So while all of this is positive in that there may be negotiations coming, so far the rhetoric doesn't sound positive in terms of solutions being resolved at those negotiations.
How does all of this look to the Fed, and do you expect the Fed to cut rates sooner than anticipated, potentially as early as next month? And as you answer this question, Vince, we're going to put the Board of North American Markets back up on the screen. They are all now back in negative territory. So there you go.
Yeah, substantially in the red. Actually, I'm going to glance over and say your 182 for the Dow is actually down 600 at the moment. So it's a really big swing to the negative side. I don't expect the Fed to weigh in next month unless something dramatically happens to the U.S. economy, turning it to recession of some sort. I don't think that's going to happen in 30 days. I think the Fed's going to want to keep their powder dry. I would expect they're going to have to cut at some point, unless, of course, inflation numbers turn ridiculously higher given the tariffs. I mean, I don't see as many cuts as the market sees because I think inflation is going to be a problem for the Fed. So while they do need to cut, and they probably will within the near future, to try to just give the economy, or give traders and investors, and the economy as well, some confidence. I don't see as many cuts as the market sees because I think inflation's not going to give the Fed that much room to do as many cuts as the market wants.
Vince, thank you as always for your insight on a big day in the markets. Bloomberg's Vince Signorella. Coming up, the market sell-off continues again amid the tariff war. We'll have more on that after this break.
I want this show to be a bright spot in your day. I want to share all the good stuff that life has to offer.
The Good Stuff with Mary Berg. Weekdays on CTV and Crave.
With the current U.S. administration in place, there are growing questions around whether the energy transition can sustain its momentum. To discuss where sentiment stands is John Cook, Senior Vice President and team co-lead of the Mackenzie Greenchip team. What are some of the ways that investors can take advantage of these opportunities you're talking about?
First of all, I think you need a deep understanding of the sectors, and I talked about wind and solar, but it's so much more than that. It's all the componentry that go into this equipment, industrial automation, water management, growing food. You need expertise to understand the drivers within these sectors, and they're not all linear. There's times to invest, times when securities are expensive, and so on. So I do think investors that want to be here, they do need professional asset managers to help them with that. And if you're interested, I would make a strong case why every investor should have at least some of their savings. Okay, well, I think, first of all, the world is very crowded. when we started, there were 7 billion people on the planet. There's now 8.1. We're consuming more than we ever have. And the energy transition is not going away because we're pushing the world up against its ecological limitations. Not just the California fires, but ocean acidification, degradation of soils to grow our food, and so on. We have to do this. So they should have exposure for that reason. And right now, because sentiment's so poor, valuations in our space, mostly across the board, are very, very attractive. And finally, there's tremendous diversification right now because the world has been so interested in AI and I'll call it capital light technology investing. So there is absolutely a place to invest in strategies like what we're doing for a piece of what particularly Canadian investors should be thinking about.
The price of crude oil is sinking, down by about 0.9 of a percentage point to $61.42. That's the live look at West Texas Intermediate crude oil. The benchmark fell below $60 a barrel this morning, a deteriorating demand outlook, and Saudi Arabia's cuts to its flagship oil price seem to have weighed on the commodity. Saudi Arabia slashed the selling price of its key Arab light crude oil to Asia by the most since 2022. Saudi's price move was more than traders had expected and came in addition to a surprise output hike announced by OPEC Plus last week. The province of Ontario is providing $11 billion in relief and support to workers and businesses affected by the tariffs. Ontario Premier Doug Ford says as a first step, the province will defer select provincially administered taxes for 6 months, including the employer health tax. Ford also says the province will break down internal trade barriers by speeding up timelines and approval for developments, as well as diversifying Ontario's trade partners. Conservative leader Pierre Poilievre, federal Conservative leader Pierre Poilievre, says he will create a new one-and-done rule for resource projects if elected prime minister. The pledge aims to create a one-stop shop that will require one application, one environmental review, and a one-year maximum wait time for approvals, so businesses can avoid multiple processes and departments. Poilievre also pledges to quickly approve projects that have been stuck for years in the approval process, including Phase 2 of LNG Canada, a massive liquefied natural gas project in northern British Columbia. There are the North American markets. This is what volatility looks like. We saw some substantial increases about 10 or 15 minutes ago. They followed very severe declines at the open. We're now back into significantly negative territory. Stocks whipsaw, as that banner tells you, as traders seek clarity on the tariff rollout. Okay, the Bank of Canada has just released its Bank of Canada Business Survey. There are numerous headlines moving on that topic. Companies expect input costs to accelerate. That's one of them. So companies are expecting higher input costs. Companies' near-term inflation expectations rise considerably. That's the word used by the Bank of Canada, rise considerably from the first quarter. So the takeaway here appears to be that from tariffs, companies in Canada expect significantly higher inflation, including inflation in their input costs, which many of them would seek, of course, to pass on to consumers. Companies believe that the inflation effect from tariffs will outweigh soft demand for products. The Bank of Canada survey also saying nearly 1/3 of companies who were responded to the survey are planning for a recession in the coming year. So there you go. You have elements there of a stagflationary outlook by companies in Canada. They are expecting significant increases in costs, in inflation. They are also, many of them, 1/3 of them, planning for recessionary conditions, which would be a contraction in economic growth. The Bank of Canada survey of businesses also showing that hiring plans are on hold now at many of the companies that responded to the survey. The Bank of Canada has also released a consumer-oriented survey. That consumer survey shows that consumers also expect the trade conflict with the United States to lead to higher prices. Consumer confidence in the labor market weakens sharply, and the survey findings reflect responses in February and March. So the responses to these surveys were as recent, or came as recently as the month of March. And the tone of the responses, both on the business side and the consumer side, is pretty clear. The expectation is therefore rising costs, slowing economic growth, and a deteriorating labor market. Well, earlier today, as we began the Open, we spoke with David Nelson. He's chief strategist at Bell Point Asset Management. We talked about investors reacting to the tariff war and when they might reach the so-called capitulation stage. That's where we began our conversation with David Nelson.
We are hitting that phase right now. You're starting to see VIX levels, approaching COVID levels, where there was real panic. And you really saw some capitulation on Friday, because on Friday, investors ran out of places to hide. For the last couple of weeks, they've been hiding in consumer staples, maybe utilities, stocks that paid high dividend. On Friday, everything was for sale. In large part, I suspect a lot of money came out of index funds. Around 2 o'clock, it started to accelerate. That's when fund managers probably get a message about how much money's coming out of their fund. So everything was for sale. And at the end of the day, a lot of PMs, even like myself, were thinking we didn't sell enough.
You say in some recent commentary, some notes written just this morning, I believe, that the velocity of this decline is reminiscent of the early days of COVID. And this is the part that I find interesting, most interesting, and it signals deeper undercurrents beyond geopolitics. What do you mean by that? You seem to be saying there's more at play here than concern over a tariff-driven trade war.
Certainly this tariffs are the bigger part of this, certainly in the near term right now. But we're already starting to see some cracks in the system. I think the DeepSeek moment really started to unwind the AI trade. We started to learn that maybe here in the United States, we're spending maybe too much capital, where they're finding maybe a better widget. And perhaps that had forced, this pullout of like data center stocks, the Dells of the world, a lot of the semiconductor companies. Perhaps we were overbuilding. I think there was some cracks there, but we're also running debt and deficits that are massive at this point. And even, some well-known people, former hedge fund manager Ray Dalio, have come out and said the United States is really just one step away from a financial heart attack. And that's in part and parcel why some of this is happening right now, why this tariff economic war is taking place.
Another very prominent hedge fund manager, Bill Ackman, has said that while he's broadly sympathetic with the administration's desire to correct some imbalances in U.S. trade relationships with its partners, is alarmed at the way the administration has done it. It is calling for a 90-day truce in which perhaps calmer heads prevail and other options for pursuing these objectives are pursued beyond the wall of tariffs that the U.S. has now erected. What are your thoughts on that, on this alarm that we're seeing from people who are very market knowledgeable?
I would take it a step further. I would say that we need a new Bretton Woods, because that's where all this really started. It started 80 years ago in 1944. Tariffs are an economic weapon. There's no other way to look at it. It's mutually assured destruction if everybody's doing it. Back then, the United States was the strongest economic powerhouse coming out of the war, and it made sense for the United States to let other countries tariff us more than we tariff them. 80 years later, with the United States running debt and deficits this large, that's problematic. Now, where I would agree with Bill is the following. For CEOs, the uncertainty here is what's really playing havoc with the market, because even if you wanted to onshore your manufacturing capacity back to the United States, what the president wants, if you're a CEO, you're going to do nothing, because the president may, in the next couple of months, eliminate the tariff on that country, in which case you made a mistake. That uncertainty is playing out in real time, and that's where I would agree with Bill.
Let's return to our original conversation. Are you seeing opportunities now to put money to work, and if so, where?
Well, they're all over the place, but you know, we could buy something today down 2, 3, 4, 5, 6, 7%. It could be down another 10 tomorrow. Until the capitulative phase has run its course, I suspect the first couple of rallies out of this will be significant. But there'll also be opportunities for a lot of people to sell things that they didn't get an opportunity to on the way down. Until this market repairs and goes back to another all-time high, which is likely not to be anytime soon, the market is going to be suspect for some time.
What are your thoughts on U.S.-China relations at this point? That's where the tariffs are the highest. China has responded angrily and with tariffs of its own. What are your thoughts on the U.S. trade relationship with China?
You know, I found it comical because China put out a statement this morning saying that you know, the United States is manipulating trade. You know, something they've been doing for the last 30, 40 years. My guess is they're going to attack, and they're going to probably try some political advantage here, try to make some deals with the EU. That could be likely to come. They could also devalue their currency dramatically. They could also use the ultimate weapon. They could start completely eliminating or start completely ignoring intellectual property and starting to sell some things like Microsoft Word at $5. Just ignore it all. Those are weapons that they have, so this is not over at this point.
Okay, why don't we finish with gold? It's a bright spot in the markets these days, and as I've said a couple times on the station so far this morning, advocates of gold, investors who believe in gold, will tell you it's doing exactly what it's supposed to do right now, and that's hold its value.
You're right. I mean, it is doing exactly what it's supposed to do. It's a place that you go to in geopolitical uncertainty, and maybe some of the Bitcoin, you know, alternative. Bitcoin being an alternative to gold isn't really playing out as many had thought, because that's been proven to be a risk-on asset and is going down as hard as NASDAQ right now. So it is a safe place. I suspect the metal is a safer place right now than the actual stocks, the paper asset, although I own both.
David Nelson is chief strategist at Bell Point Asset Management. He joined us earlier this morning. Coming up, our hot pick segment, we will zero in today on 3 stocks in the consumer discretionary sector.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me, or is there some kind of clue here?
Focus on your goals. Trust in our ETF experience. BMO has been offering ETFs to Canadians since 2009. BMO ETFs. Build on trust. Learn more at bmogam.com/ETF.
I love that my daughter still needs me, but sometimes I can't help due to pain in my hands. So I use Nervive Nerve Relief.
Its dose of ALA helps relieve pain associated with peripheral neuropathy, with results starting in 14 days.
Now I can help again. Feel the difference with Nervive.
Hi, Phil Swift here for Flex Paste Clear, the clear rubberized paste that can waterproof virtually everything. And it can be applied on wet surfaces, even underwater. Get Flex Paste Clear.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
In today's turbulent markets, Starcore works to minimize risk and maximize shareholder value.
Our established management team is unlocking the mystery of the source of mineralization at our producing San Martin gold mine, while using free cash flow to explore our portfolio of advanced assets in Mexico, Canada, and Côte d'Ivoire, Africa. With no debt, Starcore offers investors leverage at every stage of the mining life cycle, from exploration to production. Learn more at starcore.com.
There's something real here, right?
Yeah, of course.
What if we don't have kids?
Late Bloomer, new season April 11th, only on Crave.
Closed captioning of this program is brought to you in part by Bell. Get more on Canada's fastest 5G plus network.
Welcome back. It's time now for Hot Picks. Our next guest covers the consumer discretionary sector, and he joins us with three stocks in that area of the U.S. market. Let's begin. Filippo Falorni, Director of U.S. Beverages and Household Products at Citi Research. Filippo, thank you very much for joining us. Let's begin with the macro backdrop. The U.S. economy very much in flux now. The market has brought forward its expectations of rate cuts. There are expectations tariffs could drive prices up and slow economic growth. Lots of moving parts. How does the macro backdrop look to you, and how will it affect the consumer discretionaries?
Yeah, absolutely. So, look, I think the macro backdrop is clearly deteriorating in the U.S. Many companies are starting to talk about consumers pulling back on their consumption levels. Ultimately, look, my space is a little bit more immune from some of these macro backdrop. I cover categories that really are daily use categories, especially in the household product side. So these names have been viewed pretty defensive throughout prior economic downturns. And you saw in the early phase of the market sell-off that these names held up a lot better, especially on Thursday. Last Friday, you started to see all the consumer group, including staples, really underperform as well, as the market is kind of like extending those declines. But look, ultimately, with the macro slowdown, a lot of my companies are going to be relatively more immune compared to the rest of the economy.
Okay, let's jump into your picks. Your top pick is Keurig Dr. Pepper, ticker symbol KDP. Why is that your number one pick?
Yeah, so we moved it recently to our top overall pick because we think the fundamentals of these companies are really underappreciated in the current valuation. So they have essentially two businesses, a coffee business and a refreshment beverage business. The refreshment beverage is more the beverage side, so the Dr. Pepper, Canada Dry, and some smaller brands that they're selling almost entirely in the U.S., like 90% U.S. exposure. So much less at risk from tariffs and from international trade wars, and that business is growing significantly in the mid to high single-digit range. It's been an area of strong growth for the company. They continue to gain share within the U.S. beverage business from Coke and Pepsi, and they continue to expand their distribution. So that part of the business has been very solid. The coffee side has been a little bit softer over the last couple of years, but ultimately the company has provided pretty conservative guidance within coffee, and coffee is one of those areas where, because of the cost inflation moving up, there's opportunity for KDP to take pricing. They've assumed pretty significant volume elasticity for pricing, but ultimately, if they're actually able to take price and consumer doesn't change their consumption behavior significantly in coffee, they could actually have upside both on top and bottom line.
Okay, number two is Monster, ticker symbol MNST in the U.S. market. Why do you like Monster?
Monster plays in the energy drink category. That's almost 95% of their sales exposure. And that category has been particularly solid in the U.S. We've seen some softness last year when you started to see some concern among low-income consumer on the category, but now it's started really to reaccelerate significantly in the U.S. A lot of it is also the fact that this category historically for the past decade was didn't really have a lot of healthier options. And now now there's been all these new brand introduction. They have zero sugars, they have better for you energy, and they've really expanded the consumer base of this category. And then Monster, being the number 2 player globally after Red Bull, have still a solid opportunity from a market share standpoint in the US, but even more in the international market. If you look at the US market share, it's about 32% compared to Red Bull at 33, 34. So pretty much neck to neck with Red Bull in the US market. Internationally, Red Bull has over a 35% market share versus Monster only a 10% share. So it's a healthy category, and they have significant market share opportunities that makes it to us a very compelling story.
Okay, and your third pick today on Top Picks is perhaps the best known name in the beverage industry, Coca-Cola.
Absolutely, yeah. So look, Coca-Cola has been our topic of over the prior year. We moved it a little bit lower, but it remains our favorite multinational within the group. So multinational clearly have a little bit more risk from this global trade war. From a tariff standpoint, there's not a lot of direct implication for Coca-Cola, given they produce almost entirely locally in every country. But there is some risk from anti-American brand sentiment around the world that we've seen. I would say Coca-Cola remains our favorite of all the multinationals because their actual fundamentals remain very solid. They have about 40% of sales in emerging markets, which they can actually drive volume and price growth. And even in the US market, they've been able to diversify their portfolio away from carbonated soft drinks, which is their main product that everyone knows, into better for you categories. More recently, they've acquired Fairlife, which is essentially a dairy protein-based drink option, including Core Power, which is their core SKU. And they've really been able to grow that part of the business a lot faster than the core carbonated soft drink side of the portfolio. So even the US market, they're actually able to grow volume, which has been pretty remarkable. And then internationally, they do have a lot of opportunities in emerging markets.
Filippo, thank you very much. Filippo Falorni, Director of U.S. Beverages and Household Products at Citi Research. Coming up, a closer look at what Ottawa is likely to consider when applying retaliatory tariffs.
Disappointed with rates offered by GICs and high-interest savings accounts? Get more with H-Bill, a higher-yielding alternative for your Canadian and U.S. cash. H-Bill, more income every month. From Hamilton ETFs.
Harvest Healthcare Leaders Enhanced Income ETF. Maximize your monthly cash flow from Canada's leading healthcare ETF. More income from healthcare leaders. Harvest ETFs. Income happens here.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
I know.
Is this yours?
Yeah, Ma.
No way. Yes way. Get in.
There's nothing like that first Mercedes feeling. Experience the feeling yourself at a local Mercedes-Benz dealer.
We serve Canada's wealthiest investors. Center Wealth Partners of CG Wealth Management deals with investors who have $10 million or more of liquid investments. Contact us today in complete confidence. We'll be here when you're ready.
Welcome back. Canada, of course, is considering applying retaliatory tariffs towards the United States. We sat down earlier today with Randall Bartlett. He's Deputy Chief Economist at Desjardins. We began by talking about the geographic factors that might figure into how the Canadian government responds.
One of the big things that the government of Canada has to take into account is how the retaliatory tariffs are going to impact U.S. export sectors. And so when we dug into especially the first $30 billion in retaliatory tariffs applied by Canada, very much targeted on those export sectors in the U.S., where Canada is by far the largest buyer of those U.S. goods. And so we're talking things like Kentucky bourbon, Florida orange juice, other processed food items, other areas of the U.S. other parts of the U.S. that really rely on Canada. And so by doing so, they're hoping, I think, to get that political leverage, have maximum impact in places that are going to have the maximum political leverage in the United States.
I guess my question is more general. I understand putting retaliatory tariffs to get the message across and hopefully get some of the Republicans, senators, governors to go to the president and say, we can't continue like this. My question is more, what would you say about doing something else other than retaliatory tariffs? Obviously, when you put tariffs on goods coming into our country, you're hurting our consumers. And I understand they're going to try and be very selective as to what they put tariffs on. But wouldn't it be a better idea to perhaps look to, cutting taxes, make investment in our country more economic, keep businesses here? Why would they leave Canada to go back to the U.S. if the taxes were low enough here that they wanted to stay? What happens if we fight back against the U.S. by lowering taxes to try and bring more business to our country? Wouldn't that be, over the long term, a better idea than worrying about this tit for tat?
Yeah, my sense from the political leaders of the major two federal parties in the election right now is it's a little from column A, a little from column B that they're using as an approach. On the stick side, I mean, by applying those retaliatory tariffs to U.S. producers, I think the hope is to get that political leverage to get the U.S. to back off on their tariffs and actually come to the negotiating table. And we're seeing a lot of pain being inflicted, I think, on U.S. producers, not to the same extent that we're going to get hit, but certainly it is going to apply that pressure and that pain. But at the same time, we look at the political platforms as much as they've been rolled out so far, largely in one-off announcements. But the focus, I would say, generally has been on reducing taxes, a desire to reduce regulation, and to promote both investment and internal trade within Canada, investing in infrastructure, so trade supporting infrastructure like rail, roads, and ports, that sort of thing, to support internal trade, but also diversify our international trade. So I think the approach, it seems that our political leadership is taking on both sides of the political spectrum, is that it's both and as opposed to either or.
In your report on this, you have looked at you say that Canadian policymakers need to consider the effect that that Canadian tariffs on U.S. goods will have on Canadian consumers. In other words, how easy it is or difficult it is for Canadian consumers to find substitutes for American products that become much more expensive.
Yeah, that's right. So when we dug into some of the other lists that have been of goods that have been hit by retaliatory tariffs in Canada, you see that when we responded to steel and aluminum tariffs this time around, both we hit steel and aluminum. So there's that reciprocity of tariffing, but that only tallied up to about $15 billion worth of goods being tariffed. And so the remaining $15 billion was really focused on those goods that would have a minimal impact on the Canadian economy from a growth and inflation perspective. So those goods that Canadian consumers and businesses will be able to substitute with goods imported from elsewhere or produced domestically. And so really, there has been that focus both on maximizing the impact on U.S. exporters, but minimizing as much as possible the impact on Canadian consumers and businesses as well, to the greatest extent that they're able to do that.
Yeah, and I guess this whole buy Canadian patriotism that we're seeing from everybody, that's probably doing the work of the tariffs already. It's interesting. We put tariffs, or we talk about putting more and more tariffs on goods. Is it even necessary? Because I've heard a lot talking to individual businesses. A lot of business down south is being hurt because people aren't flying to the U.S. People aren't buying U.S. goods. Perhaps that's doing the job of these retaliatory tariffs without us even having to put them on.
Oh, you're definitely seeing that in the data. There's no question there at all. When we look at travel to the U.S., I mean, in February, we're back down to basically pandemic lows in terms of travel to the U.S. from Canada for vacations. When we look at, some of the, what's coming out of some of the associations of for various sectors of the economy in the U.S., whether that's, agricultural associations, whether it's manufacturers, U.S. producers are feeling this hit of less demand coming from Canada, and Canadians either looking to buy Canadian or diversifying for goods from other parts of the world as well, where folks are friendlier when it comes to trading with Canada.
We're almost out of time, but my final question is, do you have a view on whether an aggressive counter-tariff strategy is the right strategy for Canada? There are voices out there, as you know, who say the best strategy might be for Canada not to retaliate.
Yeah, I mean, as an economist, when I dig into the data, it seems to me that, I mean, we are going to, see growth be weaker as a result of retaliatory tariffs. But even more so, we're going to see inflation be that much higher than it would have been otherwise in the absence of those tariffs. Now that we've the federal government's removed the price on pollution, that's going to provide some relief. That's going to provide, offset some of that impact from those retaliatory tariffs. But at the end of the day, it's the country's citizens that put on the tariff that pay the tariff. So ultimately, we are going to pay the price of these tariffs. If it pays off in political leverage, then ultimately it may prove that it's effective. But if it doesn't, we just end up paying the cost. So I think it's a risky strategy, but one that I think the federal government and most Canadians, the polling suggests, thinks is worth taking.
Thanks for watching. Andrew Bell and Morning Markets is up next.
The Open is brought to you in part by Canaccord Genuity Wealth Management. Wealth Management Reimagined. Discover more at wealthreimagined.ca.
Interest in Canadian ETFs continues to rise, with assets under management reaching a record-breaking $519 billion last year. Joining me now to discuss the latest ETF trends is Prerna Matthews, Vice President of ETF Product Strategy at Mackenzie Investments. Prerna, thanks for being here.
Thank you for having me.
What are some of the key themes investors should consider right now?
So there's 5 key areas of focus from our perspective in the near term. The first one is geopolitical uncertainty, right? So there's a lot happening in the world around us, and that means having to build resilient portfolios for the world we live in today, not for the world we've lived in before. And so that requires active decisions and, portfolios evolving over time. The second one is international diversification, right? So more advisors and investors looking to other parts of the world to diversify portfolios, and lots of great reasons to do that now. The third one is around income. As our population here in Canada ages, we have more income needs. And those income needs can't just be fulfilled off of fixed income in a portfolio, right? So how else are you generating that income within the equity portion of your portfolio? Another key area is active management, just generally more investors, advisors looking to actively manage solutions, funds, and ETFs to be able to navigate that uncertainty I spoke of earlier, right? So how do you actually take advantage of pockets of the market where there is opportunity to be had, right? So that's going to be another key theme. And the last one I would mention is quality and valuation. So in times of uncertainty, you tend to see companies that are higher quality or have more value tend to do better or sustain those more uncertain times, right? So we're going to see more investors, advisors seek solutions that give them access to more quality and value exposures.
Hello there, welcome to Morning Markets here on BNN Bloomberg. Let's have a look at some intraday charts for the markets, because if I say anything, it'll probably be out of date as soon as it's out of my mouth. You can now see that the NASDAQ narrowly in positive territory. Talk about a roller coaster. We plunged shortly after the open. Here is the Dow almost back to level pegging. Let's have a look at the S&P 500. Now, yep, it Well, it's flat, pretty well pancake-like right now. You can see it did go positive earlier, but was apparently a, inverted commas, fake news headline that Trump's team were considering postponement or delay of at least some of the tariffs. And there is the TSX still under pressure. Oil, of course, earlier hit $60 US. It was just north of 61 last time I checked. We'll get perspective on the markets and this reversal we've seen so far with Lyle Stein in a moment. But first, here are your headlines, the big stories we're bringing you from the BNN Bloomberg newsroom. The Bank of Canada says inflation expectations among businesses and Canadians have increased. In its Business Outlook survey and survey of consumer expectations, the central bank says many firms are delaying investment and hiring decisions due to the trade conflict. Consumers also expect tariffs to lead to a higher cost of living, and more than half of Canadians expect a recession this year. The federal government has initiated a dispute with the World Trade Organization over the 25% tariffs the U.S. has imposed on autos and vehicle parts from Canada. Ottawa says the measures are inconsistent with U.S. obligations under various provisions under the General Agreement on Tariffs and Trade. Canada has since imposed a retaliatory 25% duty on U.S.-made vehicles that don't comply with the North American Free Trade Agreement, or, of course, as it's known now, CUSMA. And activist investor Simpson Oil is proposing a full overhaul of the board at Parkland in the latest development in the fight for control of the fuel seller. Simpson is also proposing the removal of Parkland's long-serving CEO, Bob Espy. In a letter to shareholders, the investor blames Parkland's board and management, saying that they have engaged in a deeply flawed capital allocation strategy. And Simpson says it's aiming to fix what it calls chronic underperformance. Parkland says the move is an attempt to seize full control without paying a control premium. Another look at the North American markets. You can see U.S. stocks now narrowly up after sliding earlier. At one point, both the S&P and the Nasdaq were down more than 4% this morning. The TSX still posting a modest loss of about 0.5%. Let's get more on the markets from Lyle Stein, president at Forvest Global Wealth Management. Lyle, thanks for giving us the time this morning. It seems perilous to say anything about the markets right now, whether they're up or down, because it changes so rapidly. But what has caught your interest this morning?
Well, there's no question about the uncertainty out there in the market, Andy. Markets don't like the fact that they really can't make what I would call a bet on the future, given the tariff uncertainty. Now, that's creeping into all kinds of other things, such as how do you actually even look at a company in this highly uncertain world? Mm-hmm. And so, you have a day where we were down 4% at the open, and then this rumor comes out, and then we run off, and now we're kind of balanced. One might say it's oversold, but without any sense of where the world is going, it's hard to make a strong case. It's going up, it's bottoming, or it's going to continue down.
Lyle, one argument you would make was that even prior to this tariff-induced sell-off, stocks, I think especially you mean in the U.S., were at pretty high multiples of earnings. But now even those earnings have come under question.
Well, and that's the big unknown. So, one of the things we do every week is look at FactSet data. It comes out every week in terms of U.S. S&P 500 earnings. And the surprising thing is, yes, they're down, but they're not down, in our view, nearly enough, given the economic uncertainty, given the significant slowdown in the U.S. economy, and then given the fact that margins are at all-time highs. And so until we start to see analysts dropping their numbers, and that'll start happening really in the next couple of weeks with the Q1 earnings reports, it's hard, again, to make a positive sense on how to properly value this market. And so now it's in the hands of traders. And, today's action is just an example of that trading activity that's caused by hedge funds and more day traders than investors.
Let's put up maybe a 1 week for the TSX Banks Index or the Financial Index. You may have seen National Bank analyst Gabriel Dechaine cutting his earnings estimates for the banks. And I mean, earnings estimates across the board in all industries are probably going to be coming down.
Well, yeah, that's right. And, the thing is the banks are very levered to the Canadian economy. And so the bet that investors are making when owning Canadian banks is that our economy will continue. The growth, albeit slow, will allow these dividends to increase. And that's really why people own bank shares. But again, in this time, it's hard for us to see Canada outperforming as an economy, given our, tight nature to being linked to the U.S.
I mean, I'm always bringing this up. The viewers are probably sick of it, but would you be attracted by a TD Bank right now? Yield well north of 5%, and of course, they'd be extremely low to cut it. I mean, they've a really strong balance sheet for one thing.
That's an issue. We wouldn't be a buyer of Canadian banks, much more looking towards the U.S. banks than the Canadian banks, because we are in Canada, a very unique real estate situation. And so domestic banks, and granted TD is less domestic than some of the others, still give us cause for pause in terms of making an investment in the area. There's a 5% yield there, and that's good. But there's other places as well where we can get 5, 6, 7% yields. And we think those are better than buying a Canadian bank stock.
Where would you look for yields like that, Lyle? What industries or companies?
Well, we've talked about this before, Andy. We like the pipeline area. Okay. We like the fact that we're getting well north of 5% yields. And we like the fact that it is a North American situation more so than a made in Canada situation. Really intrigued today by the Canadian energy stocks. I mean, they've gotten absolutely slammed. And, the price of oil, as you mentioned before, is hitting $60. But these companies are really in good shape. And the beauty is at $60 oil, ultimately, the price is self-correcting. So it's an area, and by the way, the companies have hedged, so it's a good place to look for income. There's lots of places to look for income when everything goes on sale. And so what we're looking at now is how to upgrade our portfolio. Take cash that we do have and reinvest it now, not at 4% yields, but 5 or 5.5% yields. Just not looking at TD.
Oh, okay. What about tech? Let's have a look at a 1 week chart for the NASDAQ 100. Are any of those big U.S. tech names appealing to you right now, Lyle?
We don't have a lot of tech in our portfolios. Part of the reason that the market has been so strong, it was a one-way trade. ETFs, technology ETFs in particular, saw all kinds of cash flowing in. And as a result of that, the narrowing of the funnel into the names such as the Magnificent Seven took these stocks up to quite high multiples. They've come in, but they could come in a lot more on a liquidity basis. As investors continue to be concerned about what's going on, any doubt to the economy, they sell. And you tend to sell the ETFs, and the ETFs are all heavily concentrated in those Magnificent Seven names.
That's been a thing we've heard warnings about, haven't we? That so much money went into the ETFs, the market weight, the index-weighted ETFs, and that pushed up the tech stocks, and people got jubilant about that, and they bought more ETFs. But I guess things like that work in reverse on the downside.
Well, exactly. And that's why we really view this as a great opportunity to stock pick, that it isn't just playing a trend, playing a liquidity wave, playing the momentum wave. We're more fundamentally driven. And so this is a market that's coming back to fundamentally driven investors like ourselves. This is actually a great opportunity to buy things that went on sale because they got blown out of an ETF as the ETF had to sell down to basically buy stocks. So value, I think, is coming back into the market, though not immediately, and not on these days when everything is down 2-3%, whether it's NASDAQ, Dow, the Russell 2000. On days like that, it's a great chance to just keep your powder dry and look and think.
Lyle, am I right in thinking that you're weighting in gold and gold stocks is close to 20% now?
That's about right. Plus or minus. I mean, depending. We manage segregated accounts for our clients at Forvest, but that's the general weighting. We have had a very a positive view on gold as a asset class that we call protection against calamity. Calamity, from an investor perspective, comes in two ways. It comes in the way of inflation, which is the long-run death of investing, and it comes in the way of geopolitical uncertainties. That we've had for a long time, since Trump's talk about tariff. Uncertainty is reigned, and that's very positive for the gold market. Whether you own gold shares, gold bullion, gold royalty companies, they've all been relative winners. And that really came through with our portfolios in the first quarter.
We'd better leave it there, Lyle. Thank you so much for joining us today.
Good talking to you, Andy. Take care.
Lyle Stein, President, Forvest Global Wealth Management. Coming up next, as Trump's reciprocal tariffs loom over the world economy, we'll discuss what impact are they likely to have, at least at first, on global trade. That's ahead.
Quotes about money. Every advisor in every old financial institution has one. Like this gem. A wise person should have money in their head, but not in their heart. What difference does it make if it doesn't end up in your pocket? So, how do you get yours? The answer is zero. Questrade thinks you deserve more zeros. So they changed the game again with zero commission trades. Now go get yours.
At Canadian Gold Resources, we're building shareholder value three ways: assets, projects with double-digit gold grades in Quebec's high-grade Gaspé Gold Belt, and highly prospective interlocking faults. Innovation. Our upcoming bulk sample is projected to deliver $9 million, enabling substantial year-one and subsequent dividends, rarely seen in juniors. Execution. Led by Ron Gauguin, founder and former chairman and CEO of Major Drilling. Canadian Gold Resources, breaking new ground in gold discovery and yield potential.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Have you outgrown your wealth advisor? At Standard Wealth Partners, we specialize in managing significant portfolios of at least $10 million and higher. Contact us today in complete confidence. We'll be here when you are ready.
Invest like a champion with Hamilton Champions ETF CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
Okay, well, let's find out how Trump has apparently changed the rules of the global economy with this massive list of what he calls reciprocal tariffs. Confusion, of course, reigns over the longer-term implications, even the short-term impact of this. We're joined by Karthik Sunkaran, Senior Research Fellow in Geoeconomics at the Quincy Institute. Thank you very much indeed for joining us.
Thank you for having me. Pleasure to be here.
I think it's fair to say that the methodology that was used in coming up with these tariffs is obscure. I did see Peter Navarro, one of Trump's advisors, on CNBC this morning, and he, for instance, said, well, sales taxes imposed by our trading partners, they're protectionist. So it seems that I think that there's a lack of clarity among economists as to what Trump wants the rules to be.
Well, I mean, from the way it looks from the calculation, it seems as though he thinks that there should be balanced trade, not just across the system as a whole, but in every single bilateral trading relationship. And that's what you can back out of the methodology because, as many people have pointed out, the combination of tariffs and non-tariff barriers, what's imputed to that is basically a country's trade surplus as a fraction of the as a fraction of its exports to the U.S. And so you're kind of imputing missing imports in that through that calculation. It's like, oh, these imports are missing. These must be non-tariff barriers, and that's being done not at the level, not just as the level of the global economy, but each single country, and you end up with this crazy quilt of individualized tariffs for single countries, which then does away with the principle of most favored nation, that you treat all countries for each product the same way. So that's some pretty big damage to the rules of the game in general.
Just walk us through that again. What is meant by this most favored nation concept, and why is this being undermined here?
The idea is that, except for certain exceptions, like a free trade area such as USMCA, the idea is that countries should treat other countries the same on any single product. So, for instance, if you have a tariff of 15% on a widget with India, you should have that same tariff with Japan, assuming, and the exceptions are basically either a free trade area or a set of preferences given to very poor countries. And this undermines that principle pretty much completely. So that is a big issue for the global trading system as a whole, because as part of this larger rethinking of American trade policy, where what matters is not the rules and the formal equality of countries under treaties or under WTO rules, it's sheer market power. It's like, Robert Lighthizer said in his first term that one of the problems with the WTO was there was too much litigation, not enough negotiation. I think what the administration wants to see is a lot more negotiation on everything. And in doing so, it's undermining the basis of litigation.
Canada and Mexico were spared the latest round of duties. And you think Mexico is particularly interesting here because it has emerged as the biggest U.S. trading partner?
It has. And, this goes to some of the discordances within the administration and within the broader American electorate about trade. And I've phrased this as there are at least three groups. There are openers who want to use trade policy to push open doors in other countries, to get them to open their markets to the U.S., to get them to lower tariffs. There are the decouplers who are mostly concerned only about China, and their view is, well, we just don't want this supply chain involving China. But if you bring it to Vietnam or Mexico, we're fine with that. And the third group are the repatriators who say, well, it's not good enough to put these things in Canada or Mexico. Everything needs to come back to the United States. And there's this tussle. And what we've seen in the process of the Canada and Mexico tariffs is that tussle is actually playing out, because you got a set of tariffs imposed on automobiles, which are contrary to the USMCA letter. There are some exceptions in recognition of the reality that a very large number of auto parts, for instance, come from Mexico. The supply chains are deeply intertwined, so there's some exemptions for that. But they still are trying to tariff all non-U.S. content, including that content that is consistent with current USMCA rules. So that leans a little more in the repatriationist camp, I think, which is to say, we want to bring these supply chains ultimately back to the U.S. But in this latest round of tariffs, Canada and Mexico did escape the reciprocal tariffs. So I think there's just a tussle within the administration about how to deal with Canada and Mexico, in line with this question of, well, do we need to have everything back in the U.S.? Is it okay just to have things in North America? What do our industry partners think, and so on?
I mean, there's a reason why factories moved out of America, and it wasn't unfair trade practices. It's just more expensive to make things in the USA. Are they chasing a quixotic dream here to have a massive manufacturing sector in the USA again?
Certainly in certain industries, right? Because I think you know, you've had a development of the U.S. economy that has gone in the direction of high technology. I mean, you know, Boeing still exists. There are a lot of cheaper products that have been outsourced. The administration and supporters would argue that that process has gone too far, and we need to reshore for a couple of reasons. One being the impact on big sectors of the U.S. domestic economy, and the other being national security. Post-COVID, and even more now, you need to have a much stronger industrial base that is secure from geopolitical risk. I think it's going to be very hard to do it all, frankly, for precisely the reason that you mentioned. There are already calculations that, you know, the price of the average car in the U.S. will go up by 10 to 15% as a result of this, and it's not clear what the tolerance of the American broader public will be for inflation. Other constituencies will be affected by retaliatory tariffs, American agriculture most obviously. So this is a moving target politically, and I think that's one way to see it. A final point is there's just so much uncertainty about what the tariffs are meant to accomplish. Are they a negotiating tool? Are they permanent? Before you write off a $10 billion plant somewhere outside the U.S. and bring it back home, you want to know what this is for.
Yeah, it's interesting. The Wall Street Journal calculating that Trump's policies would apparently increase the the price of an iPhone by nearly 60%. So we'll see how consumers react to that kind of thing if it comes to pass. Thank you very much indeed for joining us, Karthik.
Thank you. Absolute pleasure to be here.
Karthik Sundkarn is a senior research fellow in geoeconomics at the Quincy Institute. Coming up, we are going to drill into how U.S. markets are doing. We will talk to the chief investment strategist at RIA Advisors. We'll be right back.
Introducing the Brompton Cash Flow Kings ETFs. Investing in high cash flow yielding companies, putting their power to work for your portfolio. Brompton Cash Flow Kings ETFs, because cash is king.
Practice starts in 20. Let's get it. T-Mac.
Who shaves for practice?
My game face doesn't take days off with Gillette Labs.
Gillette Labs?
Gillette's ultimate shaving experience. Its green bar releases trapped hairs so you can get virtually every hair in a single stroke, reducing irritation from shaving over the same spot.
You looking smooth, brother.
Let me hook you up.
Appreciate that, kid.
Best your game can get.
Keeps getting better.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
Closed captioning of this BNN Bloomberg program is brought to you in part by Scotia iTrade. You have what it takes to start direct investing. We have the rest. Scotia iTrade.
Let's take another look at how the major U.S. indices are faring right now. And we'll get more from Lance Roberts, Chief Investment Strategist at IA Advisors. Thank you very much indeed for joining us. Really appreciate it. No point really talking about whether the markets are up or down in the sense that they're so volatile. What's catching your attention today?
Well, I think what's important is this morning we had a little bit of fake news out early on that there might be a 90-day pause in tariffs. And, you know, what that showed was immediately on that announcement, the markets rocketed higher by over 5%. That was just a massive move straight up on that news. That was immediately disavowed by the White House. They said, no, that's not the issue. And the market sold back off again. But what that shows you is these markets are so deeply oversold here is that any bit of good news is going to bring buyers back into the market. So from an investment standpoint, I'd be very reticent about being a seller here just out of panic. I know the markets have been down a lot over the last 2 days in particular. It's been a very sharp sell-off. But this is a lot of margin debt reduction that's going on. We're getting a lot of broad selling just across asset classes. Really no safe place to hide. So our initial reaction is to just sell everything and get out of the markets. But again, I think what today's action is showing you is that there are buyers out there, and there's a good bit of pent-up demand. And any bit of good news on the negotiation front for tariffs could lead to a fairly strong short-term rally.
The market has gone way below its 200-day moving average, the S&P 500. And that is a metric that you attribute a lot of importance to. So enlarge on that if you would, Lance.
Sure. Look, markets run in trends over time, and the 200-day moving average, it's widely followed. Markets know this average. It's where the price of the market trades above or below a certain price over the previous 200 days. And when markets crack,
Sorry, I think we froze there on Lance. We'll try and bring him back. Maybe we'll have a look at the TSX now, because we were talking, of course, about the U.S. markets there. Maybe you can put up an intraday for the TSX. And I'm just checking about the big value traders in Toronto. TD Bank and Bank of Nova Scotia, both down more than 3%. They are the biggest trading in terms of dollar value right now in Toronto. Royal Bank down a bit less, about 2.5%. Shopify, interestingly, relatively speaking, holding its own. It's down only about 1%. But here is a headline from Bloomberg. Merchant sales growth may face sharp cut because anything that interferes with international trade, not so great for Shopify's growth and sentiment on that stock. There's the TSX. You can see we are down. Maybe we can have another we got Lance back. Lance, thanks very much. Sorry, we lost you there. You were talking about the importance of the market going below the 200-day moving average. It's a metric widely watched. What are your thoughts on that?
Basically, the thing is that is an important level for markets to watch. There's a lot of computer program trading at that level. Hedge funds watch that. Pension funds watch that. The severity of the break below that 200-day moving average suggests that this market's going to be in a bit of turmoil for a while. So I would expect, as I was saying, there's a lot of pent-up demand here. I think we're going to get some buying coming in the next week or so. Any type of good positive news from the administration will certainly help that. But I would be using that to reduce risk in portfolios, raise a bit of cash. I think we're going to see a bit of volatility here for a while as we go through, the impact of tariffs, if there's, what this does to economic growth. Most importantly, what this does to corporate earnings. This is a tax. Tariffs are a tax on businesses. It's going to reduce earnings. And because of that, that's going to lower valuation expectations of the market. So again, expect some volatility here. Use rallies to reduce some risk.
Is there such a thing as a defensive sector right now? I mean, a staples retailer or banks or...
Eventually, yes. Right now, everything's getting sold off because we have a lot of what's called margin calls going on. We had a lot of people trading on margin. That's getting reduced. And today in particular, we're seeing bonds get sold. We're seeing defensive stocks being sold off. They've been a good place to be. I think they'll return back to a place to be as well. Once we get through this initial bout of what's going on with tariffs, yes, I would look for good, solid, fundamental companies that pay a dividend, That's going to be more defensive in your portfolio. I think treasuries will perform well if we do get into slower economic growth environment, especially if we head towards recession. And then on the growth side of the portfolio, companies that have good, strong earnings but are trading at deep discounts. NVIDIA, surprisingly enough, trades at a price to earnings growth ratio of 1, just barely above 1. That's cheap for that type of a company. So look for those opportunities to grow in your portfolio as well.
There is the risk, though, if we get corporate earnings coming down and layoffs, etc., some kind of a credit-related, maybe not a crisis, but a crunch for the financial sector.
Yep. Absolutely. That, look, again, at the end of the day, this all goes back to how tariffs are going to impact corporations. I would avoid small caps, mid caps. 40% of the Russell 2000 trade or companies with non-profitability. They have a lot of debt as well. So if we get to an environment where earnings slow dramatically, growth rate of earnings slow dramatically, those companies stand the risk of potentially defaults on debt at some point. So that would be an area I'd be careful of, right? So when you get to a recessionary environment, that reduces earnings, that reduces revenue, and that's going to impact companies that are heavily levered. So if you're looking at companies to buy, particularly through this and somewhere to kind of navigate, be careful of the leverage they carry.
Russell 2000, by my numbers, is down 27% since late November. So it's been ugly there.
Yes. And again, that's kind of the environment that those companies are very susceptible to tariffs, slower economic growth. You're going to get a nice bounce in those, no doubt. There's going to be a lot of talk about how this big rebound rally and small caps, mid caps. I would be wary of those this year. I would focus on large caps until we get through this process, which could be another 3 to 6 months in total. So just be patient here and just navigate carefully.
During Maggie Thatcher's early years, when the British economy was contracting drastically, partly because of her policies, they had a refrain, the Tories: there is no alternative. And so far, the Trump administration seems to be using that playbook. Do you think they'll be forced to reverse course?
I don't think they're going to be forced to do anything. I think that they are on a path. I do think, though, we are seeing about 50 different countries come to the table to negotiate. And again, this market just needs some positive news here in the short term. So if we see countries come to the table to negotiate with Trump, get these tariffs reduced somewhat, that's going to help markets. The big one is China. Look, China did retaliatory tariffs to save face. President Xi could not come to the table and just negotiate with President Trump right off the bat. That would not be something honorable for him to do. He would lose face relative to his position in the country. He had to retaliate. This now puts him on an even trading field to come to Washington and negotiate something between us and China. If something happens there, that's the big one. That's the one that potentially changes the dynamic for the market.
Watch for China to come to the table. Lance, thank you very much indeed. Lance Roberts, Chief Investment Strategist at RIA Advisors. When we come back, we'll update you on the headlines and we'll check out some of the gainers and losers in Toronto.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Interactive Brokers pays up to 3.83% on instantly available US dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available US dollars in your brokerage account. The best informed investors choose Interactive Brokers.
I love that my daughter still needs me, but sometimes I can't help due to pain in my hands. So I use Nervive Nerve Relief.
Its dose of ALA helps relieve pain associated with peripheral neuropathy, with results starting in 14 days.
Now I can help again. Feel the difference with Nervive.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
U.S. President Donald Trump is threatening to impose an additional 50% tariff on China starting in just a couple of days, April 9th, if Beijing doesn't withdraw its 34% retaliatory tariffs by tomorrow. Trump also says all meetings with China would be terminated. That move comes as China accuses the U.S. of unilateralism, protectionism, and economic bullying with its import duties. China is calling on representatives of U.S. companies, including Tesla, to take concrete actions to resolve the levies. The province of Ontario is providing $11 billion in relief and support for workers and businesses affected by the U.S. tariffs. The Premier, Doug Ford, says as a first step, the province will defer select provincially administered taxes for 6 months, including the employer health tax. Ford also says the province will break down internal trade barriers by speeding up timelines and approvals for development, as well as diversifying trading partners. And there is a look at Barrick Gold today. The stock holding its own. The Toronto-based miner is proposing dropping the word gold from its name and changing its name to Barrick Mining Corporation. It says the change will reflect its changing production profile as it expands copper mining operations. The company is advancing work at a gigantic copper-gold project in Pakistan and is also expanding a copper project in Zambia. Another look at how the U.S. markets are trading right now. You can see they are under pressure once again. As of today, and this, of course, is constantly changing, the NASDAQ was down 20% or almost 20% so far this calendar year. So there's a bear market right there. The S&P 500 as of today down around 15.5% so far in 2025. And the TSX Composite down. There's a look at our market. TSX Composite down just over 8% so far this calendar year. And let's check out some of the sectors in Toronto. The healthcare index under pressure right now. Of course, the cannabis stocks are a pretty big part of that group. The energy stocks down. Well, we did see oil hitting $60 earlier. It's bounced a little bit off that, so it's no surprise that those stocks should be down. And we've also got the communications index, that one struggling. Let me just try and check out here what's hurting the communications index. I am showing BCE, the parent of this company, down about 4% today. I'm also showing Rogers Communications down almost 4%. And TELUS Corporation down 3%. So it looks as though investors are turning their backs on some of those big telecom stocks, including BCE. And there are some losers in Toronto. Birchcliff Energy down. Chartwell Retirement, I'm not sure why that one would be vulnerable. And Power Corporation. Of course, we have seen weakness in the big Canadian banks. Okay, let's have a quick look at oil once again. The U.S. benchmark we did see earlier today hitting $60 a barrel. And we're going to get perspective on energy after this.
looking to invest, Capital Direct's One Income Trust could be right for you.
Our track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards.
Find us online.
Call today.
CapitalDirect.ca.
You've got a peptide predicament, Ace. You overdid it on your poutine routine. Undo it with Pepto Caplets.
When you have nausea, heartburn, indigestion, upset stomach, diarrhea.
When you overdo it, undo it with Pepto-Bismol.
To prove these underwear don't ride up, they don't bunch, and they stay in place all day, we're putting them to the ultimate test. They didn't move. 200 kilometers an hour. They didn't bunch up. They didn't ride, and they stayed in place. Incredible.
Invest in high-quality dividend growth stocks. Get high monthly income and enhanced returns. Add these top-performing dividend funds to your portfolio. DGS and GDV on the TSX.
Whoa, how'd you get your teeth so white?
You gotta use the right toothpaste.
Dr. C?
Not all toothpaste whiten the same.
Crest 3D White removes 100% more stains for a noticeably whiter smile.
New personal best.
Crest.
A revolution is happening in sports nutrition, and investors are taking notice. Sizzle Brands is seizing a fast-growing market, delivering premium hydration and nutrition worldwide. With a retail presence growing by the minute, Sizzle is expanding rapidly, outpacing all new brands and market share growth. Now trading on the CBOE under the symbol CZZL. Sizzle Brands is quickly shaping the future of sports nutrition.
Closed captioning provided by Who Believes in Angels, the brand new album from Elton John and Brandi Carlile. Available now.
Oil trading barely above $60 right now. Saudi Arabia made some of the biggest cuts in years to its flagship oil price. We got more from Halima Croft, head of global commodity strategy at RBC Capital Markets.
Similar to what we saw basically in March of 2020. Remember when they could not reach an agreement at the OPEC meeting, and essentially OPEC said, if you can't reach an agreement with Russia, we're going to put barrels on the market. This time it's a more restrained action, but it is a warning to countries like Kazakhstan, to Iraq, to Russia to a certain degree, that if they do not get their compliance better, if they not come into conformity with what they have pledged to do, then starting next month, OPEC is going to be bringing forth more production. So we do have a meeting on May 5. That will be an important meeting. They will look at the production levels of these three countries to see if they've managed to bring their production down. And I think they can then either pause that decision, go forward with that decision, reverse the decision. So it is essentially a 30-day warning about what is to come if these countries don't reverse course on production. I think also some key members of OPEC, countries like Saudi Arabia, wanted to disabuse other producers that they were so wedded to higher prices that they were prepared to continuously prop up the market to allow other countries to continue to cheat. So again, a warning shot. People I've spoken to have said this was not done to please President Trump, but President Trump is obviously very happy with the price action. Treasury Secretary Bessent was on the Sunday talk shows in the United States talking about lower prices. The real question, I think, when it comes to the U.S. is what type of calls are U.S. shale producers now thinking about making to the White House, because this is not good for their overall economic outlook.
How do you see, what do you think has caused the recent plunge in crude oil prices? The common interpretation is that the market is worried about a global economic slowdown and a plunge in oil demand, all of that arising from the tariff assault from the White House.
100%. You asked me what is the underlying driver of this decline in prices. It is a concern that we are going to see a significant contraction in global demand. But again, you layer into that as well. At the moment where we have heightened demand fears, we are also facing the prospect of additional supply. And so, again, you can say the primary driver is a demand concern, but then the OPEC decision, I think, really exacerbated the price action. I think it caught a lot of market participants by surprise. And so now they're having to contemplate. Some are thinking, are we back to 2014? Are we back to 2020? I think it is a different OPEC strategy. Again, the barrels won't be coming till next month. And there will be a meeting on May 5 where they review the decision. But again, what you don't want if you want higher oil prices is a contraction in demand and then additional supply coming on at that precise moment.
You mentioned the U.S. shale producers a moment or so ago. Circle back there. What you say? The lower prices are not good for the U.S. shale producers, and that they may be making their feelings known to the White House.
I mean, we certainly saw this. We had a ringside seat for this in March 2020 when you had that OPEC meeting, end without an agreement, and then you had the Russia-Saudi price war in the middle of then what was the largest demand contraction in history due to the COVID pandemic. And you had U.S. shale producers, really being afraid that they would go out of business. And it's a little bit of a playbook of what we're seeing now. Initially, President Trump was out there saying in March 2020, this was great for the U.S. consumer. And then shale producers started calling the White House saying, President Trump, American energy dominance dies in a much lower price environment. And so, again, I've always been sort of interested in how this dynamic between U.S. producers and the White House would evolve, because President Trump on the campaign trail was talking a lot about wanting oil prices in the 50s. His advisors had talked about oil prices in the 50s. They now have, at least for today, oil prices now in the 50s. But we kept saying this was not a price that U.S. producers wanted. This was not something that was viable for the overall goal of American energy dominance. And so, again, I think it's going to be if this price action continues, if we go lower, I do think there'll be calls from the producers potentially to the White House to say, we may not be able to, you have your tariff policy, but there's also an OPEC policy. Can you try to find us some relief on these fronts?
One thing politicians in any country love to see are lower gasoline prices. Are we seeing those now, or will we see them very shortly in the U.S.?
I mean, it has a bit of a lag, but again, certainly if we stay in these ranges, yes, U.S. consumers will be paying, lower gasoline prices. If we move into the low to mid 50s, yeah, you'll be talking retail gasoline prices, in the $2 range, $2.50 range. But again, that's, there are the other worrying signs about the global economy as well. So consumers will have to weigh that up. But again, a stated goal of this, administration has been the prolific growth of U.S. shale. They've really talked about wanting American energy dominance. And again, the current price outlook is not compatible with American energy dominance. And so something potentially has to give. You can't have everything everywhere all at once.
Halima Croft, Head of Global Commodity Strategy at RBC Capital Markets. Coming out, hot picks, and we zeroed in on some consumer names, including Keurig Dr. Pepper. We'll be right back.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Virgin Plus is obviously the choice for affordable phone plans with lots of data. So is the selling power of a certified actor doctor really necessary? Does it help if 10 out of 10 pretend doctors agree it's easy on the wallet? Or that you get discounts on food, fashion, and entertainment? Your glasses aren't real. Do we need all this doctory stuff to convince you? We don't. Because when you're choosing an affordable phone plan, the obvious choice is Virgin Plus. Obviously.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
You've got a peptide predicament, Ace. You overdid it on your poutine routine. Undo it with Pepto Caplets.
When you have nausea, heartburn, indigestion, upset stomach, diarrhea.
When you overdo it, undo it with Pepto-Bismol.
How's your cash performing? Compare the 9-Point Cash Management Fund, ranked in the first decile in the Morningstar Canadian Money Market category for 1, 3, 5, and 10-year performance. 9-Point, your advantage.
Earlier in Hot Picks, we covered the consumer discretionary sector. Our guest was Filippo Falorni, Director of U.S. Beverages and Household Products at Citi Research. We began the discussion with the macro backdrop and how it's likely to affect consumers.
Macro backdrop is clearly deteriorating in the U.S. Many companies are starting to talk about consumers pulling back on their consumption levels. Ultimately, look, my space is a little bit more immune from some of these macro backdrop. I cover categories that really are daily use categories, especially in the household product side. So these names have been viewed pretty defensive throughout prior economic downturns. And you saw in the early phase of the market sell-off that these names held up a lot better, especially on Thursday. Last Friday, you started to see all the consumer group, including staples, really underperform as well, as the market is kind of like extending those declines. But look, ultimately, with the macro slowdown, a lot of my companies are going to be relatively more immune compared to the rest of the economy.
Okay, let's jump into your picks. Your top pick is Keurig Dr. Pepper, ticker symbol KDP. Why is that your number one pick?
Yeah, so we moved it recently to our top overall pick because we think the fundamentals of these companies are really underappreciated in the current valuation. So they have essentially two businesses, a coffee business and a refreshment beverage business. The refreshment beverage is more the beverage side, so the Dr. Pepper, Canada Dry, and some smaller brands that they're selling almost entirely in the U.S., like 90% U.S. exposure. So much less at risk from tariffs and from international trade wars, and that business is growing significantly in the mid to high single-digit range. There's been an area of strong growth for the company. They continue to gain share within the U.S. beverage business from Coke and Pepsi, and they continue to expand their distribution. So that part of the business has been very solid. The coffee side has been a little bit softer over the last couple of years, but ultimately the company has provided pretty conservative guidance within coffee, and coffee is one of those areas where, because of the cost inflation moving up, there's opportunity for KDP to take pricing. They've assumed pretty significant volume elasticity for pricing, but ultimately, if they're actually able to take price and consumer doesn't change their consumption behavior significantly in coffee, they could actually have upside both on top and bottom line.
Okay, number two is Monster, ticker symbol MNST in the U.S. market. Why do you like Monster?
Monster plays in the energy drink category. That's almost 95% of their sales exposure. And that category has been particularly solid in the U.S. We've seen some softness last year when you started to see some concern among low-income consumer on the category, but now it's started really to reaccelerate significantly in the U.S. A lot of it is also the fact that this category historically for the past decade was didn't really have a lot of healthier options. And now now there's been all these new brand introduction. They have zero sugars, they have better for you energy, and they've really expanded the consumer base of this category. And then Monster, being the number 2 player globally after Red Bull, have still a solid opportunity from a market share standpoint in the US, but even more in the international market. If you look at the US market share, it's about 32% compared to Red Bull at 33, 34. So pretty much neck to neck with Red Bull in the US market. Internationally, Red Bull has over a 35% market share versus Monster only a 10% share. So it's a healthy category, and they have significant market share opportunities that makes it to us a very compelling story.
Okay, and your third pick today on Top Picks is perhaps the best known name in the beverage industry, Coca-Cola.
Absolutely, yeah. So look, Coca-Cola has been our topic of over the prior year. We moved it a little bit lower, but it remains our favorite multinational within the group. So multinational clearly have a little bit more risk from this global trade war. From a tariff standpoint, there's not a lot of direct implication for Coca-Cola, given they produce almost entirely locally in every country. But there is some risk from anti-American brand sentiment around the world that we've seen. I would say Coca-Cola remains our favorite of all the multinationals because their actual fundamentals remain very solid. They have about 40% of sales in emerging markets, which they can actually drive volume and price growth. And even in the US market, they've been able to diversify their portfolio away from carbonated soft drinks, which is their main product that everyone knows, into better for you categories. More recently, they've acquired Fairlife, which is essentially a dairy protein-based drink option, including Core Power, which is their core SKU. And they've really been able to grow that part of the business a lot faster than the core carbonated soft drink side of the portfolio. So even the US market, they're actually able to grow volume, which has been pretty remarkable. And then internationally, they do have a lot of opportunities in emerging markets.
Filippo Falorni, Director of US Beverages and Household Products at Citi. Coming up on Market Call in about 3 minutes, we'll be joined by Lawrence Steinberg, President of Lawrence Steinberg Wealth Management. He'll be taking your questions on global stocks. Thanks very much indeed for joining us. Have a good afternoon.
Invest like a champion with Hamilton Champions ETFs CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
The Harvest Diversified Monthly Income ETF. Consistent monthly income. The Harvest Diversified Monthly Income ETF. HDIF on the TSX.
These dishes just aren't getting clean.
The problem isn't your machine. It's likely your detergent.
Really?
Really. I recommend switching to Cascade Platinum Plus. These new pods are packed with more soaking, scrubbing, and rinsing action. Plus, the grease-fighting power of Dawn, easily removing up to 100% of tough stuck-on foods.
That's impressive.
And it works so well, it even keeps your filter clean. Cascade. No pre-wash, no rewash, or your money back.
For the 4th consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Whoa, how'd you get your teeth so white?
You gotta use the right toothpaste. Dr. C?
Not all toothpaste whiten the same.
Crest 3D White removes 100% more stains for a noticeably whiter smile.
New personal best.
Crest.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian preferred share ETF, Mulvihill.
Another night in with your best friend, maybe watching the game or just enjoying some downtime. But if your night in involves alcohol or drugs, please remember that impaired driving is both dangerous and illegal. If you're thinking about heading out, be sure to book a ride, call a cab, or take public transit. And if you decide to stay in after all, Well, maybe it's because best friends don't let best friends drink and drive. Thanks for helping to keep our roads safe. Arrive alive. Drive sober.
Hi there. Welcome to Market Call today on BNN Bloomberg. I'm Paul Bagnall. Thank you for watching. Lauren Steinberg is our guest today. He, of course, is president of Lauren Steinberg Wealth Management. He'll take your questions on global stocks. So get ready to give us a call. In fact, pick up your phone and call us right now. Our number is 1-855-326-6266. The email address is marketcall@bnnbloomberg.ca. We'll get to your questions in the second segment of our show. This is the first segment, and we'll welcome Lauren and get his take on some pretty volatile markets. Great to have you here, Lauren, as always.
Great to be here, especially on an interesting day like today.
Okay, you have managed client money through numerous market downturns. Here we are again. What is similar and what is perhaps unique about this time around?
I find there's always something a little bit unique because no two situations are exactly the same, Paul. The last time we went through a really shocker was, of course, during COVID in March of 2020. The market fell over 30% at a moment in time. The message we sent to clients then was, every time we look back on times like these, we always say, darn, I should have been buying those great companies when they're on sale. That is eternally the message. Warren Buffett, buy when there's blood on the streets.
Right.
Completely calm. If you buy great quality, and this is the moment to buy that great quality because it is cheap once again, you will be well served when you look back at your portfolio 5 years from now.
How should investors then think about buying that quality? There's that expression, nobody wants to buy a falling knife. Investors are nervous about buying something today and seeing it down 10% over the next week or so. How do they come to grips with that tension?
Exactly, and I find that all or none is probably the wrong thing to do because it just leads to paralysis. So if an investor had, let us say, $50,000 to spend and doesn't know when to get in, my comment would be just be disciplined, take $10,000 per month or whatever makes you comfortable, but start buying today because if you wait until calmness returns and things improve, you'll have missed the first 25% move.
The investors, you say, should control what they can control. What are some of those things they can control in a very remarkable market environment?
Sure. It's for us, it's easy. Buy the world's best companies. Anything from Canadian bank stocks and a whole bunch of other great technology companies. They've all been hammered. This is your opportunity. You can control the quality. Your dividend yields are higher because you're, of course, paying less for these stocks. And great management teams will figure out how to navigate this situation.
Reducing your equity exposure at times like this is a big mistake.
It's always a mistake. You're selling when the world is panicking and you're forgetting Warren Buffett's words. Buy when people are panicked and start selling when everything is rosy. And these are the same great companies. They were the same great companies 10 years from now, 10 years before. They'll be the same great companies 10 years from now. It's you can buy them when they're on sale. Why would you not? You should be loving these times.
That's Lauren Steinberg and his direct advice to investors. This is a time to buy high-quality companies. At the end of this show, of course, he'll give us his 3 top picks at this point in the market. We'll be back right after this for Lauren Steinberg taking your questions on global stocks. There's the contact information once again, 1-855-326-6266 or marketcall@bnnbloomberg.ca.
Zero. No one wants to be a zero, right? You give them 2 choices in life, be a hero or be a zero. I say don't choose. 0 is hero. It's the most powerful number in the world. There's 6 of them in every million. Questrade wants you to have more zeros. So they've changed the game, again, with zero commission trades. Now go get your zeros.
Bleeding gums are a sign of bacterial infection. We always recommend Crest Gum toothpaste to our patients. Its unique antibacterial fluoride works below the gum line to reduce bleeding to strengthen gums. Thanks, Crest.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
Welcome back. Let's get the questions going to Lauren Steinberg. First comes a question from Roman, our viewer in London, Ontario. Do you have any thoughts on Propel Holdings? I'm holding now, but should I buy more?
So Propel, for those who don't know, is a very fast-growing Canadian fintech lender, making very, very small loans to people who assumedly can't borrow money from banks. The company's been spectacular. The stock has been hammered here. I think probably the fear is, what if we do get a recession? How many of these lenders will not be able to pay back their loans? I mean, risky from that perspective. With other things on sale, we would take a pass on this. But I have to say, management's done a spectacular job building this company very quickly.
Okay. Thanks, Roman. Let's go to Michael. He's our first caller of the show, and he's in Vancouver. Michael, thank you for calling. What's your question?
Thank you so much, Paul. Thank you, Lauren, for taking my call. My question, Lauren, is on Philips. Philips, about 4 years ago, was over $50. Now it's languishing in the low 20s. It's mostly been a range from about 25 to 30 over the last couple of years. I just wonder what your thoughts are. Do you hold it? Do you like it? Or should I be looking elsewhere? I'll hang up, lads. Have yourselves a great day, and thanks so much for taking my call.
Thanks, Michael.
Thank you very much, Michael. So Philips makes medical equipment. If you're unlucky enough to walk into a hospital room, you'll see a bunch of Philips equipment there. They got themselves in trouble a few years ago with a sleep apnea machine and had to make a very large settlement to the FDA. They've been struggling since then. Frankly, they're in this market, Paul, as I said, with everything, most things down. There are, for us, just better places to look, and so we would look elsewhere.
Okay. Thanks, Michael, for that call. Let's stick with the phones. Steve is on the line from Sarnia, Ontario. Steve, thanks for your call.
Hi there. Thank you for taking my call, Lauren. My question is on the TD Bank. Like everything, everything's down today. I think it's around $78 and change. Would you step in to the TD Bank right now? It pays a nice dividend. It was moving up the last few weeks, and then the last 3 days it's tumbled like everything else. So would you be stepping in at this level? Thank you very much.
Thank you, Paul. Yes, we own TD Bank here, and TD Bank's dividend yield is over 5%. The Canadian banks are cheap. With these great dividend yields and low interest rates, why, if not now, when?
Okay, that was Steve in Sarnia, and now we're going to talk to Paul in Toronto. Paul, thank you very much for your call. What is your question to Lauren Steinberg?
Yes. I just like to know about Tesla. Like, it has come down from 280, so it is around 230. So is it going down more, and so what is the good entry point to buy Tesla? And thank you, sir, and have a good day.
Thank you very much for your call. So we do not own Tesla, and our thesis has been somewhat that, you know, over time, every single major car company will have a slew of electric vehicles, and Tesla would not be the only game in town. So, you know, for us, we would look elsewhere. You know, for sure, the brand is probably damaged a bit by everything that's been going on. There are better places to go with less risk, and it's still not a cheap stock, let me say.
I was going to ask you about the brand issue. What you're referring to, I'm sure, is Elon Musk and his very prominent and contentious role in U.S. policy these days. How badly damaged do you think the brand is?
I don't want to make long-term comments, but if he continues along this path, because don't forget, it's not just in the U.S. European sales of Teslas are down sharply. A very strong reaction against them. It seems that just his presence there at the present time is just making this a very difficult story. And then, of course, in China, you have BYD and very cheap electric vehicles pressuring on that side. And a lot of Americans, you know, who voted for Trump do not want to buy electric vehicles in the first place. So you're kind of losing those that did. And, you know, are you going to be able to capture enough on the other side? So sales were down. Better places to be.
Okay. Thanks for that call. Let's go to Otis back in Vancouver. Otis, thank you for your call.
Oh, good afternoon. Your thoughts, Lauren, on Novo Nordisk. Even before the market pullback, it's been having a pretty difficult time here, kind of short-term, long-term. Often the comparison is to Eli Lilly, although Lilly has a little bit more of a diverse lineup, I guess. Your thoughts on, well, maybe both, but would this be an entry point for Novo?
Thank you, Otis. We would hold off. I mean, Novo Nordisk, of course, had the massive run-up with Ozempic, and you know, now there's a whole slew of competitors coming into that category, and every time there's a new release coming out that this drug, you know, leads to 3% more weight loss than that drug, the stock falls again. We prefer a more diversified pharma company than one that is so heavily weighted in this one area.
Okay, that is the first batch of questions in to Lawrence Steinberg. He's president at Lawrence Steinberg Wealth Management. Global stocks is the focus today, and we'll continue taking your questions to Lauren right after this.
Don't you know what he did?
We all strive for peace of mind, whether in life or our investments. But that's not easy with today's market complexity. For over 2 decades, Goodread has helped Canadians from coast to coast achieve their financial goals through both good times and bad. Working with our portfolio managers, you can navigate tomorrow's financial uncertainty with confidence. It's time. Take control of your wealth. I'm Gordon Reid. Invest with confidence. Invest with peace of mind. To learn more, visit goodread.com.
Bleeding gums are a sign of bacterial infection. We always recommend Crest Gum toothpaste to our patients. Its unique antibacterial fluoride works below the gum line to reduce bleeding to strengthen gums. Thanks, Crest.
Harvest Healthcare Leaders Enhanced Income ETF. Maximize your monthly cash flow from Canada's leading healthcare ETF. More income from healthcare leaders. Harvest ETFs. Income happens here.
Closed captioning of this BNN Bloomberg program is brought to you in part by Scotia iTrade. You have what it takes to start direct investing. We have the rest. Scotia iTrade.
Okay, let's go back to the phones. Dominic is in Montreal. Dominic, thank you for calling. What's your question to Lauren Steinberg?
Hello, Paul. Thank you for taking my call. Lauren, I've got a half weight on Fairfax Financial Holdings and Berkshire Hathaway, the B shares. I'm looking for some fundamental analysis from you for the Fairfax Financial Holdings, and if you had a choice between one or the other, would you increase your weighting on Fairfax or would you go with Berkshire? Thank you.
Dominic, thank you very much. So we actually own Fairfax in our Canadian dividend strategy, and we own Berkshire in our global strategy. So why would I have to make a choice? I would happily own both. Both of these can be looked at, you know, insurance-driven companies that are also partly, you know, holding companies. They're just diversified sets of businesses. Prem Watsa, who runs Fairfax, has, you know, bought a bunch of restaurant chains and a whole bunch of other things. Berkshire, of course, widely diversified. So on a breakup value, not that these will ever be broken up, we have a net asset value that is quite significantly higher than the current share price, and that for us makes these a buy. Plus, I'd say both would fall into the lower risk category of companies.
Okay. Let's go back to the email inbox. Mehul, excuse me, Mehul is our email correspondent. I hope I'm pronouncing that name correctly. Mehul writes as follows: Hi, Lauren. What are your thoughts on Cenovus Energy? This is a very beaten down energy stock.
It is a very beaten down energy stock, Paul, partly because the downstream operations, the upgraders and refining and marketing have been extremely weak. One of the things we look at when we look at stocks like this that people partly buy for dividends is what's been the dividend history. The dividend history here is this company has cut its dividend in the past. So we would look elsewhere because, you know, these are not stable dividend payers, but the dividend might look high because the stock price is low. You'd be a little careful.
What's your view of this sector right now with crude oil prices collapsing?
So you have to buy this sector when it looks awful and prices are low. Otherwise, you're buying it at an all-time high. We have minimal exposure, but we do have one stock in the sector. That is the opposite of Cenovus because they've never cut their dividend and been a steady dividend increaser. But when things are weak, you really appreciate having a low-cost producer.
Okay, let's go back to the phones. Elliot is in Hamilton, and he's on the line now. Elliot, thank you for your call.
Good afternoon, gentlemen. Live Nation, the, I guess, undisputed king of live entertainment, against the backdrop of perhaps a recession on the horizon, how would you rate its prospects going forward? And would you start a position today? Thank you.
We don't own Live Nation. It's not cheap enough for us, but holy cow, this is a monopoly business. So, you know, concert buyers, you know, ticket buyers have no choice. Love the business model. May not love it if I were a purchaser of concert tickets. But if we get a recession, this stock has a long way to fall. So, you know, and I'm not saying we will get a recession, but it's just not cheap enough for us.
I have provided Ticketmaster with a lot of fee money over the years. Thank you, Elliot from Hamilton. Let's go to Brantford, Ontario. Robert is on the line. Hi, Robert.
Good afternoon. I'd like to get your thoughts on the real estate markets, not only globally, but in Canada, the U.S. I think there's tremendous opportunity, anybody who wants to buy real estate right now, because it's like holding a beach ball underwater. When you let that go, it's going to soar. And just a small percentage move in real estate is going to be huge amounts in dollars. So what do you think on the perspective of buying into real estate like now, like homes and apartment buildings? Thank you.
Listen, there's a shortage of housing in Canada for sure. Although in Toronto, for example, there's so many condos coming on stream that we're seeing condo prices soften and even rents soften for the first time. The only REIT that we own is Canadian Apartment Real Estate Investment Trust. A phenomenal, very long-term track record, own great buildings, know how to run them and increase rents over time. And so that would be our pick in the sector.
Here comes that REIT, Cap REIT. What sectors of the real estate market or the REIT market would you avoid?
Well, office buildings are going through this evolution. We don't know how it's going to end. Certainly, malls are going through a worse evolution, and so we're seeing malls getting cut in half, replaced with, you know, condo buildings and apartments. So the steadiest area has always been apartments, and there is a shortage of housing in Canada, Paul. So, you know, that's something that we are attracted to, rather than trying to make a bet on, you know, what areas will office buildings, you know, are they cheap enough?
Okay. Thanks for that call. Let's go to Walter in Kingston, Ontario. Hi, Walter, and thank you for calling.
Hi. It's on CNQ. Just wondering your thoughts, and would you be a buyer right now? Thank you.
Thank you very much, Walter. So yes, we would be a buyer here. It's the only oil stock we own. We like it because they've never cut their dividends. So they've been able to go through bad times and good times and keep on plowing through. They're also a low-cost producer. CNQ is profitable at $40 oil. So there's a long way for oil prices to fall for CNQ not to make money. And they're a great free cash flow generator, showing a lot of discipline with their capital expenditures. And again, this is conservative, great, wonderful business.
Thanks, Walter, for your question. We will take a break, and when we come back, it'll be time to look at Lorne Steinberg's past picks.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF, Mulvihill.
Stability is one of the things that makes Capital Direct One Income Trust unique and reliable.
If you're looking to invest, then Capital Direct could be right for you.
Our proven track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards, with Class F hitting 10% annualized return and Class A and C kicking out over 9%.
For consistent returns on your assets, find us online.
Or give us a call.
CapitalDirect.ca.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
Thousands of Canadian businesses don't have access to the support they need. BDC is committed to opening the way. Breaking down doors for entrepreneurs. We're on it. BDC, financing, advising, know-how.
Welcome back. It's time now for Past Picks. We will go back to February the 1st of 2024, so more than a year ago, and we'll check in on some past picks of Lawrence Steinberg. One on that day was Compass Group PLC. This one trades in London, as you can see by those pound sterling symbols. Total return over that period of time, 14%. Lauren?
We still own Compass Group. No one knows them, but they're the largest supplier to food courts, hospitals. Half their business is in the U.S., and it's a very fragmented industry. They're by far the largest, and they just keep on making these little niche acquisitions and cutting costs and generating pretty solid profit growth.
Okay, Compass Group, number one, 14% over the past 14 or 15 months or so. Nike is the next one. Recommended at $101.76, now trading at $53, has probably fared very poorly during this period of tariff panic in the markets. Total return here, negative 44%. Lauren?
Sure. Nike, first, the good part about Nike is they're the largest in the sportswear and sports athletic wear, shoes. And listen, they have no debt, so tons of firepower, the industry leader. They made some horrendous mistakes under their prior CEO in terms of distribution. The new person is fixing it. It is a slow fix, let me say. And we're looking really for earnings improvement to start in 2026. But the worst is over. And I mean, this is the global leader.
Those were inventory mistakes. Is that what you're referring to?
Not just inventory. They also changed their distribution. They wanted people to buy more online. And so they damaged relationships with their retailers, like Foot Locker, who are core to this business. And that caused some damage, which is taking a while to unwind.
What about their Chinese exposure? Are they going to be pressured to perhaps bring some manufacturing facilities back to the U.S.?
I have to say, when it comes to things like footwear, clothing, it's impossible because it'll be way too expensive to make it in the U.S. And I don't see any of that happening for these types of companies.
Okay. Starbucks was number 3 on that day, SBUX on the NASDAQ. Here are the numbers there. Recommended at 93.37, now trading at about 76.66, negative return 12%.
Listen, Starbucks is a core holding for us, I have to say. They are 6 months into their new CEO. The turnaround is already well underway. We're looking for earnings to stabilize this year and go up 30 to 40% in 2026. But this is a very fast turnaround, you know, best in the business, and no real competitors at this level. Starbucks is also makes a lot of money on their float because people put money on their Starbucks app. There's over $2 billion on that app, and you know, people like me, you know, give them money to use for free, and they buy me a free coffee on my birthday. It's a great business.
That is Lawrence Steinberg, and those are his top picks. 1 in positive territory, 2 in negative territory. We'll be back with Lauren after this, president of Lawrence Steinberg Wealth Management. He'll resume taking your questions on global stocks, so give us a call. Here's the contact information. We look forward to hearing from you.
what kind of teeth you gotta brush. Oral-B Electric cleans better with one simple touch. Oral-B's dentist-inspired round brush head hugs them, cleans them, and gets in between them for 100% cleaner teeth. Your perfect clean routine starts with Oral-B.
It's usually a good sign when a company is buying its own stock in the open market, especially in small to medium-sized growth picks. Companies who want to reduce the number of shares in the market by buying them back, well, this is usually implying that the company might be expecting improved sales or higher earnings in the future. Sometimes companies buy back shares because they feel that their stock is undervalued, making us all think it's a good time to buy. After all, why would a company buy back its stock if it's anticipating a decline in value? But while this may be true, there are critics that see buybacks as not a good thing. They think the company is trying to sweeten up their stock to new investors. And depending on when this happens, it could be that they're trying to conceal a stock-based compensation payout to top-tier employees. I'm Christina Bitson, and this is your Investor Tip today.
Innovation is changing the investing landscape. Where will it take you? Global X is one of Canada's largest ETF providers, shaping the future of investing with global reach and local expertise. Innovation meets investing. Global X.
I cannot believe this is real life.
My logical brain is done down.
Is everybody ready to race? We're on the amazing race!
All new Amazing Race, Wednesday, 9:37 Mountain on CTV.
Okay, let's get back to the phones and, more importantly, back to the questions to Lauren Steinberg on global stocks. Tushar is in Mississauga. Tushar, thank you very much for calling. What's your question? And I hope I'm pronouncing your name correctly. What's your question to Lauren Steinberg?
Good afternoon, gentlemen. I had a question on a couple of technology stocks. The first one would be the Canadian software company OpenText. I wanted to check the medium to long-term view on that. And the second one, if possible, would be for the German technology company SAP.
Okay.
So I'll address OpenText first. Listen, OpenText the stock has struggled. This was a growth by acquisition story for a number of years. Earnings flattened out, and the stock has done relatively poorly. We actually like OpenText. It is a very, very cheap technology stock in some good niches. So, for us, we would be a buyer here. And so if you're a patient investor, there's lots of upside in OpenText. They've really made a decision to stop the acquisitions and clean things up and hold on to what makes sense, but there's a lot of earnings power in here.
I was going to make the point that similar to Nike, perhaps in broad strokes, this is a company that's made some mistakes in the past, correct? With excessive acquisitions and maybe not the greatest acquisitions?
Exactly. Right. I think it was they had so much cash flow, they were buying things not necessarily at the great price and not necessarily a good enough fit for the company. And management is very, very focused on streamlining what they have. And there's not a lot to fix there. It's more a case of if they should sell something, sell it and focus on what's making money.
Okay, SAP, do you have any thoughts on SAP?
The only thoughts I have is, listen, SAP has been it's a core part of many companies' business, the guts of a company. That being said, in a market like this where tech stocks have fallen off, we think there's so many better opportunities we'd look elsewhere.
Okay. I can tell you, Tushar, that analysts, Wall Street analysts are positive on SAP. 15 say buy, 3 say hold. Thanks, Tushar, for your call. Let's go to Vancouver once again. Debbie's on the line. Hi, Debbie.
Hi, good morning. I would just like your thoughts, please, on Topaz. TPZ. I'm thinking of purchasing it, and I will hang up and listen. Thank you very much.
That's not the stock we're expecting. I'm not sure you've got a lot to say on Topaz, do you?
I can't make a comment on Topaz, let me say.
Okay.
We don't own it, and I haven't looked at it in a long time.
Okay. Thanks, Debbie. We were expecting TC Energy there, so we'll just move on. Robert is in St. Catharines, and he's on the line right now. Robert, thanks a lot for your call.
Hi, no, thanks for the time. I've been looking at
auto stocks for the last little bit, and like the BYD Company Limited, I find is like a very big like electronic car manufacturer that outside of North America is doing very well. I was just thinking of your thoughts on that. It's down like 8% today, but it's had like higher price points. Yeah, just to know your input.
Okay, BYD, not to be confused with Boyd Group, which has the ticker symbol BYD. This one is it manufactures automotive products and is based in China. Go ahead.
Sure. So first of all, I mean, we would avoid Chinese stocks, and only because if they don't have the rule of law there, the Chinese government has gotten involved in a whole bunch of different things and upended things like the large technology companies and the like. So better places to look. I have to say, as a car company, BYD is changing the auto industry. They've come with a very cheap electric car. It's taken China by storm. It'll compete in Europe. I don't know that it'll ever be sold in North America anytime soon. But really it's buyer beware when looking at stocks in China.
Okay, thanks for your call on BYD. Let's go to Bill in Bowmanville, Ontario. Bill, thank you for your call.
Thank you for taking my call. Could I have Lauren's opinion on Apple? Is it a buy now? I'd like to hear his thoughts. Thank you.
Thank you.
Thank you, Bill. We don't own Apple at the present time. I have to say, and it has been too expensive for us, but with the drop in the stock price, we're actually looking at Apple. Nothing's really changed with Apple. The one issue with Apple is China's reaction to the tariffs in the U.S. and are they going to put pressure on people they've already put pressure on the government employees not to buy Apple phones, and this is the one negative I see with Apple as opposed to consumer sentiment, which will be a temporary situation.
Okay, Apple, 34 analysts say buy, 18 say hold, so Wall Street is somewhat split on this stock. Let's go to Sal in Toronto. Sal, thank you for your call.
Hi there, thank you. My question is on Louis Vuitton, LVMH. I was wondering, I know that the luxury sector is taking a big hit due to tariffs. So I was wondering if you think this is a good time to jump in or to wait until things clear up a little bit more on the tariff picture. Thanks so much.
Spectacular company, and it's not just Louis Vuitton, of course. It's champagne and a whole bunch of other premium products. The sector had already taken a hit because of China. So China's slowdown caused these stocks to drop substantially already. For us, we're holding off because if we do get a recession, then this will get really cheap. We've seen that before. This is quite a cyclical type of company, so we would hold off, but it's certainly best in class.
Okay, thanks for the question on Louis Vuitton, one of the flagships in the luxury sector. Let's go to an email from our email inbox. Kevin has written as follows: I'm interested to know what you think of Linamar, the Canadian auto parts maker and a stock that has suffered mightily through all this angst about tariffs in the United States.
So we've preferred Magna, which of course is also a major auto parts, much larger manufacturer. But when I looked at the chart, Paul, over the last 10 years, these two companies basically put the chart on top of each other. It looks exactly the same. So in some ways, I would say pick your poison. We prefer Magna because it's far more integrated into the major auto companies. They can't live without Magna at all. And that's the reason. But the stock price has performed exactly the same.
And these stocks look to be very tariff related. Is this the right time to buy when sentiment is the worst? Is it time to avoid them? What do you think?
I would say, again, in a diversified portfolio, you want to own things that are companies that are profitable, that will stay profitable. Magna makes money every year, sometimes less or sometimes more. Of course, you'd rather buy them when things look awful.
Okay, that is Lauren's take on Linamar. We'll be back with Lauren Steinberg right after this. He's president at Lauren Steinberg Wealth Management. He'll continue taking your questions for one more block on global stocks after this.
Every April, something magical happens. This isn't just golf, it's the Masters on TSN. Presented by Mercedes-Benz and the all-new electric G-Class.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
After spending years accumulating your wealth, you may soon be entering a new financial phase called decumulation, when you want to draw down on your assets in the best way possible. So here are a few factors to consider. First, know your goals. What do you want to do in retirement? Travel, leave a financial gift, or help a charitable organization? Second, the timing and order in which you plan to draw down your income matters. For example, the amount of tax you pay and OAS you receive can be impacted by both when and how much you withdraw from your RIF. Third, do you know what your expenses are? Housing costs, healthcare needs, maybe financial help for your children. And fourth, longevity. How long do you expect to be active based on your health and family history? Finally, consider working with an advisor who can help build a strategy that works for you.
Closed captioning of this BNN Bloomberg program is brought to you by RBC Global Asset Management. Let our global reach take you further.
Welcome back. Let's get one more round of questions into Lauren Steinberg. It's been a great show so far. Lots of questions, lots of great insight from Lauren. Gulam is our next caller. Gulam's in Toronto. Gulam, thanks for your call.
Hi, good afternoon to you both. My question is on, I own some Bell Canada, and I was thinking of, as you know, the price has really fallen. I was thinking of putting some more money into Would you buy more Bell Canada at the moment to average my costs down, or do you like TELUS? I'd appreciate your opinion. Thank you.
Thank you very much, Gulam. In fact, we like both, and I have to say, even if you look at the price activity over the last few days, the telcos have actually held up. One of those sectors is actually holding up rather well in this market. For us, this sector has bottomed out. Anticipate with your BCE a dividend cut. For us, if the dividend's cut 50%, that will be fine. That will free up money to reduce debt and also possibly to buy back some stock over time. But BCE is still throwing off significant free cash flow. It's just a question of the allocation. TELUS has done better growth. They've invested in other things as well, which has diversified the business somewhat, so they've held up better. Also, these two companies, Paul, you know, even with BC cutting their dividend in half, even if TELUS made a 25% cut, high dividend yields, tremendous free cash flow, lots of opportunity going forward to buy back stock. The worst is over for the Canadian telco sector, and a phenomenal opportunity. You're picking up great yield as well.
There's increasing talk about a BCE dividend cut. You don't think the share price is the bottom is going to fall out of the share price again if that gets announced? Do you?
I think if anything, it will be a positive. Right. I have to say the investment community wants them to cut the dividend, wants them to reduce debt and take a better capital allocation strategy. As a shareholder, we would prefer to see our dividend cut by 50% and the company embark on a different road. Okay, and what do you think of the acquisition that the company made in the States? Somewhat contentious, not universally popular. That's right. They're making a big bet at the price they paid. They took money from, you know, selling the assets they sold to Rogers. So, I mean, Maple Leaf Sports Entertainment, that they weren't earning anything significant on that. So they'll earn something on this. Time will tell if they overpaid or not. But, you know, it's just honestly too early to say. Hopefully management and the board looked at things carefully and knows what they're doing. Okay, that acquisition is Ziply. It's in the Pacific Northwest of the U.S., and it is a fiber internet provider. BCE is the parent of this television channel through its Bell Media division. Let's go to Ash. Ash is in Stratford, Ontario. It's an email from Ash. Usually I buy 1 to 2 year treasuries, Canada or U.S., for safety and hold them until maturity. Are there any scenarios where selling these bonds early would be recommended? Well, my comment is if you want to have a fixed income asset allocation and that's the reason you bought them, then you should hold them because that's who you are. If you have them and say, would there be a better opportunity, if the stock market really takes a massive beating further from here, that could be a source of cash to deploy into equities that will give you much higher yields, even if your share prices, wallow around in the wilderness for a while.
Okay, thanks for the question, Ash. Let's go to Gil. Back to the phones. Gil is in Brampton. Hi, Gil.
Hi, good morning, gentlemen. My call is with regards to NVIDIA. I have a small position, and I'm wondering if this would be a good time to add on to average out my price. And if I can have your opinion, I'll just hang up and listen to your comments. Thank you.
Gil, thank you very much for the call. So our pick in the sector is actually Taiwan Semiconductor. Taiwan Semiconductor makes the chips for NVIDIA and a whole slew of other businesses as well. So it's far more broadly diversified. It's also selling at a much cheaper valuation. Yes, NVIDIA has fallen, but it is not a cheap stock, and factored into the share price is a huge growth expectation. So our recommendation is, just because a high flyer, the shares have fallen, doesn't necessarily make it cheap. Whereas Taiwan Semi, we look at a much more clearer growth path going forward over the next few years, and because a lot of their capacity will be contracted by companies like NVIDIA.
Okay, thanks for that question. Let's go to Ray in Pickering, Ontario. Ray, thank you for your call.
Yeah, hi guys. Good morning, and I was just wondering, with all the volatility in the last 3 days, if this would be a good time to get in on a best-in-class Canadian bank. And I would like to know if that might be, in our guest's opinion, Royal Bank. If I'll hang up and listen to your answer. Thank you.
Thank you.
Thank you very much, Ray. So, we like the big 5 Canadian banks. They're all a little bit different, but they're in some ways very much the same because they all have wealth management, retail, and commercial banking in Canada. So listen, Royal Bank is among the cream of the crop, incredibly well overcapitalized, in fact. Rock solid dividend yield, probably around 4% at this share price, Paul. There's nothing not to like about Royal Bank, let me say. I mean, this is just... It's the oligopoly of Canadian banks, and so here we are, take your pick. But Royal is the best performer, largest in wealth management, which is certainly a big growth area, very disciplined over the years, steady dividend growth. Definitely a buy here.
Okay, and Bay Street agrees. Ray, 16 analysts say buy, 2 say hold, only 1 says sell. Let's move on to Sandir in Woodbridge, Ontario. Sandir, thank you for your call.
Thank you for taking my call. I need your opinion on Shopify. Where do you see the stock in the next 1 to 2 years?
Thank you very much, Santir. So we are not ready to buy Shopify. Again, this is a stock that has really suffered a lot over the last little while, but it remains not a cheap stock. There's a lot of growth still built into the share price. So, even at the current share price, this is a relatively expensive stock, and I mean, we would look elsewhere. We would prefer an Amazon, quite frankly.
What about Celestica? Another, probably the other most prominent tech stock has also been hammered, I think worse so than Shopify recently.
Sure, and Celestica, we're actually looking at Celestica, Paul. So Celestica is an IT outsourcing provider, so a very different business from Shopify. But that business, there will be steady demand, and many companies just absolutely depend on Celestica, and that's the advantage they have, whereas consumers, if there's a recession, may stop buying or buy less. So we're actually looking at Celestica as a possibility.
And why would you specifically prefer Amazon to Shopify?
Far more broadly diversified, way more broadly diversified, plus the cloud business for Amazon is a massive business. They're one of the 2 largest cloud players in the world, and basically every company of any size is now forced, because of cyber, to use cloud services, and so your choice is Microsoft's Azure or AWS from Amazon. And that is a huge part of the growth story of Amazon.
And there's Amazon's share price. We began our conversation, Lauren, with you saying today that this is a good time to buy great companies much more cheaply than they were just a short time ago. That looks like it applies to Amazon. If we bring back that one-year look on Amazon, I think viewers will see it more vividly. It has come down a big way, in a big way, in the past few trading sessions, but also since the beginning portion of February.
Sure, and also, of course, fears of recession hitting, every type of retailer, including e-tailers. And so that's having an impact on companies like Amazon and Shopify as well as everyone else in the sector. And this is why, as bad as things look, if things get worse, the Fed will cut interest rates, always a positive, and we may see possibly some changes to tariff strategy.
Okay. That, unfortunately, is all the time we have for viewer calls and questions today. Thank you to everybody who put a call in. If you didn't get through, please try again tomorrow or on a subsequent edition of Market Call. We will have Lauren Steinberg's top picks right after this.
Investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Want to get the most out of one sheet? Grab Bounty. It's inspired by a dishcloth, and you can ditch the mess when you're done. Bounty, the quicker picker-upper.
Looking to maximize your monthly income? Our Yield Maximizer ETFs combine your favorite sectors with a high-yielding income-first strategy to help you meet your goals. More income every month from Hamilton ETFs.
Please join us tomorrow on Market Call. Brett Gerard will be our guest. He's Chief Financial Officer and Portfolio Manager at Liberty International Investment Management. He'll take your questions on global stocks. And if you missed an episode of Market Call, check out our daily podcast. You can find it on iHeartRadio and other podcasting platforms. You can also watch full episodes on our YouTube channel.
Incoming dishes! Doc!
Well, with Dawn Power Wash, he can fly through 99% of grease and grime in half the time.
Oh, migration. Look at him go!
Yeah, Dawn Power Wash is unique. It absorbs grease with 3 cleaning boosters, removing it 5 times faster.
Ooh, for beak's sake. That was fast.
And Power Wash can replace multiple cleaning products.
Power Wash with the assist.
Ooh, those suds got game.
Dawn Power Wash, the better grease getter.
Are you selling a business worth $25 million or more? Let Stenner Wealth Partners put your hard-earned liquid capital back to work for you. Contact us today in complete confidence. We'll be here when you're ready.
This Charmin Ultra Soft Smooth Tear has wavy edges.
It's no ordinary square. Charmin Ultra Soft Smooth Tear has wavy perforations that tear so much better, with more cushiony softness. Enjoy the go with Charmin.
Virgin Plus is obviously the choice for affordable phone plans with lots of data. So is the selling power of a certified actor doctor really necessary? Does it help if 10 out of 10 pretend doctors agree it's easy on the wallet? Or that you get discounts on food, fashion, and entertainment? Your glasses aren't real. Do we need all this doctory stuff to convince you? We don't. Because when you're choosing an affordable phone plan, the obvious choice is Virgin Plus. Obviously.
Top Picks is brought to you by Questrade. Find trade ideas with Options Play, free for Questrade customers.
Welcome back. It's time now for Lauren Steinberg's Top Picks. Alphabet is the first top pick today, not in terms of preference, but in terms of sequence. Ticker symbol GOOGL on the NASDAQ. Lauren.
I've never recommended Alphabet before, but I have to say at the current share price, Paul, this is just incredible value. This is a $350 billion revenue company growing at over 10% per year. Everybody knows, you know, search, Chrome, Maps, YouTube. It's just a growth monster, and R&D spend is almost $50 billion per year. So all of these companies, including Alphabet, are their own venture capital companies. They're investing so much money in AI and things that we'll be talking about 10 years from now. At 18 times 1 year's earnings, you're not buying this for the dividend, although they just started paying a tiny dividend of 0.5%. We look at a stock like this as being a double over the next 5 years, easily from here.
And is advertising revenue growth still a big part of the Alphabet story?
Advertising is still about 80% of the story, and that's not going to go away anytime soon because advertisers are so focused on trying to hit, you know, those core key markets that get shrunk down, those specialty niches that Alphabet delivers so well.
Alphabet is number one. JP Morgan Chase is number two. JPM on the New York Stock Exchange, often considered the flagship or certainly one of the flagship U.S. financials.
For us, they're the flagship U.S. bank. Jamie Dimon has done a spectacular job going back over time. This is one of the few U.S. banks that did not have to raise capital during the financial crisis. Pristine risk controls, Paul. And the stock is trading at 13 times earnings, about a 2.7% dividend yield. They're number one or number two in basically all of their major businesses. They're still growing. They're still gaining market share. A core holding in any portfolio. And this is the time where you can really buy the best companies. You don't have to go down the food chain.
Again, let's take a one-year look, bring back that one-year look on JP Morgan. You'll see just how dramatically it has tumbled quite recently on the news that is really taking all stocks down substantially. Look at the plunge in the past couple of weeks from about 245, it looks, to 210 today. JP Morgan, number two today. Johnson & Johnson is number three. J&J, the drug company. Sure.
So J&J spun off its consumer products division a couple of years ago. It's now pharma and medical technology, which is really medical devices. First of all, one of the two AAA rated companies in the U.S., Microsoft being the other. So pristine balance sheet forever. 62 years of consecutive dividend increases. And that's coming from their free cash flow. It's certainly not coming from borrowing money. The company is trading at a crazy cheap valuation of 14 to 15 times earnings, 3.2% dividend yield. What makes it partly cheap is the fact the ongoing talc litigation.
Right.
A judge in Texas recently turned down their effort to settle this for $7 billion. J&J issued a press release last week, Paul, and I've never seen a press release like this from a drug company. They said the evidence that was presented during the trial makes it very clear that all of these lawsuits on talc are based on completely fake, false science, and that they are instead going to choose, if the other side won't settle, they're going to choose to litigate all of the individual cases.
Wow.
And that's what Merck did back in the day.
Right.
When they had their litigation. J&J is basically fed up. I suspect this is a ploy because the law firms were putting money into this, and sovereign wealth funds have been backing law firms on this.
Yeah.
Is they're just going to pressure to get a settlement here, even if they have to pay an extra couple of $2 billion. I suspect by the end of the year, this will be over.
Is that type of headline stock market friendly, or does that suggest this is going to grind on for another long period of time?
I wouldn't say it's stock market friendly because investors don't like buying a drug company where there's still this outstanding litigation. But I have to say that press release basically calling everybody a liar in the courtroom, I have never seen before, and they've made it clear like they're done. And, you know, if you're a law firm who's waiting to get a settlement out of this, that will probably put more pressure on you.
Okay. Lauren, I want to thank you once again for joining us today.
Thank you so much for having me, Paul.
Lauren Steinberg was our guest. Always great to have him and his expertise here on Market Call. Let's take a quick look at markets before we turn things over to our partners at Bloomberg Television. There is the North American picture with the S&P TSX Composite Index down by 2.5%. I'll give you a snapshot of the of the most influential decliners in Toronto, Enbridge is number one. Enbridge is down by 4.3%. That's taking 40 points off the index, followed by Royal Bank of Canada, a stock we talked about today. Canadian Natural Resources, ditto. TD Bank, we talked about that one as well, and CP Rail. Those are the top 5 most influential decliners. So it's broadly based. Some of the biggest names in the Canadian stock market are leading the TSX down today. The S&P 500 in the U.S. is down by 1.6%, and the NASDAQ Composite is down by 1.5%. Let's move on to the price of gold. We'll check in on gold to see if it's still in positive territory. It is not. It's down, but down slightly. It is, for the most part, has held on to its value through this period of market turmoil. Let's go to crude oil. There's all kinds of worry in the crude oil market, not only from the tariff situation and the prospects for a slowing global economy, which would undercut growth, but OPEC Plus has counterintuitively perhaps decided to accelerate production increases to production quotas. Now, we spoke with Halima Croft. She's an expert at RBC on the geopolitics of oil, and she thinks OPEC Plus is sending a message here to Russia and some of its affiliated producers basically on market share, cautioning them to restrain their own production and don't get into a production war with OPEC. That's her take on that situation. Let's go to the Canadian dollar and see how it's faring right now. There is the Canadian dollar essentially at break even. The path of travel on the loonie recently has been up as the U.S. dollar has sagged in a big, big way on the tariff news and the expectations that the Fed may have to cut rates earlier than earlier believed. As early as next month in the minds of some market participants, and certainly in June if a May cut doesn't happen. Those are much earlier cuts than the market earlier had thought before that were coming in 2025. That's a weakness for the U.S. dollar, and as a result, the Canadian dollar has rallied. Let's finish with a look at Bitcoin on this day when most asset classes are down. There's Bitcoin. It's down by 1.5 percentage points to just over $77,000 per coin. Thank you so much for watching Market Call. We'll see you here next time with Brett Gerard, our guest. In the meantime, our partners with Bloomberg Television will take it from here.
In today's turbulent markets, Starcore works to minimize risk and maximize shareholder value. Our established management team is unlocking the mystery of the source of mineralization at our producing San Martin gold mine, while using free cash flow to explore our portfolio of advanced assets in Mexico, Canada, and Cote d'Ivoire, Africa. With no debt, Starcore offers investors leverage at every stage of the mining life cycle, from exploration to production. Learn more at starcore.com.
This is severe weather. It's getting worse in Canada, and we are all paying the price. But this is what protecting Canadians from the impact of severe weather looks like. The 140,000 people in our home, auto, and business insurance industry working in your community, advocating for solutions that protect all Canadians. It's all part of our plan to protect the things we love.
Oh, it's mesmerizing.
I can't look away.
Cleaning that greasy mess?
And not even scrubbing.
Will fluff my feathers.
Dawn Platinum is bringing it.
You know it. It cuts through the grease better than their old dish soap.
Keep quacking.
Platinum breaks down the slimy stuff it would leave behind, removing 99% of grease and food residue. That's why only Dawn is trusted to save wildlife.
Yeah.
I'd fly south for a clean like that.
Dawn Platinum, the better grease getter.
Get more from Canadian banks and insurers with HEB and HFN. Exposure to Canadian banks and insurers with 0% management fees until January 2026. HEB and HFN on the TSX. From Hamilton ETFs.
I'm Marilla Fernandez. Thanks for joining us on Market Call today. Hap Sneddon is on the show, President and Chief Portfolio Manager at Castlemore. He's going to take your question today on technical analysis. Call us toll free, 1-855-326-6266. You can also email questions to BNNBloomberg.ca, market call at bnnbloomberg.ca. Hap, thanks for coming in today.
Thanks for having me, as always.
Since the markets are doing a bit of crashing today, we're going to take a quick look and see where we are at the hour, the effects of the tariffs and counter tariffs as announced by Washington and most recently China. So the TSX down today 987 points or 4%. It was down even more earlier this morning. The S&P 500 taking a 200-point plus hit, also down more than 4%. The NASDAQ down 682, also losing about 4%. And, of course, that is on top of the losses yesterday. So let me ask you first what you think about the tariffs as they were rolled out, sort of how they were applied in a fixed rate to each nation. What are your thoughts on the way this was rolled out by Washington?
Oh, the rollout was crappy. Once you dig into what the point is, I sort of looked at, it made me look at, okay, the U.S. administration rolled out all these tariffs, and they talked about sort of fair treatment. So I went around and looked at the existing tariffs on U.S. goods into other nations, and they're astronomical. So I sort of get, and they were, if we look at Vietnam, they got hit with 45%. Well, they have a 90% tariff on U.S. goods. So when you look at what the end game is, which I believe is going to be everyone coming with free trade or some version of that, the end game is kind of noble. How it was rolled out was, in my view, terrible. Maybe history will look at this and say this is how it had to be done because, it's been sort of piecemeal for maybe 30, 40, 50 years, right? You go to Europe, you don't see U.S. cars. And they've always claimed some sort of a cultural thing, or any nation can do that. With the exception of food security, I think that, and that being a nation gets to make sure that its food supplies are safe. Everything else is probably open, and that's where we're going to get to eventually on free trade.
You said you understood the logic of having higher tariffs on other nations for the U.S., I guess, but the way it was rolled out was not done sort of the best that it could have been. How do you see that differently? What would have been a better way to introduce this if the goal was, as you say, to even out the tariff situation?
Well, it might have been to have dialogue with each country. That might have taken 10 years. You never know if you kind of, I think that approach seems sensible, but, that's why I alluded to the idea that if we go ahead, 5 years history, might look back and say this was sort of necessary to usher in another wave of growth. I mean, as I said, the rollout's been awful. Sentiment right now is out of 100, there's a couple gauges out there, 100 being exuberance and 0 being that is it. We're at 4.
Oof.
So, there's the old adage, when things speed up like this, investors should slow down. This doesn't feel like it's going to break quickly, but the worst of the news, the sort of the cascading of the news, China today pushes where it's at. I went and looked at China's tariffs. They're very large on the U.S. When China talks about going to the WTO, and that kind of rings a little hollow, that if you want to address this, I think every country has to start to negotiate, but the rollout, probably couldn't have been, I don't know how it gets rolled out. Does a 10-year slow walk work better than sort of shock and awe, and then we kind of get somewhere quicker than just maybe a malaise for a much longer period? That part we still don't know. But as I said, when we look at the sentiment, we're exceptionally washed out. If you're a short-term trader and you wanted to short, you're too late. Both short-term, long-term, medium-term, you're probably better off looking at where there's value right now than trying to protect anything.
Got it. Okay, we're going to take a quick break to line up your phone calls for Hap Sneddon, President and Chief Portfolio Manager, Castlemore. Again, taking your questions on technical analysis. Back in a moment.
Trading Day is brought to you by Capital Group Active ETFs.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart so they can make a difference where it matters. The core of a portfolio. Capital Group, actively different.
Explore new horizons and cities with centuries of tales to tell. Explore adventure from coast to coast in the heart of the Mediterranean. Explore more stories. Visit Malta.
If you're looking to invest, Capital Direct's One Income Trust could be right for you.
Our track record boasts stable income, portfolio diversification, and compound growth.
Last quarter, Capital Direct's return hit over 10%.
Find us online.
Call today.
CapitalDirect.ca.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
Herbal Essences is a force of nature, made with supercharged botanical blends. Our sulfate-free formulas deeply penetrate to boost hair health without the Salon Naturals price tag. Herbal Essences.
BMAX is Canada's first enhanced multi-asset ETF with high monthly distributions. BMAX blends multiple equity and fixed income strategies all in one ETF. BMAX on the TSX.
Welcome back, and thanks for joining us. We want to get straight to your questions for HAP today. So Bev had a question that she's emailed in. She says, please provide your technical analysis on Whitecap Resources. HAP, can we take a look at Whitecap?
Yeah, if we look at this on the chart there, what we will see is it broke below this March low. That is usually an indication that we're actually going to go up some level lower. Pardon me. If you look back here, you can see something that happened right there back in from a December low. It happened in late February, and then we usher in a new set of lows. It did it again. So we would have to go back. I'm not sure if the control can go to a 3-year, but we'll sort of try to find out, okay, where are we going to find support? And I imagine a lot of the charts that we look at today, we're going to see that. So we broke that. Okay, so this is a bit of a longer term move right there. We probably have to go back even further, and that's quite a long 3-year wait to lose that much money over that time frame. So right now, it looks like Whitecap, subject to a sort of a dramatic reversal in the price of natural gas, which Whitecap is, I believe, more disposed to, and crude, that it's probably going to keep probing a bit lower here. There's no place to hang your hat, as you can say.
Okay, so if you were going to sort of dip in, we don't know whether she's in it already or not. You might even wait for a further dip?
I would wait, yes. I would wait clearly on this one. All the energy is going to be a bit of a wait and see. That's had a lot of damage done to it in the last 2 days. Today's a big one, but you want to kind of wait. As I said earlier, there will be value there, but you just got to find a place to where to step into.
Got it. Okay, let's go to the phones. John is on the line from London, Ontario. Hi, John.
Hi, Marilla. Thanks, Hap. I appreciate your dissertation on macroeconomic effects on stocks. I think Mr. Trump is probably trying to devalue his currency the way China did during COVID, thereby decreasing their national debt. In any case, when you have such a conflagration of macroeconomic disaster, are there any technical features that you look at to try to, I mean, we can't predict precisely the bottom, but anything that tells you that things are about to turn around? Thanks very much.
Interesting. So a wider picture.
Yeah, great question, John. I think the way I address this, and this is something that we look at Castlemore whenever we get these situations, what are the things that start to pop up to catch our attention, to say we're getting close to a bottom. It doesn't mean we're going to resume some uptrend. There is some speculation that this is going to be some type of a V because the macro picture is still decent. You know, will this break that? That's what everyone's trying to find out. But to answer John's question, the first thing I would look at would be, you know, sentiment. You know, where are we at? I gave you one off the top. It's a common sentiment out there. John, you can go find it. It's called Fear and Greed, made up of 7 components of different varying bond yields and all these different components. And right now we're at a 4. Last I checked, just before we came on, we're at 4. That's out of 100. Mm-hmm. So, you know, you can't go below 0. So we're really getting there. So what does that do? That kind of gives you the background. Other things you can look at, and we didn't get a chance off the top, was look at the put-call ratio. Put-call looks at how are people buying insurance through options. And usually the higher level of that occurring is indicative of the opposite happening. So the more people go out and buy insurance, the more it's going to be sort of
the less confident they are about putting money in the market. Yeah.
So the time you buy insurance is when things are quite high, yeah, right? Not when things are low, because your insurance cost is too high. And then you can just look at that, you know, once you see something starting to go sideways a bit, not make a new low. And that we saw that, John, with Whitecap. So if you're looking out there for ideas to buy, what's acted well today, even if it might be down 3 or 4%, you know, one of my top picks will be one of those names. A couple of them are ones that have acted quite well through the salt. They're still suffered a bit, but that's where you can see strength on the other side. So sometimes you're not going to get it perfectly, but you have to start to look what the strong names are if you've got cash or you want to make some top grading to your portfolio.
Got it. Okay, let's go back to the phone lines. Elliot is on the line calling from Hamilton, Ontario. Elliot, what's your question today?
Good afternoon. Against the backdrop of continuing tariff turmoil, I think we're probably in for 2 more significant hits in about 8 weeks with the debt limit, what might be a debacle for 2011, and of course Trump versus his deficit hawks when he tries to push his taxes through at the end of the year. Against that backdrop, what are the 2 next significant support levels for Alphabet? Not just down 1 or 2%, but maybe down 5, 6, 10%. Support levels, please.
Okay, thanks for your call, Elliot. We'll have a look at Alphabet, which is at 149 today.
Yeah, and that's great. I love that the producers went right to the 3-year chart, because sometimes you can't see something in the short term. So the thing that we would have looked at maybe you know, a little while ago, back in maybe it looks like mid-February, was this break here right around, looks like 160. The next spot we're going to probably find some support is really close to where we're at right now, and that would be around the 140 level. Shy of that, we're probably looking at a band right there around 110 to, let's call it, sort of 80-ish. It's sort of, you know, you would anything in this area would probably be acceptable if this upper level right here at 140 breaks. So 140, then you're probably looking at sort of a chop between sort of, let's call it 90 and 105. So 2 places that you could kind of, you know, if you don't own it and you wanted to buy it, and I talk about this all the time when I'm on, is one way to deal with markets, investing, is through portfolio management techniques. That has nothing to do with your fundamental analysis, your technical analysis. It's simply putting money in over a period of time, taking out some of the finite guesswork. If you want to own Alphabet and you know it's been washed out here by 30%, well, go buy, and you want to own a 2 or 3% position, go buy half it right now today, and then watch for that second half before you do that.
So dip in over a period of time.
Over a period of time, and that takes away you trying to guess any particular market being, you know, spot on. So.
Got it. Okay. It's good. It's good advice, especially in times when it's unclear what's immediately ahead. Let's get one more caller in. Dominic is calling from Montreal. Hi, Dominic.
Good morning. Good afternoon. Thanks for taking my call. I'm intending to dollar cost average on my shares of NVIDIA. I'm a believer that the insanity of governing with tariffs will soon give way to negotiation. Earlier this morning, the VIX hit in the 40s. I wonder 2 things. Do you use VIX as an indication, you know, to getting in on a position? And what do you see as an entry point for NVIDIA?
Can you explain VIX a little bit so people understand a little bit more about it and when you use it, if you do?
Yeah, well, that just you know, to make it simple, it's another version of an indicator that sort of tells us about the nervousness. So we talked about fear and greed. That was just sort of a simple way. VIX is a component, I believe, of that There we go. We got a graph of the VIX. That is, and we're right back to a high here. So if I own the VIX, and we have owned it in the past, this is probably a really good time to sell. We're ready to peak that we saw back in August. Look at same spot right here. And this is somewhat misleading because you had to hold this through that whole year and be down significantly at times, and then to get up to that 171%. But I certainly would, if I was holding VIX as a insurance in my portfolio, I would sell it. So it's volatility. It's volatility, and you can short the VIX, you can be long the VIX, you can be 2 times the VIX. It's not a position that you hold because it's got decay to it, meaning there's contracts in there that expire and they keep rolling them over. But on the VIX level, to answer Dominic's question, yes, we do look at it. But again, it's a background thing. It's not perfect at timing. It tells you, the neighborhood you're in, but it doesn't tell you, what to do. It just sort of tells you that maybe you should be doing contra moves to the VIX spiking. So to go short when it's at this level, you would have to expect that we're going to substantially go higher. And I'm not sure. We'll take some time when we close today, but you can look at these moves in terms of standard deviations. How many standard deviations, sort of complicated math, away from the average are we? And when you get moves of 2 and 3, those numbers don't sound big, but they're quite big in terms of the standard deviation away from the average. So, so back to NVIDIA here. A break right there. NVIDIA is going to be hard, I think, because it's it's very widely held. It's going to be subject to a lot of volatility. But that level there, this line right here, probably
Where
around.
Would you say that is? Yeah.
Yeah, I guess it would probably look somewhere around $90, $95 that it would look at. And why here? Because we had some action here, and then we saw that little breakout there. And so this is where you had this area here is where you had a whole bunch of new dollars come in. And so that's the logical place where you might find that support again. NVIDIA apparently is quite positive on its situation. We saw there was a couple of announcements recently about some analysis of its chip use, and it's not gonna slow down. But when you have this kind of market, they throw the baby out with the bathwater. So you can pick up really good long-term companies. I alluded to earlier. But by just being patient and deciding, you know what, I don't own NVIDIA. I wanted to own it. I'm going to buy half my position here and just sit tight and see what happens.
Got it. Okay, we're going to take a break. Back with Hap Sneddon, President and Chief Portfolio Manager, Castle Moore. He's taking your questions on technical analysis today. Back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg. Harvest Healthcare Leaders Enhanced Income ETF. Maximize your monthly cash flow from Canada's leading healthcare ETF. More income from healthcare leaders. Harvest ETFs. Income happens here.
No matter what kind of teeth you gotta brush, Oral-B Electric cleans better with one simple touch. Oral-B's dentist-inspired round brush head hugs them, cleans them, and gets in between them for 100% cleaner teeth. Your perfect clean routine starts with Oral-B.
Is this how you're hoping to retire? Well, hope isn't a good retirement strategy. You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals. Have someone on your side to keep you on track.
Call for Fisher's Comfortable Retirement Kit with the help you need to make your retirement a success, including the Investor's Guide to a Comfortable Retirement, 12 retirement investment blunders to avoid, and 7 secrets of high net worth investors. Call 1-888-601-1168.
Fisher Investments tailors a plan to keep you on track for the retirement you want. And as a fiduciary, we do better when our clients do better.
Call now for your free Comfortable Retirement Kit. 1-888-601-1168.
If your retirement portfolio is $500,000 or more, call us today. You don't have it coming to you unless you plan for it.
1-888-601-1168.
Practice starts in 20. Let's get it. T-Mac.
Who shaves for practice?
My game face doesn't take days off with Gillette Labs.
Gillette Labs?
Gillette's ultimate shaving experience. Its green bar releases trapped hairs so you can get virtually every hair in a single stroke. reducing irritation from shaving over the same spot.
You looking smooth, brother.
Let me hook you up.
Appreciate that, kid.
Best your game can get.
Keeps getting better.
Thanks for joining us. Let's get straight back to your phone calls for Hap Sneddon, who is here to take your questions on technical analysis. Joseph is on the line from Montreal with his question. Hi, Joseph.
Hi, thanks for taking my call. I want to hear what you have to say, Hap, about the prevailing rate environment and how that affects your technical analyses through the lens of real estate investment trusts, specifically Crombie REIT. I would have thought that as rates go lower and lower and lower, especially here in Canada, the REITs would do pretty well. They're not well as I thought. Crombie, however, seems to be outpacing the bunch. And technically speaking, it looks pretty good. I showed up one of my screeners the other day, RSI. Nothing controversial. It's in the 50s. MACD pointing up. Money flow is modest. I was trying to get your opinion on interest rates and how they affect your analyses and Crombie REIT. Thanks in advance.
Thank you. So REITs in general, what's your perspective sort of during this time?
They've actually acted quite well. We started to pick up some of the REITs. One of my favorite smaller ones in Canada was Minto. We also own the U.S. broad REIT ETF in the U.S. Okay. So the sector's actually acted quite well. Certainly, as Joseph's talked about, the rates have helped. You know, when you get rates coming down, it makes the housing complex more affordable. When you have this volatility, there's a lot of predictability there that's not in other areas. It tends to be a safer area. Sometimes it's not because of, you know, pricing and whatnot. But in this condition, it's acting quite well. There's the income that you get from that. So that sort of tends to buffet against some of these other issues. Real estate also tends to be local, so it doesn't tend to get as impacted, although we know that what we're seeing in the markets is because we believe it's going to impact everyone's, come to everyone's shores. But there's certain parts of the market where if they've got much more of a domestic look, that they can be a little bit more insulated from what's happening externally or at the stock market level. So, Crombie looks quite good, like Minto, and probably a good place to step in here. On Crombie, we've got this level right here. Sort of 1350 levels, had a lot of touches and a lot of support here, a breakout here, and a touch there. So it probably wants to sort of migrate to there at the worst case. If you didn't own this would be, again, one that maybe you step into now a little bit, see if it comes back to that level. And if it doesn't and starts to accelerate, well, then pay more for something. It's always acceptable to pay more. Got it.
Okay, let's go back to the phone line. Nazar's on the line from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Hap. May I have your technical analysis on Bank of Montreal, please? The stock was trading at $140 before the tariff announcement, and it's trading around $127, $128 now. Does your technical analysis get impacted by this two-day dramatic sell-off in the markets? I read a line saying that Fed chair says it's good time to step back and let things settle down. Thanks for taking my call.
All right, let's take a look at Bank of Montreal. We'll pull up a chart in a moment. There we go. That's a 3-year. So it's down to 127.30. Yeah,
this level that it's actually come to right about here. I'm looking. I've got some stuff on my screen that we can't see on what the viewers see. But this is actually the 200-week moving average. There's another average there, the 50-week that have converged right at the same spot here. So this is finding support right here, right now. If it doesn't, it would come into this congestion sort of between 130 and 104, and that's what the top of this is, and then that's what this band is right here. So if it doesn't sort of hold close to this upper end here we're looking at, then it's going to probably come into this congestion zone and certainly be a buy anywhere between now and 104. Some of the indicators have softened immensely, but the price is sort of holding in. So when you look at indicators, they can soften. The price doesn't have to fall. It can just sort of go sideways as the indicators sort of work off this oversold situation. So that's what we're going to see with BMO, and we see that with lots of the banks. The U.S. banks, they've been harder hit. Probably going to see the same thing coming into these longer-term 2- and 3-year levels of interest.
Got it. Okay, let's go back to the phone lines. Deborah's on the line from Okanagan Falls in BC. Hi, Deborah.
Oh, hi. Good morning, everybody. My question today is on Citigroup. I was very interested in this stock in the $65 to $69 range, but I was holding off knowing the tariffs would put the red candles on the screen. So my question to you is, how would you play this one based on the technicals with such a deep decline on the charts? And my secondary question is, and this is a more global question, you look at seasonal patterns, but do you look at policy change patterns historically when you're doing your analysis?
All right, thanks for the question. Both very good questions. So let's first take a look at Citigroup, and then we'll talk about policy in a moment.
Sure. Yeah, so Citigroup, Deborah, looks a lot like BMO. As I said, it's come right back to this support where we've got a convergence on a couple time frames. So we've got one on a monthly basis, we've got one on a weekly basis. The short term is a bit more washed out. So when you get this convergence of different time frames, so you look at a short time frame, a longer time frame, and the longest time frame, and they start to show us a level that's relevant to each of those time frames, then you get sort of more of a robustness to that analysis because there's multiple time frames. And what we're seeing here is right around this $56. I'd drawn a line on my own chart, and it was some time ago. It was about 5 years ago, actually, of this level being quite supportive. Now, I leave this on my software, so I'll go back to see a line that I've drawn and see, it's got the data. When did I do that? And it was right at this level. So that was, it's been a pretty critical level there. We see on the short term, some of the indicators are actually trying to turn up. Look at the crack.
There's a 5 year.
Yeah, there we go. So this 5 year, can't see it a lot from here, but it would probably be similar to that level right there, that breakout that we saw back in end of 2020. But as I was saying is that it's come right into this zone for a chart that a line that I've drawn a long time ago. So it's a really critical level where it came into. So Deborah, I would go buy half of what you want, your end result in your end holding in Citigroup, buy it today, and then see, there is a chance. I've also got another support line that I drew just north of $50. So that would sort of be around this level here. Probably has to do with these tops here. I'm not sure why I drew 50.
So buy a little, wait to see if that drop continues.
Yeah, and then buy the other half.
And then buy the other half.
And then on policy, that is so hard to handicap. Sometimes policy, there's two types of policy. There's fiscal policy and monetary policy. Monetary policy is much faster. Fiscal policy usually is much slower. Now, this is a fiscal policy hit that it has come to bear much quicker. But normally, fiscal policy takes a while to sort of get there, and this is why fundamentals is what fiscal policy is about. Trying to understand it, you do your analysis. People have different views. That's why when you back up and go to the technicals, you're sort of getting an unbiased view of what all investors sort of think of this. And you may have a read of some type of fiscal policy announcement that you don't think the market quite understands. And why don't they, what is the market? And you're sort of fighting that notion. And what are you fighting? You're fighting a price trend that's going up or down or against you. And so what the technicals do is stop us from trying to force our view onto things of, in this case, how is this going to work out in the trade? I've said I think the end game is going to be positive if we get there. We don't break a lot of stuff along the way. But we're going to look to see whether, how that's being processed, not by people's reaction or the business media to stories, but the market and money being put up. And that will be through an analysis of price, saying, look, people are now starting to buy.
Yeah, fiscal policy usually also, the deadlines are well in advance, right?
So
it's not like by 2 days we're going to do this, which is kind of the way this is rolling out.
Exactly.
Okay, we're going to take a quick break. When we come back, we'll have a look at HAP's past picks. Stay tuned.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
With the current U.S. administration in place, there are growing questions around whether the energy transition can sustain its momentum. To discuss where sentiment stands is John Cook, Senior Vice President and Team Co-Lead of the Mackenzie Greenchip team. What are some of the ways that investors can take advantage of these opportunities you're talking about?
First of all, I think you need a deep understanding of the sectors, and I talked about wind and solar, but it's so much more than that. It's all the componentry that go into this equipment, industrial automation, water management, growing food. You need expertise to understand the drivers within these sectors, and they're not all linear. There's times to invest, times when securities are expensive, and so on. So I do think investors that want to be here, they do need professional asset managers to help them with that. And if you're interested, I would make a strong case why every investor should have at least some of their savings.
Ahead.
Okay, well, I think, first of all, the world is very crowded. When we started, there were 7 billion people on the planet. There's now 8.1. We're consuming more than we ever have. And the energy transition is not going away because we're pushing the world up against its ecological limitations. Not just the California fires, but ocean acidification, degradation of soils to grow our food, and so on. We have to do this. So they should have exposure for that reason. And right now, because sentiment's so poor, valuations in our space, mostly across the board, are very, very attractive. And finally, there's tremendous diversification right now because the world has been so interested in AI and I'll call it capital light technology investing. So there is absolutely a place to invest in strategies like what we're doing for a piece of what particularly Canadian investors should be thinking about.
See, when you heard the news about the perp you arrested?
And we're sure he's the guy. Maybe he's not the killer.
Gotta let it go, Mick, for your own sake.
I can't for Casey's. If Kelly's the guy, then where the hell is she?
Have you seen Lafferty?
He's on leave. Maybe I was just asking him too many questions. That's probably why he benched me.
Like he's hiding something?
Mick, come here.
Now to take a look at past picks from HAP. This was May 29th of 2024. And at the time, you picked Schneider Electric SE, SB, GSY. And at the time you picked it, it was 49.06. And today it's hovering around 41. Last I looked, it was 41.07. So a return of 16% down, 16% down total return. It's also hard to look at it over the past couple of days and see what has happened sort of as the add-on after the tariffs. But what did you initially like about Schneider Electric?
Well, what Schneider Electric does, and you can see their chart, they're coming right back to some support. What they do is they are involved in the digitization, I guess you could say, of taking electricity and using it much more efficiently, using it for high value, high consumption needs, AI, transforming lots of aspects of infrastructure to be better powered. We see their trucks here in North America. You can see Schneider Electric. They do, they're at the commercial level. I don't know if they do any residential at all, but at the commercial level. So these guys are a part of a growth, longer-term sort of growth infrastructure grow out. Well-run company, fairly stable as far as the kind of investment you're buying.
Would you hang on to them at this point?
Now, this one, we actually just sold it yesterday, not because we wanted to, but we wanted to sort of top grade. We wanted to actually take the money, it wasn't a big position for us, and add it to something else that we really liked during this market downturn. And so that's what we did. If we had the extra cash, we probably would have kept it. I would look back to buying it again. I think it's a great stock long term. Sometimes when you run a portfolio, you have to sort of make tough choices. You don't want to sell something, but it's just a matter of a better opportunity somewhere else.
Got it. Okay, let's get to your second pick from May of 2024. At that time, it was Costco, which was trading at 806.52 American. Now it's up to 953.71. So a return of 18%, total return with yield at 19%. Costco, of course, very well-known name, but what have they been doing right over the last year?
Geez, no one, anytime Costco opens up a store, it's successful. They don't close stores. I don't know if they've ever closed any. I've never heard it in Canada. They've got a model they can just replicate in different countries. It's been easily transferable. Their pricing power. They know so much about their customers and how they treat them. They sort of get this exceptional loyalty, this premium loyalty. There's another name out there that you can look at today that's in this space, BJ Wholesale, really similar to Costco, but downstream a bit more bare bones than Costco even. But this whole space is actually looking quite good. If you didn't own Costco, this would be a name right now that would probably do quite well over the next year.
Let me ask you, because tariffs are in place, and I'm not sure how much product they get from where. Will they be affected? I mean, people want to go to Costco when they have less money to spend. Yeah. But how will Costco be affected by tariffs?
That's a good question. Their produce probably a little bit less impacted because it's going to be sourced more locally or regionally from where they are. But some of the more hardware goods, which I don't know what percentage that is, so, the coffee makers and all the sort of the consumer goods that are in the internal part of the store, the center section, may be impacted from a pricing perspective.
Got it. Okay, let's get to your third pick then. It's Chemtrade Logistics. At the time was $9.16. It's dropped to $9.11, so 1% drop return, but a 6% upside total return. Tell me a little bit about Chemtrade.
Chemtrade, they supply chemicals. One of the biggest areas they supply chemicals to is in the water treatment. So they're probably somewhat isolated because Canada did skate pretty good. When we look at the bottom line, for us, it was about a 5% net increase. And if you take out energy, we actually have, the last read, we had a surplus with the U.S. So the energy has a big component of whether, what the balance of trade is between the two countries. But this is one that will probably do reasonably well because the chemicals they supply to water treatments all over North America are sort of much more niche-y. They're a low-cost provider. They pay a very nice dividend. It's a well-run company. So I would imagine they're going to do much better than the average industrial company because they're very deep down into the use of its products.
The drag down you see at the start of the year is just sort of the general drag down with everything else?
Well, when we have this volatility, people are going to go upstream a little bit more for sort of high quality names. But when you look at, that's what we're talking about there. But when you look at where it came out, this sort of $9 range was sort of an expected place that it would sort of come to because it has a reasonably decent dividend. It tends to get a little bit more, once you get into a place, people will sort of bear it out a little bit more. What we saw in the real estate units in the Crosby and what we'd see in Crombie and would see it anything else. When you have a decent dividend, it's fairly safe. You're going to get a little bit more support from the market than if you don't pay a dividend.
Got it. Okay, we're going to take your questions when we come back. Hap Stedden is here with his technical analysis. We're back in a moment.
Doubleview Gold's Hat Project is potentially one of Canada's largest porphyry copper gold projects, with 477 million tons inferred and 150 million tons indicated copper gold resources, and a significant potential for scandium, an in-demand critical mineral.
When I acquired the project, the potential for copper was totally overlooked, but my belief was so strong that I actually mortgaged my home to drill it. We hit in the first year.
Doubleview Gold Corp, the one to watch.
Your home is your happy place until you come back to bad odors. Use Febreze plug-in with Fade-Defy technology. It has 2 complementary scents that alternate to constantly fight odors and give noticeable freshness. It even reminds you when to refill, so you can always be sure that your home smells fresh and clean for up to 50 days. Enjoy the freshness of Febreze plug-in and try a warmer now for 99 cents.
Head & Shoulders Bare.
Clinically proven dandruff control with just 9 essential ingredients. No sulfates, no silicones, no dyes. Dandruff control, minimal ingredients. Job done.
No amount of studying can guarantee a gambling win. Find tips for safer play at gamblingisrandom.ca.
Welcome back to Market Call. Thanks for joining us today. Kevin's on the line in Ottawa. He has a question today for Hap. Hi, Kevin.
Hi, Hap. Thank you for taking my call. My question's on Honda Motors. I've been watching this for a while, and you look at its long-term chart, 5, 10 years. It's always been very flat, and I know it pays about a 5% dividend. But I'm just thinking, they make such good cars, and I'm just wondering if you think now would be a good time to get in. I've been waiting a few years, but the stock hasn't moved that much. So its graph over the last 4, 5, 6 years just looks horrible. And I'm just wondering, do you think this might pick up considerably after the tariffs are done? Thank you.
Okay, so tariffs, are they going to be greatly affected by tariffs? I'm sure they do production in the U.S., but Japan's been tariffed. All of Asia's pretty much been tariffed. I'm just wondering.
Yeah, to me, the hardest thing the hardest sector, the hardest area to try to figure out is autos, because of the part sharing,
the integration of the system,
the integrations, them having manufacturing facilities in the U.S. and different, so that one's a really hard one to look at. If we're able to pull it a little bit further on this chart, if we can do a 10-year chart, we'll see a little bit better of what, what the caller was.
There we go.
There we go. So this is sort of what he's talking about. It's been kind of gone nowhere for quite a long time. It's sort of, it had a decent run from about 1984 up until about 2008. And then actually, it made a high in 2011. So just before, the back here on this side of the graph, there's a high. And then since that high, it's just gone entirely sideways the whole time. So it's sort of been dead money. But having said that, the low here of around $22 would be that low, would be, again, I've said this a couple of times, I would go out and buy, if he's interested in owning it, I would go out and buy half your position right now.
So he already owns it, and I think he doesn't know what to do about it, because as you say,
I certainly wouldn't sell this.
Okay.
We did have a high just early last year of around $40. Now we're cut by 30-40% in the span of a year. You're getting that dividend, and he's been through this before. This is not the first ride. We've seen these rides before. So if you've had Honda, this is sort of nothing new to you.
But hang on for the
I would certainly hang on to at this point, yes.
Okay. So we do have to take another break. We're going to be back with Hap in a moment. Stay tuned.
Disappointed with rates offered by GICs and high-interest savings accounts? Get more with HBIll, a higher-yielding alternative for your Canadian and U.S. cash. HBIll, more income every month. From Hamilton ETFs.
Bell 5G Plus? What does the plus mean?
Want to get the most out of one sheet? Grab Bounty.
It's inspired by a dishcloth, and you can ditch the mess when you're done. Bounty, the quicker picker-upper.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian preferred share ETF, Mulvihill.
These dishes just aren't getting clean.
The problem isn't your machine. It's likely your detergent.
Really?
Really. I recommend switching to Cascade Platinum Plus. These new pods are packed with more soaking, scrubbing, and rinsing action. Plus, the grease-fighting power of Dawn, easily removing up to 100% of tough stuck-on foods.
That's impressive.
And it works so well, it even keeps your filter clean. Cascade. No pre-wash, no rewash, or your money back.
Welcome back to Market Call. Let's go right to the phone line. Solomon's on the line from Edmonton, and he has a question today for Hap. Hi, Solomon.
Hey, how's it going? So I just had a quick question regarding Amazon. I recently opened a position just because, of course, it's down almost like 25% or 25% from when it was up at around $240. And I have some buys set in the 140 and 160 range. I was just wondering, where do you sort of see Amazon going, and if you think those two buy points around the 160s, 140s are reasonable?
Okay, thanks for the question. Let's take a look at the chart. Amazon down like a lot of the technicals. It hasn't been hit as much, I think, by
No,
this.
it's actually acting pretty well today. It's actually, when I look at my screening, it's actually screening very, very well. Now, from this chart, we're not going to be able to, pardon me, we're not going to be able to tell a heck of a lot. We actually have to go out a bit further, and I'm going to do that on my chart here that I'm looking at, and we'll see that we've got support right around the 175 range. And then we'd have some really big, heavy support around 155. And then after that, we have a level at around 120. So right now, we've got some support. We've got some support around 155. And then again, as I said, around 110, let's say.
Okay.
But the way it's acting today, we're trying to get some of these indicators, and we can't see them, but these are sort of sine wave things that look like that I'm looking at on my screen. And, a stock just moves up and down. This would be strong, and this would be weak right here. And we're seeing some of these indicators, not the price, but because that's not too bad for the day, but these indicators trying to turn up, which means that some of the selling has been sort of maxed out. You're getting people starting to step in to buy Amazon.
Okay, so that's a good sign. He was saying he does think it might go down a little bit lower. You agree?
155 and then around 110.
Got it. Okay, let's go back to the phone lines. Then we have Mike on the line from St. John. Mike, what is your question?
Hi, good afternoon. Hap, I'm just looking for your technical analysis on Hammond Power Solutions. It's come off quite a bit from its all-time high there. I just wonder what your analysis says. Thank you. Have a great afternoon. Bye for now.
Have a good day. Okay, Hammond.
Yeah, Hammond, we saw a peak there, it looks like, in the all-time high, and we did see a double top. So that was a bit of a warning sign. So we saw back about a year ago there in April, right about, a couple weeks from now, a year, and that was, so there's that double top we're talking about. Actually, you could find a triple top if you go back up there a little bit. And usually when you have these scenarios, these tops that it can't get through, eventually the negativity, wins the day, and the negative soldiers vanquish the positives, and that's what we saw there. We also saw this trend line right here break pretty dramatically there around 120. Right now, pardon me, we're just above some longer-term support. So I've gone out to a longer-term look that looks back multiple years, and it looks like the best place right now that we're going to find support is around $60. So that's not terrible. So around $60. So a bit lower than another 13 on 73. So maybe another 8, 9, 10% kind of thing. A little bit higher before it would get support. Now, when you sort of move downstream, we just saw Amazon, and now we're talking about a much smaller company. People will dip their toes in usually, unless there's something very specific to the smaller company that the market is just entirely discounting. Some great news and it doesn't care. But the market investors step into the bigger names first. And so you will probably see names like this languish for a little bit. And I go it a little bit further, and that level that I gave you, that sort of $60, becomes even more apparent, is that is the place that you'd find buyers come back to. Doesn't mean it has to get there, but that is the place that, you know, we're sort of in no man's land right now. Where could you hang your hat if you didn't own it? Or put on a level to sell. If you do own a lot of this and you bought it much earlier, then that would be the place to look at.
Okay, let's squeeze in one more phone call. Linda's on the line from Angus, Ontario. Hi, Linda. What's your question?
Good afternoon, Hap. If I could please have your analysis on Suncor, and let me know if you think this is a good entry point. Thank you.
Thank you.
Have a good afternoon, all. Take care. Bye-bye.
Well, this is another chart. I love when I come on and I pull up my system again. People can't see it because I've got sort of a history in every stock. I might do notes and they stay there and they tell me when did I make these notes and all that. And so one of the lines I had on here was at $47.
Okay.
You know, and these are not scripted. I just, I take lots of calls because we can do that. But this line that I drew this line back in 2009.
Oh, wow. Okay.
So we're talking about some pretty deep support. Now, Suncor, you know, we've kind of gone nowhere there for a while, and this break is significant. But you can see it came right up to this level here in the past couple of years where it kept having trouble getting through. It finally did. It goes to a new level, and then it comes back. It'll kind of migrate back to that level where we had previous support. If we can go back a bit further, we'd see that.
Okay, we'll pull up the 5 here,
look at that.
I
What
guess.
a crack
so
team.
48 there, and moving on. Here we go.
There we go.
Okay.
Yeah, so this whole congestion zone here is kind of what we're talking about. This would be an area of interest, and particularly the top part of it. This one might be a bit of an anomalous. I think we're already below that level, but sort of the top part of that range, and that's sort of the bottom of that zone that we see right now. So that would be the first place. If you didn't own Suncor, certainly it's been on sale the last 2 days. Energy has been hit dramatically. I'm not sure what the backstory is there. Maybe over the weekend I'll sort of have a chance to sort of figure out why is energy being so strongly hit. I know OPEC Plus is still cranking it out, but I don't know if the market is taking that and run with it. We talked about it earlier, baby in the bathwater. You know, they're selling cats and dogs. Right?
Yeah. Well, they've hiked their production, right? So they're going to roll it out faster. So that's kind of playing in as well.
And then we did have the drill baby drill sort of.
Yes.
Yeah, that sort of is not a. The companies aren't probably rushing to go out and finance new project.
Right now anyway.
Yeah.
Okay. Hap, we do have to leave that part of the conversation and the phone calls there. When we come back, we will share his top picks. That's coming up next.
Trading Day is brought to you by Capital Group Active ETFs.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between strength, flexibility, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters. The core of a portfolio. Because we don't fit molds, we prefer to cast originals. Capital Group, actively different.
We created these! We're 4 Canadian friends that quit our jobs because we hated our underwear. We couldn't take the chafing, riding up, and constant adjusting. So we spent 12 months creating our own. They're made with a premium modal fabric that's breathable like cotton, but it won't stretch out. And we designed them to contour and support the boys, preventing sticking. We also made it to Dragon's Den and received offers from 4 different dragons. So visit manmadebrand.com to experience ultimate crotch comfort today.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
Dry, brittle hair? Need some intensive care. New Pantene Damage Repair Collection. Our formula with provitamins, argan, and jojoba oils regenerates hair bonds at the molecular level for healthier hair at a fraction of the cost. Pantene.
Interactive Brokers pays up to 3.83% on instantly available US dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Welcome back. Time now for top picks with Hap. Definity Financial is the first one we're going to look at. Why do you like Definity Financial on the TSX?
It's a very predictable company. We've held this for a while. We keep buying it. We start keeping this around $30. They're a smaller, probably I think the 6th or 7th largest property and casualty insurer. They do auto, property, liability coverage. They do businesses and individuals. There we go. Pretty stable chart there. The bottom line start with these guys is their return on equity has got an exceptionally bright future. The way they run their business, recent earnings prove that. They saw the top line growth over 9% and really good expense management, which is key in insurance business, right? That kind of make sure you're keeping your expenses under control because they operate on sort of very finite margins of what they do. The underwriting investment income, the gross premiums, that's a big deal in insurance. They also showed really well, and it's got an excellent management. Pays a decent dividend, not as good as it used to be, but just a well-run company. I'm not as experienced in the insurance business is a little when you get up to the regulatory, but to me they would be a candidate to be bought. But I know that's a little more complicated when you deal with insurance companies. But fantastically well-run company here in Southern Ontario.
Okay, let's get to your next pick, which is a well-known name, Berkshire Hathaway, of course. Today, just looked it up, trading around 501. So it is down like everything else, but you still like it moving forward.
Yeah, when you look at how it's actually acted, this was the name we added to yesterday that we sold a bit of we sold Schneider for, just because of how this is acting. You can see that it's still a pretty, quite a reasonable chart there. We've got support back here around the $500 level. There always is concerns that Buffett isn't getting any younger. He's 94 years old. But we know that there's a longer-term chart there, and this has beat the S&P on all time frames. They've got a massive cash hoard, so when you're looking to try to figure out where to deploy money in this market, why not get a little help from some other people that can do it? $478 billion. They will find something that they'll use that cash for, and as I said earlier, the legacy on them is the legacy planning they have is one day Warren will not be here, but the company will live on, and I think that's what he expects, and Munger. That's everything.
But the people who are going to run it after him believe in his fundamentals and are going to sort of move forward under that guidance?
100%.
Got it. Okay.
Yeah.
Let's go to your third pick then for today. The third pick is Coca-Cola, which was a surprising one. Why do you like Coca-Cola?
Well, Coke, when you look at what they do, they've got the basic Coke, but the brand strength they have. I mean, we can go through the names. There's tons of them: Sprite, Fanta, Dasani, Vitamin Water, Body Armor, Powerade, and on. Is in the teas. They've got a big potential expansion in coffee. So that's another area that they're going to be, getting into.
We're going to see Coca-Cola coffee.
No, just the coffee category.
Okay.
Not
under that brand.
Yeah, adding coffee.
Might not be a bad thing.
No, I don't. And due to its focus on the total beverage portfolio, as I said, the new developments in coffee, their pricing power, their geographical diversification, they're really close to all their retailers, and they really get local culture. So what Coke can do in Southeast Asia, what it can do in Northern Europe, what it can do in South America, it ports its brand. It takes its brand to those places and operates quite well. And then on a technical basis, you can see here, we got a little bit of resistance. We want to see it kind of plug through that, but the chart for Coke is pretty decent, pays a decent dividend, and it's been down much less in the market the last few days. And that's where you tend to look for strength coming out of markets. You don't want to get super heavy into super defensive, which Coke kind of would be called defensive at this time of the market.
A defensive stock?
A little bit defensive. Beverage tends to be a defensive. It's very predictable. People will still buy their drinks as opposed to maybe they won't buy a car, but they'll go out and buy some drinks. So it tends to operate in a defensive basis. But technically, and all the their earnings and all the components right now look really good. The market backdrop doesn't impact them as much as it would other companies.
Got it. Okay, good to know, because I didn't realize it acted that way. And moving forward, if there is a recession, people are, again, trying to figure out where to stash their money to be safe. Hap, we got to leave it there. Thank you for coming in. Appreciate your time on this. We do want to take a quick look at the markets as we head to a break, just because it is that kind of day. So the TSX is now down over 1,000 points, 1,070 or 4.4%. The S&P 500 down 253. It has lost almost 4.7%. The NASDAQ also taking a hit, down 788 points, and it has lost about 4.8%. Remember, China has introduced retaliatory tariffs on the U.S. after Washington's markup on many of the countries in Asia. So a lot going on. We're keeping an eye on it. Thanks for joining us on Market Call. We'll see you again on Monday.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
And it's another day, Ed, of U.S. stocks whipsawing following President Trump's tariffs. This as nervy investors respond to the speculation on tariff delays, since refuted by the White House, and reports of a legal challenge to those levies. Let's check in on the markets. Right here, right now, we're up 0.6% on the trading day on the Nasdaq's 100. Remember, this has already entered a bear market of 20% from its highs. But for now, we managed to hold on to some sort of hope when it comes to the dramatic sell-off of recent days. Move on and have a look at what's happening to the S&P 500, though. Other benchmarks haven't performed as well as the tech benchmark. We're off by 0.1%. We could be on track for a bear market of 20% of the highs from the S&P 500 too, Ed. What are you looking at?
Well, in the context of tariffs and this market and the technology sector, it is the Mag 7 names that are the focus. Think about NVIDIA, a name that was significantly lower, swung to a gain, it's held that gain. Analyst downgrades and cuts is part of the story in Apple and Tesla, but in one point in the session, Apple was on track for its biggest three-day drop since October of 2000. I want to show you some data that was brought up by Apollo Global in their newsletter this morning, and it is the Mag 7 names and their North America or US revenues. In Amazon's case, 61% majority in North America, excluding AWS. But for most of them, most of those sales come from outside the US, in jurisdictions where tariffs will be held hardest. And that's why there's concern, in part, that it will be a hit to earnings going forward.
And boy, hasn't that been the story for Apple. Now, let's just return to the key stock that renowned tech bull Dan Ives of Wedbush has cut his price target for the iPhone maker. He's gone way down to $250 from $325, while maintaining, though, an outperform rating. Joining us now, Bloomberg's Ryan Vlastelica. Apple has been in the eye of the storm, and Dan Ives singling that out over the course of the weekend.
Yeah, good morning. Thanks for having me. Apple is really sort of the poster child for tariff-related risk right now. It does so much manufacturing overseas, especially in countries like China and Vietnam, which are some of the countries that have been hit with some of the highest tariff rates. So there is so much uncertainty surrounding the company, surrounding its earnings potential in this kind of environment. What are they going to do? What are tariffs going to look like? Are they going to have to raise prices? If they do, what is that going to mean for demand? Are they going to absorb these higher costs? If so, what does that mean for margins and earnings? There is so much uncertainty here. And because we're talking about Apple, which is still the biggest company in the world, it's obviously has a lot of implications for the market overall.
We were talking before the show about, is this a historic Monday or not? Biggest three-day drop for Apple going back to 2000. That gives me a sort of sense of scale. But talk to me about the stock, Ryan. I mean, our colleagues at Bloomberg Intelligence don't think Apple raises prices. It has used mechanisms around the world to stay competitive on the services side in particular. How's the stock viewed?
Well, I think so much of this really depends on what happens with tariffs. There is so much uncertainty on that point, and if they stay in place as they currently are, the outlook is very grim. But if they come off tomorrow, which doesn't seem like it's, honestly, who knows? People are still pretty positive about the company's longer-term potential. Maybe eventually with AI, with services growth, with earnings, it still has a bunch of cash, a very strong balance sheet. There's certainly reasons to be optimistic, but a lot of people I talk to are just very skeptical about it. Now, I will say that if you look at its RSI, it's trading at some of the most oversold levels in years. So there is certainly an argument to be made here that some people feel like it's gotten oversold. Like you said, biggest 3-day drop, at least at one point, since before the iPod. So that tells you the kind of buying opportunity, if you like the stock, that you could be looking at here.
Welcome to this Monday. Bloomberg's Ryan Plaselica. Thank you very much. Let's get more on the wider market turmoil. Angelo Zeno, CFRA Research VP, Senior Equity Analyst, joins us now. And I want to go back to the point that we raised at the top of the show, that if you put the Mag 7 side by side, Angelo, and look at the revenues they derive from outside of the United States, Apple catches the eye, right? There's a lot of it coming ex-USA or ex-North America. How are you modeling that this morning?
Yeah, no, thanks for having me. So as far as that's concerned, yeah, I mean, look, listen, I mean, Apple it's really tough to be a technology hardware company right now. And to us, Apple is probably facing its toughest test in about 2 decades, let's call it since the financial crisis, where it actually prospered because of the iPhone launch at that point in time. But when you kind of look at Apple specifically here, to your point, 43% of sales here in the U.S., the rest internationally. So it is a true global company. And the fact that they do have, most of their iPhone production in China is the issue at hand. We do think, as far as the tariff concerns are concerned right now, there's essentially this $20 billion or so deficit that they're going to have to make up in terms of, if you were to look at over the last 12 months and kind of extract the type of tariff hit that they would have gotten from importing all those goods in the U.S. So when you think about that and you look at the potential of what they could do here in terms of offsetting that $20 billion increase, I think there are a number of things that they can do, but I don't think personally it's something along the lines of them increasing iPhone prices by about 30% or so across the line here in the U.S., because that's just going to cause way too much demand destruction.
So they swallow a margin hit, but right now the investor base is having to swallow serious headline pressure. We are being whipsawed by the latest. We don't know whether this could suddenly on a dime spin into the green. We're off by 2.5%. How do you, as a long-term investor, hold the trade, Angelo?
Yeah, I mean, listen, you look at where the stock is at now. I mean, we've seen essentially a 30% plus correction in the shares. So in our view, it's at this point, it's too late to sell the shares if you're an Apple investor. We've told investors we think there's downside to about $155 to $165 a share. That would essentially imply a peak to trough of about 40%. And those are declines that we've seen in the past from Apple stock, and they've recovered and hit new highs back then. We think this is a point in time where Apple is going to be able to adjust to whatever new scenario that we see. If these 50% plus tariffs from China are here to stay, we think they're going to adjust their business model for that, whether it be increasing their iPhone prices by $100 across the board with the iPhone 17 cycle, and then potentially kind of when you look at it from an installment cost perspective, that's fairly limited to the consumer out there. But nonetheless, there are a number of things we think Apple can do here to kind of right size their model.
Let's go to the other areas that you focus. You focus on a lot of chip names, and many are worried about the exposure of semiconductors to supply chain in Asia, even though there was a carve-out for semiconductors coming from Asia from a tariff perspective. They're in the green today, Angelo. Is that the right way to be analyzing the sell-off of late?
Yeah, it's interesting. So you kind of, when we were looking at these shares this morning for a lot of these names, specifically a name like NVIDIA, we thought it was essentially overdone. But you kind of look at the decline we've seen from peak to trough on the semiconductor side of things. It's been about a 40% decline, which is actually similar to the decline that we saw from peak to trough back in 2020-22. And again, it's one of those situations you never know where the bottom is on the chip side of things, but there is clearly some very strong secular opportunities tied to the chip sector, specifically on the AI side of things. We think that infrastructure build out continues. Clearly, it's going to be somewhat ratcheted down because of the tariff situation we're in right now. But nonetheless, I mean, it is an opportunity that, persists, we think, over the next decade or so. And, NVIDIA clearly at that top of the list. But when you look at the profitability of these companies on that AI trade, that is going to remain intact, of course, with some downside to the estimates. But again, the 40% reduction we've seen in the share prices reflect that.
Let me jump in here. The bigger question to me is not just whether the infrastructure build-out continues, it's whether the hyperscaler CapEx moderates, because profit estimates for many of these companies in the semi-space are predicated on that. What's your call on that investment cycle?
Yeah, so I mean, we do think that it's going to be challenged. So you kind of look at a year ago, and essentially the CapEx numbers just continue to go higher and higher. In our view, it actually, we've probably seen somewhat of a peak type CapEx number here in the near term. We don't think you're talking peak levels at all long term. We actually think as you go into 2026, we're looking at a CapEx increase of about 4% for the hyperscalers on a combined basis. It's going to be north of 30% this year. It starts to level out, though, absolutely. But nonetheless, I mean, you kind of look at the secular themes that drive infrastructure spending. It is the cloud, it is digital ad spend, and long term, those are going to be trends that continue to see higher revenue growth.
Angelo, how does this technology market compare to 98, 2000, 2008, and every day of your working life that's gone before it?
Yeah, that's a great question. I think, specifically from a valuation perspective, I think the good news is we don't have a valuation problem in tech. And I think historically that has been an issue. These are historically very high growth oriented type names, and you always have to worry about how much can these names really kind of decline. I think the great thing is when you look at tech here, specifically what's driving it, it is big tech. And big tech has massive free cash flow generation. Even if we kind of discount some of the tariff issues at hand right now, you're still talking about an Apple, if they don't offset that 20 billion or so, is still going to generate potentially 90 billion or so on an annualized basis. And that would be your worst case scenario. So when we start thinking about the drivers here of tech, the discount now that you've seen here over the last 9 to 10 months on the valuation side of things, now trading less than 20 times on a calendar 26 basis. Again, those estimates have to go down. But when we kind of look at things here, you got to look at it from a long-term perspective. You look at that 20% or so discount on broader tech.
Yeah.
And I think, overall, if you're a long-term investor, I think there's an opportunity here over the next, couple of days, weeks. You just got to be willing to lose some money in the near term.
Right, that volatility. Angelo Zeno of CFRA, great to have you on the show. Thank you. Coming up, we're going to check in on Tesla's stock price following a dramatic price target cut from Wedbush. More on that next. Ed, what are you drilling into?
So I think it's fair to say a lot of people worked this Sunday, and one of the only markets open to look at was crypto and Bitcoin in particular. We went from like $88,000 per token Friday night down now to around 78,500. It's moderated, but there's divergence with gold. There is the tariff story hitting crypto assets, and we'll continue to track it because that was a lot of the focus over the weekend. Just in case you missed it, stick with us. We'll be right back. This is Bloomberg Technology.
Everybody has a hose, but can your hose do this? And can it do this? The X-Hose DAC 5 can, and much more. It's the strongest, most powerful hose you can have, yet it's light as a feather. Turn the water on and it expands to 3 times its length. Turn the water off and it shrinks to a compact size. Can your regular hose do that? Don't think so. Run over a regular hose and you get this every time, but the DAC 5 is super tough. No matter how often you run it over or how great the pressure is, it won't break because its reinforced high-grade drag-resistant Dacron 5 polyester outer layer is specifically woven to make it tougher and stronger than ever, while its solid brass fittings and superior strain relief collar are crush-resistant. Drag an ordinary hose through rocks like this and it'll break. But the DAC 5's tough outer layer makes it impervious to wear and tear. Leave an ordinary hose in the heat and it'll almost melt. But the DAC 5 remains intact and works like a champ, even when it's on fire. So go ahead, beat it up all you want. It's still gonna work like new. And look, while other hoses kink and stop working, the DAC 5 never kinks. And it keeps a strong, steady flow. Its thick, specially formulated latex inner layer expects expands to produce more velocity and higher pressure, so it's even more powerful. Even when it's tied into knot after knot after knot, it still has a powerful stream that blasts everything out of its way. And now you can have the amazing X-Hose DAC 5 for just $29.95, and we'll ship it to you free. But wait, call now and you can double the offer and still get free shipping. Just pay a separate fee. So why put up with this when you can have this? Order your X-Hose DAC 5 now.
To order, call 1-800-264-7819 or go to xhose.ca. So call 1-800-264-7819. That's 1-800-264-7819 or visit xhose.ca.
Tesla trading at one point in the session below $218 a share, a price at which Commerce Secretary Howard Lutnick predicted they'd never fall to again. That decline followed a 43% price target cut by Wedbush securities analyst Daniel Ives, citing Trump's trade policies and a brand crisis created by Elon Musk. Bloomberg's Global Autos editor Craig Trudell's here for more from London. When I was reading the Ives note, there were some very specific points, which is that, for example, in China, it's not just the tariffs themselves, it's the reputation and association of Musk with the policy that might drive Chinese consumers to buy domestic models.
Yeah, that's right. And I mean, I think what we've seen from the Trump administration is that they've really sort of, stoked this nationalistic sentiment in other countries already. You think about Canada being a great example of this. Well, maybe not great, but an example of this where, at hockey games, suddenly, there's a booing of the national anthem. And, we don't have to go that far back in history to think of other companies that, have felt the brunt of sort of nationalistic sentiment in China and felt blowback from that. And so I think that's what I was alluding to here. And it's maybe a risk that we haven't seen necessarily in China where, whereas we've seen these Tesla takedown protests in other countries, it's not something that we're seeing on the streets of, say, Shanghai or Beijing.
He calls for Elon Musk to step up, Craig, and to show leadership. Now, last time I checked, I don't think Elon Musk particularly cares what Wall Street analysts think or ask of him. But are we anticipating a return to leading this business rather than his role at the White House?
I think there was a lot of sort of hope and optimism last week, right, when Politico reported that Musk, was on the cusp of stepping back officially from his roles. But I think, not only did we hear Musk dispute that and say it's, fake news, we also heard, from J.D. Vance, the vice president, talk about this idea that, Doge is nowhere near done and allude to the idea that Musk is going to continue to advise this administration, for long into the future. And so even if officially he is no longer a special government employee, I think this notion that he would fully step back from politics seems like a stretch given how sort of assertive and hands-on he's been to this point. Maybe he does go back to spending more time, say in Austin or at facilities like in California. But I think the bigger problem here is the sort of daily drumbeat of his posts on X that can be really divisive.
Craig Trudell, thanks so much for joining us, as always. Meanwhile, coming up, we're going to take a closer look at how the US-China trade tensions could also be playing into the negotiations for TikTok. Sam Sachs, Senior Fellow at New America, joining us. Ed, what are you keeping an eye on?
Markets over in Asia overnight, and also a piece of news. This is the MSCI AC Asia Pacific Information Tech Index. Clearly heavy declines, but this, as President Trump said that he has spoken to the Japanese Prime Minister, also getting some headlines crossing the Bloomberg terminal relating to Asia. Trump says China must back off 34% tariff increases by April 8th. Trump says that talks with China on possible meetings will be terminated, and he threatens a 50% additional tariff on China starting April 9th if they don't meet an April 8 deadline he's talking about to back off of the 34%. I think we call them reciprocal tariffs, right, Caro, that were put in place by the Chinese.
We continue to see this sell-off at the moment, Ed. We're dramatically now back in the red, off by 1.8% on the back of that headline. We'll bring you more on it. This is Bloomberg Technology.
Most men over 40 look into the mirror and see this, when they could be seeing this. Most men over 40 look into the mirror and see this, when they could be seeing this. Most men over 40 look into the mirror and see this, when they could be using this. Particle 6-in-1 Face Cream for Men, the first of its kind anti-aging cream designed specifically for men. Fights the look of eye bags, dark spots, and wrinkles. Visit particlemen.ca and use the promo code on your screen to receive 25% off your entire order. Plus, we've got free shipping and a 30-day money-back guarantee. www.particlemen.ca, because seeing is believing.
Mr. Clean Magic Eraser has made my life so much easier. My cleaning routine before was a little hectic. I had to use different products to do the same job, but with the Magic Eraser, it's so much more effective than all the other products. You just add water and you can clean the messes off. Even those stubborn messes. On the burnt-down messes on the stove, in the bathroom, on the shower door, gets the grime out, the soap scum. It's effective, it's versatile, it's easy to use. I really recommend Mr. Clean Magic Eraser.
The report is that we had a deal pretty much with TikTok, not a deal, but pretty close. And then China changed the deal because of tariffs. If I gave a little cut in tariffs, they'd approve that deal in 15 minutes, which shows you the power of tariffs, right?
That was President Trump speaking last night aboard Air Force One, saying China's objections to U.S. tariffs stalled a deal to sell off TikTok and keep it operating in the U.S. In the last 2 minutes, the president has posted on Truth Social threatening a 50% additional tariff on China if they don't remove the 34% reciprocal tariffs that China had put in place by April 8th. He set a deadline, that post. I think, Carrie, we're seeing all kinds of assets react, some that I'm seeing. For example, Golden Dragon Index, NASDAQ Golden Energy Index.
We have more breaking news, Ed.
Go for it, Carrie. Pick it up.
President Trump saying that all talks with China have been terminated unless tariffs are pulled. So thus far, unless there is a change of sentiment coming from China and they withdraw, as you were just articulating, that extra 34% that they put on Friday, then all China talks are terminated unless those tariffs are pulled, Ed.
Yeah, I'm going to look at some of the assets just really quick. Shares like Alibaba's US-listed ADRs clearly getting hit, but the NASDAQ Golden Dragon China Index down almost 4%, so it's important. Let's get back to the story we're talking about, and that is the future of TikTok in the United States. Bloomberg's Kurt Wagner joins us. And essentially, Kurt, what the president said last night on Air Force One confirmed what you had reported a couple of days earlier, that the tariff policy of this White House derailed a deal that was being negotiated with China to have U.S. investor ownership of TikTok in the U.S. Take it from there.
Well, that's exactly right. This deal, as Trump said, was close to being done. They had the framework in place. And, you know, the tariffs hit, the tariffs were announced, and China said, you know, we're going to pause on this thing. And the news you just shared, Ed and Caroline, makes me think that we're definitely nowhere close to a deal now, right? Things are getting more intense, not less intense on this tariff war. And so, you know, as Trump said, the tariffs work. I would say tariffs have consequences, right? In this case, the deal for TikTok is sort of in the crosshairs crosshairs of this thing. We knew that would be the case, I think. I'm not sure if we knew it would be quite this much in the middle of all this, but, you know, part of the geopolitical fight here.
Kurt Wagner, we thank you. We have now got the perfect voice to discuss the implications of US and China on technology and more broadly. Sam Sachs is with us, Senior Fellow at New America. You have worked for tech giants like Siemens, setting up their businesses over in Asia. You speak the language. Interpret what is going on at the moment and how China is going to fight the US on this.
China anticipated the tariffs, but they were shocked by the scale. And what we're seeing now is the leadership in Beijing is trying to both signal resolve. They're saying, we've got this under control, we've diversified our economy, but they're also still hoping for some space for a deal. And let's watch how they navigate doing both at the same time. In TikTok, the deal was ready to come, but tariffs derailed it. And now China's saying we still can maintain leverage at this key moment.
Sam, I'm just going to remind our audience of the breaking news of literally the last 30 seconds, which is that President Trump is saying that all talks with China have been terminated. He had threatened an additional 50% tariff if China had not removed the 34% reciprocal tariff by April 8th. The question, who's in the stronger position here, the United States or China?
Well, first of all, there were no talks actually planned with China. So I'm not sure where that's coming from. China has already moved forward. We heard news that they're building a rail line linking to Europe. They want to secure their exports to Europe. It's going around Russia. They're trying to accommodate European sanctions. They're looking towards emerging economies. They've signaled that they've already significantly reduced their trade and investment with the United States. So they've priced this in, but their economy is weak, and they want to try to offset the domestic pressure on the economy in the hopes that maybe Trump will come around. But look, we're quickly moving toward a downward escalatory spiral if Trump moves forward with these compounding tariffs.
If you are Apple, if you are Tesla that has significant revenue in China, and you're implicated by the brand destruction of a domestic consumer going for China right now, how do you respond? Do you wait this out? Are you trying to make changes to your business model at this moment?
The problem is these companies attempted to change their business model with the China Plus One, diversifying to India, to Vietnam. But now those transshipment companies have also been hit by tariffs, and I think multinationals are reeling from that. Same in the fashion industry. They were double producing lines to countries that are now impacted by the tariffs. The prices are just going to be passed to the consumer, and multinationals are going to be hurting in the process.
So, Sam, I go very quickly back to my same question, but who's got more leeway here to put their economy through pain, China or the United States?
What do you do when both countries are under pressure domestically? I think the United States came at this from a very strong position in their own economy, while China was weak. And now that may flip.
Sam Sachs, New America Senior Fellow, just the perfect guest on this, let's call it a historic Monday. Thank you, Caro.
It is, with these sorts of breaking news headlines, Ed. Coming up, look, could a rare iPhone price hike from Apple actually be coming to the United States? Angelo Zeno thinking that there might well be. For more on the impact on the electronics giant next. And we keep an eye on Apple, off by more than 5% after the latest breaking news that it seems as though Trump is saying yet more tariff pain to come to China unless they move back from their recent response. This is Bloomberg Technology.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
This Charmin Ultra Soft Smooth Tear has wavy edges.
It's no ordinary square. Charmin Ultra Soft Smooth Tear has wavy perforations that tear so much better, with more cushiony softness. Enjoy the go with Charmin.
Have you recently inherited $10 million or more?
A significant inheritance can be complex. At Stinnerworld Partners, we can provide specialized guidance to inheritors. Contact us today in complete confidence. We'll be here when you are ready.
A diaper this leak-free sets them free. Only Pampers Cruisers 360 have a 360 stretchy waistband for up to 100% leak-free fit on every wild child. Pampers Cruisers 360. Live wild and free.
How's your infrastructure fund performing? Compare the 9-point Global Infrastructure Fund, ranked in the first quartile in the Morningstar Global Infrastructure Equity category for 1, 3, 5, and 10-year performance. 9-point, your advantage.
What's the Wi-Fi?
It's AX lamp, lowercase p, capital 7.
Capital 7.
My internet, well, the modem is in the shop.
Better not. I have an internet intolerance. My Wi-Fi gives me rashes. You have fishnet?
These are violent criminals, so they're not going to go down easy. Let's get this done.
Being a cop is stressful. 24/7.
Every year on the job is different. You never really stop being a rookie.
Because if we lose control, bad things happen.
Work smarter, not harder.
Get into a new episode of The Rookie, Tuesday, 9/10 Mountain on CTV. Stream next day on Crave.
Assuming you heard the news about the perp you arrested?
And we're sure he's the guy. Maybe he's not the killer.
Gotta let it go, Mick, for your own sake.
I can't for Casey's. If Kelly's the guy, then where the hell is she?
Have you seen Lafferty?
He's on leave. Maybe I was just asking him too many questions. That's probably why he benched me.
Like he's hiding something?
Mick, come here.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Let's talk about the markets and whipsaw, volatility, gyrations, call it what you will. The breaking headlines of the last 30 minutes are President Trump talking on Truth Social about ending tariff negotiations with China. The NASDAQ 100 has swung from a 4% decline or more early in the session to a gain. Now it is down 1.9%. It's probably better exemplified in some of the single mover names. In the context of tariffs, there is a big focus in the research notes and the activity on social media around the Mag 7 names because of their exposure in terms of revenue outside of the United States. Nvidia is a name that has swung between a significant loss to a significant gain. It is now slightly softer. Tesla continues to be under pressure. Apple down 6%, and we will get to more about Apple with Bloomberg's Mark Gurman in a moment. Amazon now flat, but had actually had a big reversal of fortunes earlier in the day. Caro, it's very hard to piece where you win and lose in this market, but I think Mag 7 is interesting if you just think about where their businesses are around the world.
And the threat of ongoing headline risk is one that investors are having to navigate. Case in point, the last 30 minutes trade. Let's discuss it with Isabel Lee, who joins us on the impact of those that have controlled the stock market, ultimately the big owners, Wall Street. They've been pushing back over the course of the weekend. I think of Bill Ackman's been speaking out. You've had Boaz Weinstein, a whole long list, JB Diamond. How have they basically seen the move shift away from them of late with Trump's commitment to tariffing, certainly China, in the last 30 minutes?
Exactly. It's really been hard, to your point, headline risk. And I want to point out that this intraday gap of 7%, more than 7%, is the largest since 2020. And of course, the whole of the country and the whole of the world are affected, but especially the investing class. We have around 10% of Americans, or at least the richest 10%, invested in a huge chunk of this. And they really don't want to look at their 401ks. There was a meme that says 401k is now 201k. And it's really astonishing. We have strategists cutting down their price targets. VIX jumped to 50. We have one after the other downgrading their U.S. views. And even Fed cuts are shifting by the hour. So it's really an exciting market. We spent the whole weekend, this big take I did with Vildana Hajrik and Denitsa Tekova. We were just calling people, and everyone was really just worried. That was a common thread.
Team in the control room, let's bring up those pictures from last Wednesday where President Trump walked out with the chart of death. There it is. There is the president. Countries listed by tariffs and I think reciprocals as well. Just anecdotally, some of the responses you got to that specific board in his hands were some of the most astonishing things I've seen in print journalism. Recap some.
We have Rich Steinberg. He's a senior wealth advisor, and he was saying he's used to all the stress, but then this is one of the most frustrating he's seen. In fact, he's very, very frustrated. We have that quote in the story. Jay Hatfield of Infrastructure Capital was saying that this is, quote, unambiguously stupid, and there's no reason to cause a, quote, trade war like this. And to Caroline's point, on top of all of this is the reverse wealth effect. We had a wealth effect for the good of 2 years. Everyone was feeling flush, everyone was feeling happy, taking vacations, but now it's the exact opposite. And that can have real implications in the economy. If you look at your 401k or your retirement or just your investments in general, you may not want to take that vacation. You may not want to buy that big appliances. And yes, maybe the richest Americans hold majority of the stocks, but if you're an average American, if you have $50,000 in your bank account, a 20% wipe down is still significant. In fact, if that's your whole nest egg, it's a lot scarier than for those who are wealthy.
Bloomberg's Isabel Lee. Brilliant reporting. Good to catch up. Thank you very much. Let's get back to Apple. And after years of avoiding iPhone price hikes in the United States, Apple may need to finally concede to raise its $999 flagship model pricing as tariffs hit production. Let's go to Bloomberg's Mark Gurman. This was the subject of this weekend's Power On. You explained the historic strategy very well, which is Apple's not raised prices. It has removed the bottom tier of handset and only offered a premium. So what happens next?
Currently, there is precedent for Apple raising prices outside of the U.S. We've seen it post-Brexit in the UK. We've seen price adjustments in the European Union. We saw 25% iPhone price hikes in 2022 in Japan. Seen some adjustments in Canada and Australia. But you're right, in the U.S., it's been pretty stagnant. It's actually been one of the only things in the technology world over the last decade that's been pretty consistent. But given these tariffs, something's got to give. And there's going to be adjustments with suppliers. They're going to push suppliers to give them better pricing. They're going to eat some of the costs themselves. They're going to make supply chain changes. But ultimately, I do strongly believe they will have to make some price adjustments, probably with the iPhone 17 launch later in the year. And this is going to be a big sea change for Apple. Obviously, it's a big shift, but they do have some ways to help the consumer here. They've got a trade-in program. They have installment plans through all the carriers now. So I think from a consumer standpoint, it's not going to be a massive negative. Now, we've seen some analyst reports and commentary over the last few days. I saw one website claim that a made in USA iPhone would cost $30,000 per unit. I've seen analyst notes saying a made in USA iPhone could cost $3,000 to $3,500. The good news is that these are completely misguided. Apple's not moving production to the US, certainly not for the iPhone. What you're going to see is them moving to more of these safe havens outside of China that are pushing that are going to get hit with tariffs, but less so. India, for instance, prior to Trump's post earlier today about a 50% tariff, India was at 50% of the size of the tariff on China, coming in around 26% versus the prior 54%, right? And so that is a big improvement. Vietnam is in the high 40s, but that's still an improvement over the 54%. And they've been stuffing the U.S. channel over the last several months with more units in order to avoid those tariffs.
Can I quickly get your expertise on what Tim Cook is thinking about right now as well? We all thought he was a marvelous politician in and of himself, the way in which he'd managed to navigate the previous administration. How much do you think he's desperately trying to get some sort of carve out?
Extremely desperately, but it seems like Trump, as we expected, is even more emboldened in his second tour or his second term, and he is doing whatever he wants at this point. It doesn't seem like he's working with companies on exemptions. It doesn't seem like he cares about who showed up to his inauguration. It doesn't seem to care that Apple said they're going to invest $500 billion in the U.S. basically because of him. He's just doing whatever he wants, and it doesn't seem like he's taking the impact into account.
There's how this is playing out in markets and the stock analysis, and then there's how it's playing out in the culture, how everyday people talk about MAGA and tariffs and Apple. This is a video from a post that Overheard on Wall Street made. And I'm not sharing it with you, Mark, flippantly. But they're suggesting that in the future, Wall Street analysts will quit and start assembling iPhones in the Midwest, as far as I can tell. You said that won't happen. Just explain in 30 seconds why.
I mean, there's certainly, you know, they have the right to quit their jobs and become manufacturing workers, but I don't anticipate Apple moving outside of Asia in any considerable way. The one thing I do see them doing is decentralizing their supply chain, right? But I don't see that coming to the U.S. I think you'll see more production in parts of South America, right? Maybe parts of Europe, maybe more parts of India and China, but I don't think Midwest manufacturing facilities to create iPhones are coming anytime soon. I certainly don't think they're on the table right now.
Makes for a good meme, but Mark Gurman is nothing but straight talk. We thank you so much.
Nice.
Let's take a quick look at what's happening in semiconductors right now, though, Ed, because throughout the trading day, we have basically been in the green. Whipsawed somewhat on these headline risks, but the stocks up more than a percentage point. Nvidia now up 1.5%, shaking off that anxiety around the yet further tariffs coming China's way if Trump is to be believed on Truth Social. Broadcom up 3%. Let's dig into what all of this means for the industry. Peter Elstrom, I'm pleased to say, is doing a tour of the US at the moment. You're here with me in New York. And people basically had seen the chip sector weighed because of, again, its exposure from a supply chain to Asia. Why are they managing to shake it off a little bit today?
Well, the volatility here is really surprising. I thought I knew what the tariffs were as I was walking over here to the set, and they changed even on my way over. So we know that Taiwan is going to get hit with tariffs around 32%. China also is looking at some tariffs at this point. So there are concerns about what exactly those costs are going to be as products move into the U.S. There'll be an exception for the chips themselves. At least so far, we've seen the White House carve out this exception for the actual chips, but there's not an exception for the products. And TSMC, of course, makes products for Apple, as Gurman was referring to earlier, and also NVIDIA in particular. And it's not exactly clear what those products are going to do when it comes to these tariffs. You may see some exceptions there. And the analysts are trying to figure this out right now. They do believe that NVIDIA servers coming into the U.S. are going to be exempted from the tariffs, but it's not clear, and the White House hasn't been able to give clarity on that point so far.
It's an amazing point that actually many don't understand specific policy as relates to tariffs. The other part of it is that everything your team's reported for the last 2 years, which is the United States wants to have more semiconductor manufacturing, but fabs take time and billions of dollars to implement and build. Where are we at in that process?
Right. You talked about these companies that are trying to sidestep the tariffs from the Trump administration right now. Apple, of course, has been very good at this. Look at TSMC, though. Certainly not as high profile, but TSMC came forward. They were already spending $65 billion on chip capacity in the U.S. They promised to spend another $100 billion on capacity in the U.S. You think that they would be one of the companies that would get some exemptions here. But so far, the Trump administration has been holding pretty firm, and it's not clear exactly how they're going to be affected as they make chips in Taiwan and send them over to the U.S. Still, they have the bulk of their manufacturing in Taiwan. They need to be able to send those chips someplace else, and then they come into the United States. So TSMC is making progress in building this geographic diversification, but they haven't made that much progress so far.
What's so interesting is tomorrow we get Samsung preliminary revenue. Right. It's going to be down, and they're in the line of fire when it comes to US curbs. And at the same time, we're all worried about AI infrastructure bubbles that we were talking about even before this.
Right.
So how much are we dialing up into what already is a feeling that we're over-allocated to the chip sector?
Well, that's the big question with all of these huge investments into AI and into data centers in particular. We know that the hyperscalers are spending tens of billions of dollars at this point on that capacity, but we don't know what kind of revenue is sitting on the other side of it. So we're trying to get some insight into that. Samsung is certainly going to talk about their progress in making memory chips for AI. They've been behind SK Hynix in particular in terms of building that kind of capability, pairing up with NVIDIA at this point. But we're going to get some sign of their progress tomorrow, and we'll see whether they give us any indication about what that AI demand is in the end.
Bloomberg's Peter Elstrom over in New York. Thank you so much. Now, coming up on the program, market turmoil is causing companies to rethink their IPO plans. Greg Martin from Rainmaker Securities joins us to talk about the appetite for going public, or lack of, I think. Caro.
Yeah, we take a quick look ultimately at what's been happening across the board as we look towards the IPO market. We're currently off by the Nasdaq 100, 0.4%. This is Bloomberg Technology.
Thousands of Canadian businesses don't have access to the support they need. BDC is committed to opening the way. Breaking down doors for entrepreneurs. We're on it. BDC, financing, advising, know-how.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
I know.
Is this yours?
Yeah, Ma.
No way. Yes, way. Well, get in.
There's nothing like that first Mercedes feeling. Experience the feeling yourself at a local Mercedes-Benz dealer.
What keeps baby's skin healthy? A diaper that doesn't leave skin wet. That's why Pampers Swaddlers absorbs wetness better for up to 100% leak-proof protection and 0% skin irritation. Pampers, for healthy baby skin.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
I feel really lucky to be here.
Only Crave has the shows you can't stop watching.
Fire it up!
And now, get 30% off with a premium 6-month plan.
What did you do?
And start streaming exclusive HBO originals.
We should always live like this.
Amen.
Hit Canadian series. Plus the biggest blockbusters.
Movie night!
Get 30% off with a premium 6-month plan. Visit crave.ca/spring offer. Crave, endlessly entertaining.
I really missed you, Maggie.
I'm sorry, I just need a minute. The reservation's not coming up.
Hey, that's my cup of coffee.
Taxes for your screw-up. I don't think those two are gonna get along.
Spread your wings and fly.
No matter where I went, a part of me would always be here.
You sure you made the right decision?
A new season of Solomon's Crossing starts Sunday, April 27th on CTV. Stream next day on Crave.
Let's turn to another side of the markets right now, because 2025, it was supposed to see a rebound in IPO demand. But look, this market rout following Trump's tariff announcements has led several companies, Klarna, StubHub, for example, to pause their plans. Here to talk about this all, Greg Martin, co-founder of Rainmaker Securities. Rainmaking was meant to be on, and now we understand there's a pullback because these markets are treacherous, Greg. Are all IPOs on ice?
Well, thank you for having me on. I was hoping to be able to talk about the excitement we were going to have coming into, Klarna and StubHub hitting the road and hopefully a reemergence of the IPO market. But the worst thing for the IPO market is uncertainty and instability, and that's what we have in spades right now. I mean, the VIX at 45, approaching 50. It's crazy how unstable we are right now, and it's a huge wet blanket on the IPO market.
StubHub, Klarna. We see Chime, for example, delaying. The brands that we know have already paused, but there's others waiting in the wings. We were already discussing, well, maybe there'd be Shein, Bolt, Discord. Many had been articulated in the markets, varying amounts of reports as to whether or not they'd actually tap. But Greg, do we think there has to be a step away for the entirety of 2025 as it stands?
I think that's strong. I think it's a little bit wait and see. We're definitely in pause mode. I think people want to see what materializes. I remain an optimist. I'm hopeful that trade deals will get done. But if this uncertainty, this instability persists for a long time, and if we start to have fears of a global recession and trade wars, it could push this thing considerably to the end or next year. I think right now it's really up in the air, as we pointed out. Klarna and StubHub have delayed. Hinge Health was supposed to go public. Chime, Circle just filed last week. It's just a lot of uncertainty, and I think right now it's wait and see mode. So I think it's probably at least a quarter of pause.
What's interesting, let's bring those names back up, is a lot of people work at those companies. A lot of them have a broad base of investors. Many of them, the employees and investors, watch this program. Does this pause on the IPO window open up the secondaries market or put pressure on the companies to give employees liquidity in other ways?
Absolutely. We've had a huge dearth of liquidity, since 2021, frankly, and people have been waiting for the IPO market to open up. We've started to see companies doing tender offers in order to alleviate some of the liquidity pressure, but there's still a ton of liquidity pressure that persists. And frankly, in this period there's a lot of fear in the market, and employees and workers in all of these companies are starting to think, I'd like to have a little bit more of my net worth in cash. And so I think there's going to be a lot of pressure for companies to enable secondaries trading. So I do expect some secondaries trading will happen. The flip side of that, though, is that investors, when they buy secondaries, when they buy into these private companies before they go public, they want to see a public market in the future because they start to think about liquidity. So there's a trade-off there, and so we are going to see more liquidity pressure, but we also will see a little bit of a pause on demand. So it'll be interesting to see how the market plays out.
Greg, is this an America problem or it's a global market problem for IPOs?
It's a global problem. I mean, this is something that hits everybody everywhere in every part of the world, and it needs to be sorted out. We're seeing every single market affected by this, and the United States is the center of it all, of course, but everyone is affected by this, and it needs to get sorted out, or else we could have some long-term issues.
India was really active, for example, Greg. Though I want to just see where the blame lies, because briefly, CoreWeave wasn't exactly accepted with welcome arms when it came to the market. It's since rallied a bit, but was this already in the making?
I don't think it was necessarily in the making. I mean, CoreWeave was a unique story. It had major customer concentration issues. It had a huge amount of debt, and frankly, it's actually traded up quite well since the IPO, and actually is still up about 20% since it IPO'd at 40, despite the major market pullback last week. So I don't think this has anything. I don't think this was necessarily in play before CoreWeave. CoreWeave was a different story. I think this is something that hit from left field, and I think it's something that we're all having to deal with. And right now, we're just not certain which direction we'll go, and that's why the market is in pause.
Greg Martin, co-founder of Rainmaker Securities, thank you very much. Now stick with us, because coming up, we're going to go back to tariffs, discuss what the EU response could be and what it will mean for tech. That's coming up next. This is Bloomberg Technology.
Closed captioning of this BNN Bloomberg program is brought to you in part by Scotia iTrade. You have what it takes to start direct investing. We have the rest. Scotia iTrade.
We created these. We're 4 Canadian friends that quit our jobs because we hated our underwear. We couldn't take the chafing, riding up, and constant adjusting. So we spent 12 months creating our own. They're made with a premium modal fabric that's breathable like cotton, but it won't stretch out. And we designed them to contour and support the boys, preventing sticking. We also made it to Dragon's Den and received offers from 4 different dragons. So visit manmadebrand.com to experience ultimate crotch comfort today.
A break in the action. Incoming dishes. Doc. Well, with Dawn Power Wash, he can fly through 99% of grease and grime in half the time.
Oh, migration. Look at him go.
Yeah, Dawn Power Wash is unique. It absorbs grease with 3 cleaning boosters, removing it 5 times faster.
Ooh, for beak's sake. That was fast.
And Power Wash can replace multiple cleaning products.
Power Wash with the assist.
Ooh, those suds got game.
Dawn Power Wash, the better grease getter.
Earn more from investing in Canada's largest banks and life cos. Get high monthly income and enhanced returns with SBC and LBS. Over 15 years of proven performance. SBC and LBS on the TSX.
I'm obsessed with this Olay Hyaluronic Body Wash. With vitamin B3 complex, it's really hydrating. My skin is visibly improved. Look at the Olay difference. It's Olay Hyaluronic Body Wash and Lotion.
A revolution is happening in sports nutrition, and investors are taking notice. Sizzle Brands is seizing a fast-growing market, delivering premium hydration and nutrition worldwide. With a retail presence growing by the minute, Sizzle is expanding rapidly, outpacing all new brands and market share growth. Now trading on the CBOE under the symbol CZZL. Sizzle Brands is quickly shaping the future of sports nutrition.
While the EU remains open to and strongly prefers negotiations, we will not wait endlessly.
That was EU Trade Minister Maroš Šefčovič. Now, trade ministers from the bloc have been meeting in Luxembourg and discussing how the bloc should respond to Trump's tariffs. For more, let's bring in Bloomberg's Michael Shepard. That's the thing about tariffs. They can go both ways. There's a response. What do we know about the EU's position as it stands?
Well, as we heard from the trade minister, they're willing to sit tight for a minute, but not for too long. They want to see how the effects of the latest downdraft in markets play out here in Washington and whether it might cause the Trump administration to start rethinking the levies that they have imposed on the bloc. That is not just the 20% across-the-board tariffs that Trump unveiled last week, but also the measures targeting autos that took effect on Thursday, and then the levies that took effect previously against steel and aluminum. Taken together, they have really angered officials in the European Union and prompting calls for a strong response and a potential retaliation that could take aim at America's biggest tech companies. And this would be through a measure known as the anti-coercion instrument, and that could result in higher taxes, including through the digital service tax against American tech giants, the ones that we know so well, like Meta, Google, and others.
Shep, what's interesting is the EU is going to be watching closely what's just being posted on Truth Social. Trump threatening yet more tariffs on China because of their tough response. So how does the EU navigate not having yet further tariff ire their direction?
Well, Caro, they are really having to walk a tightrope here. And even before his tariffs announcement last week, President Donald Trump warned both China and the European Union in social media posts that he would retaliate against them over any reprisals that they unveiled. And China responded very quickly last week to Trump's across-the-board tariffs, hitting all Chinese goods with heavy tariffs of their own. And because the European Union has waited a moment, they have a chance now to see how that possibility of a reprisal to a reprisal from the U.S. could play out.
I just want to think of materially how this impacts technology companies, right? So, for example, Apple makes some iMac products in Ireland, part of the EU, subject to a 20% tariff. Intel has a fab in Ireland, other facilities in Germany under consideration. Just that sort of physical component, Mike.
Well, it's the physical components, Ed, but it's also the whole demand side question, too. If there's a chill in the global economy, if there's an overall bump in inflation, that will also weigh on global commerce and even anything happening on these shores. If it's imported to the U.S. or even if it's just consumed in the U.S., tech companies, like every other business across the U.S., will start to feel it. A lot of the tariffs are paid here by consumers in this country. It's not just, as the president has liked to say, those countries paying the cost as he sees it.
All stock markets currently down. Shep, we thank you. Mike Shepard there. Look, let's quickly look at how the markets have fared. It's been ugly in Europe, and the Stoxx 600 has sold off in particular. ASML is still off. But we think more broadly about the US, just in gyration mode at the moment. We're off by 0.75% on the Nasdaq 100. We're in a bear market. We're likely going to enter a bear market on the S&P 500. But that does it for this edition of Bloomberg Technology. And we really are speaking once again with Ed Ludlow back in the fold in San Francisco. It's a joy to have you back on.
Yeah, thank you very much. It's good to be back. This is Bloomberg Technology.
standard. Gold dust. Pot of gold, solid gold. Golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Looking for a smarter way to mop? Try the Swiffer Power Mop. An all-in-one cleaning tool that gives you a mop and bucket clean in half the time. Our cleaning pad has hundreds of scrubbing strips that absorb and lock dirt away. And it has a 360-degree swivel head that goes places a regular mop just can't. So you can clean your home faster and easier. Goodbye hassle, hello Power Mop. And with TerraCycle, you can recycle your Swiffer pads.
Stability is one of the things that makes Capital Direct One Income Trust unique and reliable.
If you're looking to invest, then Capital Direct could be right for you.
Our proven track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards, with Class F hitting 10% annualized return and Class A and C kicking out over 9%.
For consistent returns on your assets, find us online
or give us a call.
CapitalDirect.ca.
Stream championship events now. Get a TSN 4-month pass for $60 and go mad for March Madness. Every round to the championship game, the Masters, the French Open, and Wimbledon. Also included TSN Plus. It's 4 months of madness for $60. Subscribe now to TSN, Canada's sports leader. Offer ends April 7th. Visit tsn.ca/subscribe.
There's something real here, right?
Yeah, of course.
What if we don't have kids?
Late Bloomer, new season April 11th, only on Crave.
Hello there, welcome to Berman's Call. Larry Berman is here to take your questions on large cap stocks and ETFs. Let's put up the coordinates, 1-855-326-6266, or email Larry at bermanscall@bnnbloomberg.ca. Larry, thanks very much for joining us. We've seen quite the swing in the markets, the S&P moving into positive territory, the NASDAQ too. We'll put up some intraday charts. What is all this volatility telling you?
It tells me I should be back on the beach in Fort Lauderdale. Listen, the market got hit by, not unexpected, because we knew tariffs were an issue, but the process has been very, very disruptive in terms of how they're going to negotiate with all the countries in the world. We've heard from business leaders, we've heard from market participants over the weekends. Nobody likes this. So I think before Congress steps away for the session on Thursday, I think we'll see something out of Washington or the White House in terms of a better path forward. But I sit here with my fingers crossed like this, because I hope that happens. If we don't have a resolution and Congress is out, it's more market volatility. Now in market volatility, there's always opportunity. And it depends how you look at it. If you want to be an ostrich in the sand and put your head in there and not look, or do you want to look for things that are mispriced? And I think it's much, much better to look at it from that perspective and say, well, what didn't I want to buy a few months ago because it was expensive? Like, listen, NVIDIA dipped below 90 today. That's pretty good, actually. And as soon as that headline came out on, well, we're going to push tariffs back, you know, NVIDIA went over 100. Now it's back again a little bit lower, but still up on the day. So look for the great names that you want to own in your portfolio that maybe you didn't want to own at 140 or 150 that are on sale. And, you know, start nibbling on them. My technical indicators are, I'm going to cover that on the educational part of today's show, are saying as much.
What was the timing factor with Congress that you mentioned, Larry?
So I think it's Thursday that they're out for a month. And we need some kind of resolution here. So Grassley's putting forward a bill. Trump threatened to veto it. You know, we heard some headlines out of the White House, but turns out they were not from the White House. And so that's what we're going to have in the next couple of days. But I think the market's response to those positive headlines is a message for the White House that you can fix this thing. You don't have to let it get a whole lot worse. And, you know, let's do it the right way.
We've the likes of Jamie
Dimon
and
Larry Fink, a lot of them were out
saying, ease up here.
This is not what we voted for, Mr. President. Let's get it done in a very professional way. What he's doing now is completely unprofessional. The way they came up with the calculation for the tariff rates has been completely discredited by just about everybody on the planet except for the White House. So, you know, that's the reality of where and why we're here and why we had record back-to-back down days, you know, in the stock market.
Insofar, though, as Trump's base are lower-income people, do they care about the stock market dropping?
They should care about their jobs, because if the stock market drops to the point where it causes a recession and you get retrenchment in the consumer, a lot of those people are probably going to be out of work. So they should care. They may not care about their 401k. They may not have much of one, but they should care about their employment. It's all linked together.
Have you ever seen anything like this, a U.S. president launching policies that have caused...
Well, I wasn't around in the 1970s. I imagine Watergate. I imagine there's the 60s with the wars. I imagine there was this stuff. It was a different name on the door, different event, but nonetheless, Washington doing what Washington doesn't always do well.
Yeah, I mean, Nixon abandoned the gold standard and stuff like that. And Bretton Woods, of course, yeah, they walked away from that. Yeah, that was disruptive. Yeah, incredible. So I mean, your view, I mean, the stock market, there's buyers and there's sellers. Look out for stocks that you liked a few weeks ago that you thought were expensive.
We've been very cautious through this market melt-up. I sometimes get hate mail when people say, Larry, what are you talking about? Artificial intelligence. I get it all. Now it's cheaper. So let's look for those opportunities now, because this correction, whether it was this as a catalyst or something else, was always going to come. Why? Because it's normal, right? Now, how it happened this time around is different than last time and the time before and the time before, but it always happens. So you've got to always keep some powder dry so that when it does happen, you don't put your head in the sand, you look for opportunities, and you take advantage of the volatility as opposed to fearing it. If you're fearing it today, you just don't have the right portfolio for your long-term goals. You shouldn't be worried by this kind of market disruption.
We're going to get to your phone calls and emails for Larry, and there's that number again, 1-855-326-6266, or there's the email address, bermanscall@bnnbloomberg.ca.
At Capital Group, as one of the world's largest active asset managers, we believe there's an art to managing funds. Our portfolio managers, researchers, and analysts collaborate, each weaving in their unique perspectives, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that makes them worthy of being at the core of a portfolio, so they can make a difference where it matters. Capital Group, actively different.
Herbal Essences is a force of nature, made with supercharged botanical blends. Our sulfate-free formulas deeply penetrate to boost hair health without the Salon Naturals price tag. Herbal Essences.
Invest like a champion with Hamilton Champions ETF CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
The Harvest Diversified Monthly Income ETF. Consistent monthly income. The Harvest Diversified Monthly Income ETF. HDIF on the TSX.
Did you know serums are concentrated with powerful ingredients to visibly improve your skin? Try Olay Super Serum. For 5 powerful ingredients in one, it hydrates, improves texture and evenness, while also firming and smoothing. Try Olay Super Serum.
In today's turbulent markets, Starcore works to minimize risk and maximize shareholder value. Our established management team is unlocking the mystery of the source of mineralization at our producing San Martin gold mine, while using free cash flow to explore our portfolio of advanced assets in Mexico, Canada, and Côte d'Ivoire, Africa. With no debt, Starcore offers investors leverage at every stage of the mining life cycle, from exploration to production. Learn more at starcore.com.
Don't you know what he did?
Email from Dennis. Are there a lot of foreign components in the ZWU ETF? Do you still consider this one as a sleep at night pick? And so this is the covered call utilities, Larry?
Yes, it is. And so as much as sleep at night can be these days, I woke up at 2:30 in the morning last night. You know, it does. It has AT&T in it. It's got some pipelines, Kinder Morgan, Verizon Communications, for example. So it has about 30% exposure to U.S. telecom and pipelines. And then 70% Canadian. So most of your dividend is coming from a Canadian source. But there's about 30% coming from the U.S. So that's the message there. Is it still sleep at night? Absolutely. It's been a very defensive place for me to be in my portfolios. But I'll tell you, Andy, in our sleep at night portfolio, on Friday at the close, we sold some ZWU to get a little bit more aggressive in the portfolios because some of the areas that we've avoided because they were a little bit more overvalued kind of stepped into a little bit on Friday. So inching in, and this was one of the things we sold. Not that it's bad to hold at all, but it was my more defensive holding. And it was a good opportunity to get a little bit more aggressive.
Okay. We have Nazar calling from Scarborough, Ontario. Go ahead, Nazar, please.
Oh, hi, Andy. Hi, Larry. May I have your thoughts on Royal Bank, please? All the big banks have fallen. Is this a good time to pick up Royal at $154 at this time, or wait a little bit more for the market to settle? Thanks for taking my call.
Thank you.
Yeah, so one of the things I bought was rolling out of ZWU into ZWB, which is the covered call banks. But again, it's just a first kind of tranche in, not a full position. But I haven't liked the banks for a number of months at higher levels. Royal's my least favorite here. It's the most overvalued relative to some of the other ones. So I think there's some better values. And a TD, for example, that's been beaten up a little bit over, you know, things that are unique to TD, for example, at the moment. Bank of Nova Scotia, I think there's a little bit better value there as well. So the answer's, you know, sure, a little bit, but I'm not, you know, I would wait a little bit if it's new money and you have some patience. Probably get it a little bit cheaper than where we are here. 130, 140 range, I like it a lot.
Okay. John in Toronto, go ahead, please.
Hi, Andy and Larry. Good afternoon, guys.
Hi.
Thanks for taking my call. Larry, I have a question regarding options. So I have some put spreads on 4 or 5 of the Canadian banks, and of course they're in the money. Expiration time April and May. And what I'm trying to determine right now is the strategy moving forward to neutralize the losses. Would you just roll these to another expiration date, and to June or July, or would you, on the other side of this, write some call spreads to turn these into iron condors?
Okay, so there's probably a little bit more to get very specific. I would need to know from the question as to what might be more appropriate. But it seems like you're hedging long exposure to your underlying bank stocks by owning put spreads. That's great. One of the things I like doing here is actually, buying into weakness. So depending on where the call strikes are or the put strikes are, you would take your profit on the long end where you've protected, expose your naked put to adding to the position. I like doing things like that. I'm not sure what's appropriate for the caller here. You have to look at the price of volatility in the short run, the near-term expiries, versus what you're going to pay to roll those out to the back months. Is that an expensive trade or is it a cheap trade? There's a lot to unpack. It's a great question, but it's not something that I could answer very specifically in 30 seconds, unfortunately.
In a time like this, Larry, though, you're writing any kind of option. Are you likely to get a pretty good premium with this volatility?
Well, that's exactly right. And that's how options are primarily priced, based on the volatility of the market. I wouldn't be selling calls here. Because I think you want to sell calls market's up, not when the market's down. So I would be a little bit patient on that. So you may want to roll them out, wait for a bounce, then sell your calls. Again, I don't know what's appropriate for you and what your ultimate goal is. So very hard to get too specific.
Kai is calling from Toronto. Go ahead, Kai, please.
Hi, Larry and Andrew. Thank you for taking my call.
Pleasure.
Larry, my question is on Microsoft. When I started nibbling away at tech stocks years ago, I heard an analyst here on the channel describe it as the utility stock of tech stocks. And now I'm just wondering, is it a case where the baby's been thrown out with the bathwater here? And would you recommend taking a bigger position on Microsoft? Thanks very much.
Thanks.
So one of the things that I do when I look at it, any stock, is, where's it valued today relative to its 1 year fair value, 3 year, 5 year, and then I kind of make an assessment. So at the recent highs, 450-ish, I didn't love it. I didn't like it. To me, it was very overvalued. Now it's starting to get closer to more neutral value. If we think about it on trend, if I could get a 5-year or chart on Microsoft, that would be very helpful here. Because when you think about the recovery off the 2022 lows, go even further back here, but there's a trend line that's coming up that kind of looks like that. So, for a trader, there's a good opportunity here. We could argue that if this trade things persist, that we could easily think about coming back to some of these levels. I'm not forecasting that because I don't know what's in the president's mind. I don't know how hardball he's going to play here. But that could be a very real scenario. So you've got to judge the quality of the names you want to buy. Microsoft's a great company, don't get me wrong. But I'm very underweight the name. And I would be adding to it a little bit here. But I don't think we're free and clear and stepping in a big way yet.
Is there any...
Because at the recent highs, it was 35 times earnings, very expensive for Microsoft.
Right. Is there any case to be made, though, it's a defensive name among techs?
Not at 35 times earnings.
Okay, yeah.
At 25, okay. At 35, no, sir.
Okay. We have an email from Dion. I was wondering about your thoughts on ZBAL, T-Series. It's targeted to retirees. What about somebody who's got a horizon of 15 to 20 years?
15 to 20 years for the average investor, depending on your risk tolerance. I would argue that you don't need any fixed income in your portfolio because it really depends on your level of risk. ZBAL is a 60-40 balanced portfolio. Most people are taught to think about balance. But what bonds were a decade ago, 2 decades ago, 3 decades ago in terms of what it did for the accretive part of your portfolio? If we're in an era of inflation, and it's going to be more persistent for a decade or two to come because of less globalization, because of tariffs. The bond part of your portfolio is going to fail you. Okay? I would much rather, to manage risk, be in these very innovative strategies. BMO has some of them where they give you all equity potential, but they give you a buffer in it to protect your risk. So it acts like a balanced portfolio, but you get a much better long-term upside potential because it is really all equity. Even though those annual gains are capped, it's going to be a much better way of getting balance or less risk for the average investor than looking at a 60-40 type portfolio.
So you're a skeptic on bonds if somebody has a horizon of, say, 15 years?
Skeptic is not the word, and that is an understatement. I think as a safe asset class, I've been talking about private credit for years. People have got to start moving into that space. Fixed income has been terrible for a decade. It's going to be terrible for a decade more.
We have an email from Ravi. Is there any safe alternative to GICs for sheltering cash for up to 1 year?
Everybody loves their safe money. With the Bank of Canada cutting rates, money market rates are coming down. The government rate right now is 2.75. Their next meeting, they're 60-40 right now, I think, for a rate cut again. So that rate's going to keep coming down. So how can you do better than that? You can get a dividend and get better tax treatment, right? So you want your safe money, it is what it is. There are real no super safe extra yield strategies publicly without an additional layer of risk. So there's no guaranteed investment certificate, but give me it with much higher yield, please. Right? Like those things don't exist. You will get teaser rates. Some of the, you know, tier 2 financial institutions will offer you some premiums to get into those. Those are but then you're typically locked in. You don't have a lot of liquidity. What do you need the cash for? So the answer is no, they're not really great alternatives. There's some ETFs. They used to be these high interest savings premium ones. Government of Canada got rid of all those benefits. So very, very little out there.
Okay, we have an email from Tom. Is it better to have exposure to the private markets by investing in publicly traded private equity firms, for example, KKR or Texas Pacific or Onyx, rather than illiquid private funds?
Yes and no. Can you handle the ride? Bring up a KKR 1 year if you can.
Okay.
Okay, so President Trump gets elected. Less regulation, that was going to be great for PE companies. These stocks rip. And when I mean rip, they ripped. Okay, so I don't see a chart yet, but if you can bring up KKR, great.
There you go.
President Trump gets elected, stocks rip. Oh, tariffs are coming, slower economy. So if you can handle the ride, you'll do better in these in the long run for sure. But don't buy it here. Buy it here, buy it here, and so forth. So I like it now. I'm nibbling, I'm adding to positions here where we have exposure in some of the public companies that are played in the private equity space. But you have the full volatility of markets, you have the liquidity of markets. It's not the same when I'm saying get into private equity or private credit. When I'm talking about those are vehicles that price monthly, quarterly, annually. You lock up, you earn a illiquidity premium, and you get a much smoother ride. You act like a little bit more like a pension plan in terms of incorporating that stuff into your portfolios.
We're going to take a break. Coming up, Larry's educational segment.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
I know.
Is this yours?
Yeah, Ma.
No way. Yes way. Get in.
There's nothing like that first Mercedes feeling. Experience the feeling yourself at a local Mercedes-Benz dealer.
Head & Shoulders Bare. Clinically proven dandruff control with just 9 essential ingredients. No sulfates, no silicones, no dyes. Dandruff control. Minimal ingredients. Job done.
Invest in high-quality dividend growth stocks. Get high monthly income and enhanced returns. Add these top-performing dividend funds to your portfolio. DGS and GDV on the TSX.
Dry, brittle hair? Need some intensive care. New Pantene Damage Repair Collection. Our formula with provitamins, argan, and jojoba oils regenerates hair bonds at the molecular level for healthier hair at a fraction of the cost. Pantene.
We serve Canada's wealthiest investors. Center Wealth Partners of CG Wealth Management deals with investors who have $10 million or more of liquid investments. Contact us today in complete confidence. We'll be here when you're ready.
A diaper this leak-free sets them free. Only Pampers Cruisers 360 have a 360 stretchy waistband for up to 100% leak-free fit on every wild child. Pampers Cruisers 360. Live wild and free.
Closed captioning of this BNN Bloomberg program is brought to you in part by Scotia iTrade. You have what it takes to start direct investing. We have the rest. Scotia iTrade.
Time for Larry's educational segment. Take it away, Larry.
Andy, you might remember about 5 years ago, we started publishing the Berman's Call Pro Eyes indicators, and it was a website we put up under the Berman's Call website banner. And this was an indicator of 20 different market-related ways of measuring sentiment, tactical trading, market valuation, business cycles. And we spent a couple months actually educating people about it. I haven't talked about it in quite a while because I've been very, very cautious. The indicator has been a bit defensive. But this weekend, and we update it once a week, and it's designed to be like the CNN Fear and Greed Index. Market starts correcting last couple weeks. Last week, very intense. This indicator takes all the 20 different factors and then says, should we be cautionary? And for the most part, late last year as the market was rallying, it was like cautionary, don't chase this thing. There's some valuation issues, and the momentum was waning on us.
So when it goes up, it's sounding a cautionary note.
It's cautionary.
Okay. Yeah.
Now, in 2022, COVID, we can go back and look at the flash crash. We can look at all the corrections over history and say we're now in an area where there's much more opportunity. And that's what I was saying at the top of the show. So start putting your favorite names on the front burner, looking to add to them during crazy days, right? And so the overall index is, but keep in mind, it could be a couple of quarters of this, up and down, up and down. What the indicator doesn't tell you is how long it's going to last. It just sets the environment. So we're oversold enough for a trading rally. Let's look at just the technical component, because we have valuation, we have business cycle, and then we have all the trading tactical indicators. So this is our trading one. We're based on technical indicators, and it's as oversold as it ever gets, setting up for a trading rally. So I think we're set up for a bounce. We do need the headline out of the White House or Congress to say, we're going to do this a little bit better. And as we saw this morning when that headline hit, markets ripped.
A false belief that he was going to postpone the tariffs.
Right, that one.
Or he was open
we need
to
a
it,
real one.
Yeah, exactly.
Right?
Yeah.
So we'll get a bounce here, but it's probably going to be to a much lower high. The biggest resistance is going to be around 5,500. So where we broke down from just a few days ago after his wonderful tariff news. So bounce is probably limited to 5,500 at this point over the next months at least, unless we really solve this thing. But technically, we're very oversold. Last chart here, if we look at the levels, so overnight futures contracts, so this is looking at the S&P 500 futures from the 2022 bottom to the high earlier this year, the whole bull run, we retraced overnight 50% of the rally, big technical level. It also happens to be the high from 2021. So from the high in 21 till last night, Markets made nobody any money. Lots of movement in between. So we now have this good support. We're very oversold technically. It's a good level to buy into, but it may not hold. I don't know for sure. There are other support levels, next one being around 4,500. And if you're really cautious, somewhere in the low 4,000s is where we could end up if they don't play their cards right here. So it's not a free and clear, but it's a tradable rally here. And I think for the traders out there, not a bad opportunity.
Larry, thanks very much indeed. Let's just remind you where you can follow Larry online. He's on YouTube, he's on LinkedIn, and his websites are etfcm.com and qwealth.com. Larry returns every Monday at 3 p.m. Eastern. You can get your questions in right now. Email us, bermanscall@bnnbloomberg.ca. The close is up next.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
Explore tastes of tradition with modern notes and food as vibrant as the scenery. Explore more flavors. Visit Malta.
Stability is one of the things that makes Capital Direct One Income Trust unique and reliable.
If you're looking to invest, then Capital Direct could be right for you.
Our proven track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards, with Class F hitting 10% annualized return and Class A and C kicking out over 9%.
For consistent returns on your assets, find us online.
Or give us a call.
CapitalDirect.ca.
Oh, it's mesmerizing.
I can't look away.
Cleaning that greasy mess?
And not even scrubbing.
Well, fluff my feathers.
Dawn Platinum is bringing it.
You know it. It cuts through the grease better than their old dish soap.
Keep quacking.
Platinum breaks down the slimy stuff it would leave behind, removing 99% of grease and food residue. That's why only Dawn is trusted to save wildlife.
Yeah.
I'd fly south for a clean like that.
Dawn Platinum, the better grease getter.
For the 4th consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Hi there, welcome to The Close. I'm Andrew Bell. Markets closing in half an hour. Let's see how they're doing right now. After an initial plunge, U.S. stocks then turned up. You can see Toronto still down, north of 1%. Of course, oil prices near 4-year lows. That's not helping today. Let's have a look at those U.S. markets. And the S&P, now it's down. The Nasdaq and the S&P only about an hour ago were in positive territory. We've had wild swings throughout the session. Speaking of which, let's have a look at the volatility index, and you can see spiking and going pretty stratospheric. We have a packed show for you. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. The province of Ontario is providing $11 billion in relief and support for workers and businesses affected by the U.S. tariffs. Premier Doug Ford says that as a first step, the province will defer select provincially administered taxes for 6 months, including the employer health tax. Ford also says the province will break down internal trade barriers by speeding up timelines and approvals for development, as well as diversifying trading partners. And we are going to hear from Ontario's finance minister shortly, so stay tuned. The federal government has initiated a dispute with the World Trade Organization regarding the 25% tariffs the Americans have put on autos and vehicle parts from Canada. Ottawa says the measures are inconsistent with U.S. obligations under various provisions of the General Agreement on Tariffs and Trade. Canada has since imposed its own retaliatory 25% tariff on U.S.-made vehicles that don't comply with CUSMA, which is North America's free trade agreement. U.S. President Trump is threatening to impose an additional 50% tariff on China starting in just 2 days, April 9th, if Beijing doesn't withdraw its own 34% retaliatory levies by tomorrow. Trump also says all meetings with China would be terminated. Now, this move comes as China accuses the U.S. of unilateralism, protectionism, and economic bullying with tariffs. That nation is calling on representatives of American companies, including Tesla, to take concrete actions to resolve the dispute. Right, so North American stock market swinging again today. We did see, though, this afternoon, the S&P 500 and the Nasdaq moving into positive territory. Let's get more from Martin Pelletier, Senior Portfolio Manager at Wellington Altus Private Counsel based in Calgary. Martin, great to see you. Always great to get your insight. The Trump administration, Trump's team say, well, look, businesses will adjust. That's what businesses do. So the sun's going to rise tomorrow. We don't have to subsist on canned goods. Are you interested in stocks right now? Are you buying or are you staying clear?
We're not buying yet, but doesn't mean we aren't sharpening our pencils here. I don't think the market's hit the bottom. You still have retail that have been strongly buying these dips. Credit spreads are still holding up. And 10-year yields, if you look at the U.S. 10-year yield, still went back above 4%. So there still is that tail risk that can still hit the markets. And so we don't know how that's going to shake out. Should this be a longer-term structural shift? That doesn't mean that there aren't opportunities out there, but you have to be very careful not to catch a falling knife.
When you say credit spreads, meaning that corporate bonds, people are still willing to accept modest yields on corporate bonds despite the risk?
Yeah, and even high yield bonds, junk bonds, the yields are not compensating for the amount of risk out there. If this is a pervasive trade war that goes on longer than what many are expecting, and it's not an art of the deal negotiating tactic, then there could be some more downside and some serious tail risk here. And so bond markets are not telling you that at this point in time, and so we're just being a little cautious. But have our trades lined up. So if we get continued volatility, then we can start layering in.
The Prime Minister, or should I call him the Liberal leader, Mark Carney, stating the obvious. I guess that's the thing central bankers and ex-central bankers do. If America goes into recession, we'll suffer. What is your view on investing in Canada right now?
Yeah, so we have to be careful about stock markets and economies because sometimes they'll do different things. I do think Canada is going to be more exposed. We saw that with the job numbers last week economically, and we just don't have the means to compete against the U.S. Our productivity is low. Our GDP per capita is still abysmal. So from that standpoint, it's not a high growth economy. However, that said, there are some good companies here that are somewhat isolated and protected due to their oligopoly type of structures, due to their pricing structures. So some of the Canadian utility sectors, the healthcare, looking at the banks, they've sold off a little bit here. And so I think there's potential for Canadian TSX companies to do better than the U.S. just because of the very nature that they didn't participate in the growth that we saw the last 2 years, but they're also not getting hit the hardest. due to these tariff risks.
What about oil? What's your thought there? Oil not far off 4-year lows.
Yeah, that one's really been interesting. I went out to Vienna and met with OPEC, which was really fascinating. We had pulled back and reduced our energy exposure in January, fortunately, significantly by 50 to 60%. And so I was getting a few jabs from some of the other people that were attending this event in Vienna about me being a little bearish. Unfortunately, that's worked out okay, and I didn't want to be right. But if this recession does turn into a recession into the U.S., that's going to impact U.S. oil demand, and they're the biggest consumer. And so Trump does want lower oil prices. So maybe it wasn't a coincidence that OPEC announced an increase in output at the same time Trump wants lower oil prices. Who knows? I love conspiracy theories. And so that's going to impact the sector, and it's been hit pretty hard. Having said that, you got companies like CNQ, Canadian Natural Resources, their break-even oil price is at $40 US a barrel. We're still at 60. Maybe U.S. shale companies can't make money at 60, but Canadian companies sure can.
Yeah, and I mean, if you buy CNQ now, I'm just checking the yield. You lock in that pretty solid yield. I mean, we know Murray Edwards will be loath to cut it. Yeah, a yield of about 6% today.
Yeah, no, that's a good dividend. And they've got a strong balance sheet to be able to maintain that. Oil prices, even with oil prices at $60, they're generating some good cash flow. Oil differential is still half decent in the Canadian dollar. I mean, you guys get paid in U.S. dollars. So that's one of our ones that we're looking at adding on our list here should it continue to sell off, because we already reduced our exposure, as I had mentioned. It's tempting to get back in again, but we'll have to play that by ear.
A lot of your client base are people in early retirement. So I guess in a lot of cases, they have 20 years or more to go before they stop getting interested in money. Let's put it that way. So you think sometimes, are they too risk averse?
No, so it just depends. A lot of like our clients per se have taken a lot of risk, and they've generated a significant amount of wealth through their careers, being professionals or being entrepreneurs. And so if they can get, 6, 7, 8% returns and mitigate the downside as much as possible, then their lifestyle is not being impacted during retirement. So they can still do their trips, maybe not going to the US anymore, maybe going to Europe. So it's just a whole different mindset and a different philosophy. And, they're thankful for, we're not getting any calls, so thankful for the risk management during times like these, because they don't have to worry about cutting down on their spending or their trips because of markets. And, that's not a bad place to be. For younger investors, you probably do want to take a lot more risk with your portfolios. If you've got if you're in your 30s and you want to save up for a home, and well, in Canada, that's going to be a tough job. But all of a sudden, markets are that much cheaper.
It's interesting you mentioned travel. Mike Bird, who is the Wall Street editor for The Economist, has just retweeted a chart from Goldman that he says shows a slump in overseas passengers arriving to the U.S. He reckons some of it is who wants to be harassed at the border. But in any case, maybe we could put up Air Canada. Do you think Air Canada will have to update its disclosure on weakness in U.S. travel?
I think all of them are going to have to do that and readjust their flight routes. There is some anxiety to be justified. My son is going to Oregon in 2 weeks, and he's 19 and a young whippersnapper. And if he was like me at 19, then I'd be in a world of trouble down there. So we want to be careful about that. And I think other parents and other people are asking the same kinds of questions, and they're redirecting their travel to other jurisdictions. And I can't blame them. So, yeah.
Yeah, I just had a daughter fly to California, and we were apprehensive, but she landed safely, I'm glad to say. Yeah, I told her not to provoke them in any way. Leave us with a final thought, Martin. Do you think Trump, you touched on this at the beginning, do you think Trump and his team will back down in some way here?
I do. This is not a long-term Brexit type of situation, in my opinion. But it's going to last longer until we start to see. We're still in the early innings per se, and there's going to have to be some more pain and negotiations to be had before we get to where we get to. And so that means markets probably have some more downside. But I mean, he can't be that stupid, to be honest. I'm going to use a strong term there, because if this continues indefinitely, it will really be quite painful to the U.S. and the U.S. consumer. And so I don't think we're going to see the full extent of what's being talked about. But there's a big stick being waved around right now, and that's going to continue probably for the next couple of weeks.
Martin, thanks very much indeed. Martin Pelletier, Senior Portfolio Manager at Wellington Altus Private Council in Calgary. Up next, we are going to talk to the Ontario Finance Minister about the impact of the US tariffs and the provincial government's proposal to spend billions of dollars, maybe $11 billion, to help businesses and workers who are affected. That's ahead.
The Close is brought to you by Enterprise Mobility. We find roads that take your business new places.
Introducing the Brompton Cash Flow Kings ETFs. Investing in high cash flow yielding companies, putting their power to work for your portfolio. Brompton Cash Flow Kings ETFs. Because cash is king.
Sometimes business travel takes you to London, Paris, New York, Rome, Beijing, or Hawaii. And sometimes to Palawan, Mimaropa. Here at Book a Limo, we think globally. We think business, your business. It doesn't matter where you go. No place is too far. We're there for you.
What's your destination? Book a limo. Any car, anywhere.
Thousands of Canadian businesses don't have access to the support they need. BDC is committed to opening the way. Breaking down doors for entrepreneurs. We're on it. BDC, financing, advising, know-how.
Explore new horizons and cities with centuries of tales to tell. Explore adventure from coast to coast in the heart of the Mediterranean. Explore more stories. Visit Malta.
Can make you smell kind of funky, but aluminum-free Secret Whole Body Deodorant gives me 72-hour whole body freshness. For long layovers, surprise gate changes, and heavy luggage. And it's totally middle seat approved. Secret, no sweat.
Ontario is offering what it says will be $11 billion in relief for businesses and workers in response to these U.S. tariffs. Now, this country already faces duties on steel and aluminum, and of course, the Americans have gone ahead with levies on autos and parts not compliant with CUSMA, and that's a deep interest and perhaps ominous for Ontario. We're joined now by the Ontario Finance Minister, Peter Bethlenfalvy. Thank you very much indeed for joining us, Minister.
Pleasure, Andrew.
So you're not going to be writing checks, it looks like here. It's going to be deferring taxes. 9 billion of it, I think, will be deferring taxes. I guess, is this cancelling taxes from April 1st to October 1st?
Look, it's $9 billion of tax deferrals. We've done this before through COVID with great effect. What that means is we have provincially administered taxes like employer health taxes, gas tax, a whole bunch of things. And what we're telling companies is that they have the ability to defer those taxes for 6 months. They know their businesses really well, so it's a tremendous amount of liquidity and financing relief that they can have over the next 6 months. And this is in combination with the WSIB, the Workmen's Safety Insurance Board assets that we have, giving $2 billion of premium rebate to businesses that pay into that. So this is real money at a time when there's a lot of uncertainty, as you know, Andrew, as you're reporting out every minute, and providing some certainty and relief for businesses.
So the $9 billion, though, is just a deferral. Those taxes will ultimately be payable?
That's right. They'll continue to collect them. The federal government has announced their 3-month corporate tax deferral. This, like I said, we've done this before with great effect. It's endorsed by many businesses and organizations to do this because it means that they can manage their payroll. This is basically interest-free, effectively borrowing for 6 months on the $9 billion. And of course, it goes along with other measures that we continue to work on. Obviously, interprovincial trade barriers, which are removing those. Where our government has taken a leadership role on removing those, will be good for the jobs and businesses in Ontario. And of course, working with the federal government, they've got a lot of programs as well, but particularly the retaliatory tariffs, which will generate billions of dollars. Those will be earmarked for those impacted industries and workers in the auto sector, steel, and beyond.
And then the $2 billion in workers' safety credits, that's a permanent thing, though, the $2 billion rebate there.
That is. We've done about $3 billion over the last couple of years. This is because we have a surplus in the fund, and we can give it right back to the businesses. They pay into the fund. It's their money. We have a surplus. WSIB board, they manage this, and this will be a rebate that will be paid back to the businesses that put contributions into the WSIB. So that's $2 billion. That's meaningful money at a time when businesses need it.
But is this going to be targeted? I mean, will you be targeting this tax deferral and the health rebate to, say, auto firms, or will it be for all firms across the province?
Well, let's unpack the two. The deferral unpacks about 80,000 businesses, so they'll get to choose whether they need that type of relief or not. So that's a very effective way of providing relief to those who are impacted and need that kind of deferral and relief over a 6-month period. For the WSIB, that's for companies, a much larger cohort who pay WSIB premiums. By the way, benefits have gone up, so we're making sure that benefits are not impacted. This is the independent board who's deemed that they can give some of this money back out of the surplus that's been generated.
Maybe I didn't put it very well, but say firms that are not directly affected by the tariffs, will they get the deferral, for example? It seems a bit...
They can choose to, yeah, because even though, Andrew, they may not be directly impacted, there may be a second order, a third order impact on their business. We don't want to micromanage that.
Yeah.
They know their businesses best. They know if they need some temporary kind of bank liquidity type relief. That's what this is. So it gives them maximum flexibility.
So this is not like the helicopter money we saw during COVID, for example, money that was just dished out to consumers and businesses.
No, this is not helicopter money. We're not in the business of helicopter money. We're in the business. By the way, Andrew, the reason that we can do things like this is because we've been managing the borrowings of the province and the deficits in a very prudent way over the years that I've been finance minister, and since we took power in 2018, we saw 2 credit rating upgrades on our provincial debt in the last 12 months, one in June and one in December. So what that means is our balance sheet, the fiscal situation of the province is in the best shape it's been in some time, in decades, basically. We're borrowing costs are the lowest, which means that we're in a much stronger financial position to protect this economy, to support the jobs and the workers. And this is just one measure out of many that we've either already rolled out, we're rolling out now, or we'll continue to look at. We're going to use every tool in our toolkit.
Although I know the Fraser Institute says that provincial tax revenue has been rising as a percent of the GDP. 2003-04, it was less than 10%. But they say the most recent forecast is it's going to top 13% of GDP. So you are apparently taking more out of the economy in taxes.
Well, you know what I think? If the economy is growing, that's a good thing. And we've never raised a tax or a fee in the province. In fact, just the opposite. We've been cutting taxes, gas taxes, integrated fares for our transit riders, taking off driver's license stickers. So we've been doing a lot of things. We've been reducing taxes and fees. And what a concept, that the economy grows and everyone benefits. And by the way, some of the metrics that the market looks at, like debt to GDP, which is a barometer of fiscal health, it's the best that it's been in over a decade. So we've got an economy growing. We've got financial metrics that are the strongest in over a decade. And we're in a position, which you should be. That's what we're here for when circumstances like the markets are doing what they are in this trade war, that we're in a position to help.
We better jump. Minister, thank you very much indeed for giving us the time.
My pleasure, Andrew.
Peter Bethlenfalvy is the Finance Minister of Ontario. Coming up, we are going to bring you the latest on the federal election campaign. Stick with us.
How's your fixed income fund performing? Compare the 9-point diversified bond fund, ranked in the first quartile in the Morningstar Global Fixed Income Market category for 1, 3, 5, and 10-year performance. 9-point, your advantage.
Too slow. Saw you and it only took a second for me to know. Hey. That I want you bad. I tell you before you know.
The 2025 Infiniti QX60 now get 0% for up to 36 months. Includes loyalty rate reduction and multiple security deposit requirement.
At Canadian Gold Resources, we're building shareholder value 3 ways: assets, projects with double-digit gold grades in Quebec's high-grade Gaspé Gold Belt, and highly prospective interlocking faults. Innovation. Our upcoming bulk sample is projected to deliver $9 million, enabling substantial year-one and subsequent dividends, rarely seen in juniors. Execution. Led by Ron Gauguin, founder and former chairman and CEO of Major Drilling. Canadian Gold Resources, breaking new ground in gold discovery and yield potential.
What keeps baby's skin healthy? A diaper that doesn't leave skin wet. That's why Pampers Swaddlers absorbs wetness better for up to 100% leak-proof protection and 0% skin irritation. Pampers, for healthy baby skin.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF, Mulvihill.
Old Spice Super Hydration Body Wash. The sweet scent of a honeymoon in Fiji. Moisturize with vitamin B3.
You better not be using all the Old Spice.
Ooh, can you get my bag?
Let's get an update on the federal election campaign from Bloomberg's Canadian government reporter, Brian Platt.
Both Mark Carney and Pierre Poilievre are campaigning in Western Canada today. Carney is spending the day in British Columbia, and Poilievre is starting off in British Columbia and then heading one province over to Alberta for a rally in Edmonton tonight. And both of them have announcements that are framed around Donald Trump and Trump's trade war and the threat that he's posing to Canada's economy, but each are taking it in a bit of a different direction. Carney's announcement today is focused on retirement savings and fairly minor changes overall. One of them is a small top-up to the guaranteed income supplement, which is for low-income seniors, 1 year 5% top-up. And then another rule change just to give seniors a bit more flexibility in how they use their retirement savings. Carney is framing this around the turmoil in the stock markets, and for seniors who are worried watching what's happening to their portfolio right now and their retirement savings, Carney is pitching this as a way to give you a little bit more confidence confidence in your savings and your economic position overall. And Pierre Poilievre is focused on resource projects and strengthening Canada's economy through making it faster to build, to approve and then build resource projects in the country. In particular, he wants to streamline this, make it so you only have to get one approval instead of going through both provincial and federal steps, and to try to speed up how that happens with a 1-year limit. And really what he's aiming for, he says, is the target of 6 months to approve a resource project. He has a list of projects that he cites that he wants to see get built quickly, but the top of the list is LNG Phase 2, which is the big LNG plant, LNG Canada Phase 2, I should say. It's the big LNG plant on the West Coast that's supposed to start exporting LNG later this year. This would be a doubling of that project, so quite a significant expansion. And then also in the oil sands, Suncor's Base Mine extension. Poilievre says he wants to see that sped up. And there's a list of other projects he cites as well. So both of these announcements are framed around, again, Donald Trump and the threat that he's presenting to Canada's economy. But each candidate's taking it in a little bit of a different direction today.
That was Bloomberg's Brian Blatt. Up next, we've got the closing bells on Bay Street and Wall Street.
What's the Wi-Fi?
It's AX lamp, lowercase p, capital 7.
Capital 7?
My internet. Well, the modem is in the shop.
Better not. I have an internet intolerance. My Wi-Fi gives me rashes. You have fishnet?
Old Spice Swagger's freshness makes me smell good, so Coach thinks I'm slacking. So I took my Old Spice, worked very hard, and became the best player ever. Sometimes, a man must overcompensate for his freshness.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
Your home is your happy place. Until you come back to bad odors. Use Febreze plug-in with Fade-Defy technology. It has 2 complementary scents that alternate to constantly fight odors and give noticeable freshness. It even reminds you when to refill, so you can always be sure that your home smells fresh and clean for up to 50 days. Enjoy the freshness of Febreze plug-in and try a warmer now for 99 cents.
Closed captioning of this BNN Bloomberg program is brought to you by RBC Global Asset Management. Let our global reach take you further.
It's the end of the trading session. Doing the honors at the TSX, it's South Bow. That was the spin-off from TC Energy, and it carries an awful lot of oil through its huge pipeline system every day. The regular session is over, but we on the close are just getting warmed up. And there you have it. The Nasdaq eking out again. That's E-K-I-N-G, not E-E-K-I-N-G. You sometimes see that mistake made. The S&P narrowly down, but earlier this afternoon it was positive. So we saw this pretty big swing intraday in the markets. They opened down, certainly south of the border they recovered, and then they're ending flat. Let's call it the TSX coming off the lows of the day. Let's check out some stocks of interest here. Shopify, one of our technology flagships, that stock rallying today. So we did see the US tech stock showing some signs of life. Let's have a quick look at Tesla, because that's such a bellwether for sentiment right now, and politicized because of the role of the CEO, Elon Musk, in Mr. Trump's administration. Tesla, no joy there. You can see the stock now down 40% in the past year. Let's have a look at a couple of big energy stocks. CNQ, one of Canada's biggest energy producers. It may actually be the #1 overall energy producer. That stock down, hardly surprising. We did see a bit more weakness in oil today. Crude now near the lowest in 4 years. And finally, let's have a look at Royal Bank. Oh, thanks, control room. Yep, oil down another 2% today. That's amazing. It's not so long ago oil was not far off $80. And there's Royal Bank. And our market is always going to struggle on any day when Royal Bank is under pressure. Let's get some more on the tech stocks south of the border. Apple has not proved to be a good refuge for investors. We're joined now by our Bloomberg equities reporter, Ryan Vlastelica. Ryan, thanks very much for giving us the time. Update us on the tech stocks, if you would, please.
Good afternoon. Thanks for having me. There's been a lot of volatility over the past several days. There's been a couple of names that have sort of rebounded after some pretty sharp weakness, but Apple is not one of them. That stock had another pretty negative session today. I'll have to check where it closed, but earlier it was looking at its biggest 3-day drop since before the iPod was released, just to give you a sense of how dramatic and historic this sell-off has been. It's lost about 20% or so over the past 3 days. It is really seen as at the center of the tariff-related risk in U.S. equity markets. It does so much of its manufacturing in China, in Vietnam, in countries that are really being hit with all these extra tariffs and the retaliation. It's really seen as a place that has a lot of risk facing it right now.
Yeah, the Wall Street Journal, I'm not sure if you saw that, calculated that an iPhone made in America would cost 50 or 60% more. So China is so much part of their business, both as a market and a manufacturing center.
Absolutely, and that's sort of the issue here right now. Either Apple has to absorb all of these higher costs due to the tariffs, which of course has a real negative impact on margins and earnings, or maybe it has to raise prices in order to offset some of this, but of course that is going to be a big hit on demand potentially. How many people want to pay 50% more for a new iPhone? So maybe they go somewhere in between the two, but right now there's so much uncertainty about all of this, uncertainty about what this really means for the stock, for the profits, for the margins. People are really just selling right now and just waiting for a little bit more clarity.
What about Tesla? Obviously, Tesla's at the eye of the storm here because Elon Musk is so close to Trump. Although it's interesting, I saw a headline on Bloomberg today. India seems to favor supporting Tesla as a big manufacturer in that country over China's BYD.
Well, Tesla is also facing a number of issues right now. You mentioned Elon Musk. He's become, even more controversial in recent months, given Doge here in the United States. There's been a lot of sort of brand, the way people view the brand has really deteriorated according to a lot of surveys and analysts. It is facing increased competition out of China with all these other new EV makers. So in addition to facing its own tariff-related risk, that is something that, there's a lot of stuff that's swirling around that stock. And like a lot of the so-called Magnificent Seven, a lot of them had high multiples, and there's just a lot of reasons for people to be selling right now, especially just given how well they had been performing up until, the recent news.
Maybe we could have a quick look at Meta, because I'm curious about Meta. They've invested so heavily in AI. They are seen as one of the big winners, maybe, in AI. I know there's a suggestion that Amazon and Apple have been laggards. Yeah, Meta Platform's up a bit today.
Yeah, again, these are all stocks that have been incredibly volatile. Meta fell very sharply over the previous 2 sessions. These kinds of internet media stocks, they're not as directly impacted by the tariff situation here. You know, you don't really put tariffs on online advertising or anything. So there might be some insulation from that. But, you know, these are the kinds of companies they've done so well over the past few years. It is a very natural place for people who are looking to take some risk off the table, looking to lock in some profits. These are the kinds of names that you would go with first and foremost. And just I'll note with Meta, I know they had a 20-day rally earlier this year, an absolutely historic run for them. They've given all that back and more, but, you know, these are stocks that have been doing quite well. Like I said, it's a natural place for a lot of people to be taking some profits right now.
We'd better go. Ryan, thanks very much for giving us the time.
Thank you.
Bloomberg reporter Ryan Blastelica. Okay, up next, we are on the hunt for tariff-proof investment ideas. We're going to talk to portfolio manager Colin Stewart.
Want to get the most out of one sheet? Grab Bounty. Bounty is made to be stronger and more absorbent. So each sheet keeps working, even when wet. It's inspired by a dishcloth, and you can ditch the mess when you're done. Bounty, the quicker picker-upper.
Earn more from investing in Canada's largest banks and Lifecos. Get high monthly income and enhanced returns with SBC and LBS. Over 15 years of proven performance. SBC and LBS on the TSX.
Most men over 40 look into the mirror and see this, when they could be seeing this. Most men over 40 look into the mirror and see this, when they could be seeing this. Most men over 40 look into the mirror and see this, when they could be using this. Particle 6-in-1 Face Cream for Men, the first of its kind anti-aging cream designed specifically for men. Fights the look of eye bags, dark spots, and wrinkles. Visit particlemen.ca and use the promo code on your screen to receive 25% off your entire order. Plus, we've got free shipping and a 30-day money-back guarantee. www.particlemen.ca, because seeing is believing.
Markets swinging, to put it mildly, today with this escalating tariff war and, of course, recession fears. Let's get more from Colin Stewart, CEO and portfolio manager, JC Clark. It's hard to understate the volatility here. I mean, it's just up and down.
Yeah, pretty wild. It's we haven't seen this in a while in equity markets, that's for sure.
I should say it's hard to overstate the volatility. Yeah, you say you were on the phone there with a client and the market was down. You came back and it was up.
Yeah, it seems like constant tweets and rumors and denying rumors and et cetera. But yeah, I mean, we're reasonably defensively positioned and you know, don't expect this to necessarily end quickly. I mean, I think we're now, unfortunately, not only are we, you know, seeing some of the economic data weaken, we're seeing, I think, consumer confidence weaken, and that's sort of flowing through to, we've seen some airlines, for example, cut guidance outlooks on people not traveling as much. I think it's going to hit some of the consumer discretionary areas, and I think business confidence is weaker as well, which could, you know, we haven't seen a lot of M&A deals recently, and I think you can, you know, it's understandable if you're the CEO of a company or a board, you're probably unlikely to authorize a large acquisition of another company or a huge new capital project or something like that when there's this constant level of uncertainty and just, you know, who knows where we're going to be, let alone 2 or 3 months from now, who knows where we're going to be next week. So I think that's, you know, really put a pause on some of that M&A activity and you know, I think consumers are maybe, you know, pulling back a little bit and being a bit more cautious.
Meanwhile, though, it seems people do expect inflation, which is an ugly scenario.
Well, exactly. If we have slowing economic growth and inflation expectations, as you suggest, have moved up a little bit, it really puts the central banks and the Fed in a tough position because they're unlikely going to be in a position to come to the rescue, as they often have in other crises, and cut rates quickly because of that worry that inflation could be higher, and people talking about stagflation. But listen, I mean, we have seen a correction in the markets, particularly the U.S. markets, and I think stocks are in the U.S. I think still a bit pricey, but they're getting cheaper, and ultimately I think there are going to be some good buying opportunities created out of this. We just don't think we're there yet.
Later on the show, we're going to be talking to Jared Bernstein. He was a top advisor to Joe Biden, the former U.S. president, and he's going to talk about, well, Trump, of course, trying to jawbone the Fed into lowering interest rates, but he's going to talk about the risk of stagflation.
Yeah, it's really one of the worst economic outcomes. We haven't seen that, in a long time, since the 1970s, I think. And it's, if you have slowing growth and high inflation, central banks can't cut rates, as we've seen, as I said, in other crises like during COVID or during the financial crisis. So, and it puts a lot of stress on the consumer, particularly the low to middle income consumer. So, I think investors should really focus on more defensive sectors right now. Look at investing in businesses in the consumer staples area, utilities, companies that pay dividends. Those are sort of the areas that we're focused on.
You have a couple of ideas for us. Jameson Wellness, they're big in supplements and vitamins.
Yeah, they're one of the leading vitamin, or really the leading vitamin brand in Canada. You go into any Shoppers Drug Mart or Loblaws, you'll see their products prominently displayed on the shelves. And, they also have a very strong and growing business in the U.S. and China, which are small, but, growing very rapidly. And they've got a trusted brand, strong management, and the stock's down 16, 17% year to date. And they really don't have much in the way of impact from tariffs. So we think that that sell-off is unwarranted, generating a lot of free cash flow, pays about a 2.8% dividend yield, and the valuation sort of down to, a pretty low level for a company of this quality. And again, I think it's really an essential product. There's a, continued focus with consumers on health and wellness. It's not necessarily something that consumers are going to cut back on a lot or change their, habits from a health and wellness perspective if we have a tougher economic environment or, the market's selling off. It's not something people are going to skimp on, and I think it's a well-positioned business.
I'm just thinking Dr. Oz was appointed to a pretty senior role in the Trump administration. He's famous for his keenness on some supplements. We haven't heard much about him, though.
No, it's been eerily quiet.
Yeah.
You're right, Andy. I haven't heard much about Dr. Oz recently, so who knows where he is.
Yeah, but Robert F. Kennedy Jr. makes up for it. Yeah, yeah.
Yes.
And also Superior Plus, they're big in the propane business, for one thing.
Yeah, again, it's another example, I think, of a reasonably defensive business that investors can buy in Canada. The stock sold off quite a bit last year due to concerns about a dividend cut, and then the company ultimately put in place a very large dividend cut to focus more on buying their shares back and de-levering the balance sheet. But at the end of the day, it's really an essential business. They provide propane for heating to customers who don't have a aren't near a natural gas pipeline and need to heat their homes in more rural areas, cottages. They also have a compressed natural gas business where they deliver compressed natural gas to industrial customers. And so there's a new management team in place that I think are doing a good job. They're slowing down the M&A, focusing on optimizing pricing, optimizing their routes and density, and doing a better job at just the blocking and tackling of the business. And they had an investor day just last week and came out with some very positive guidance around 2026, 2027 estimates. And the expectation is the free cash flow in this company is going to go up very significantly in the next couple of years. And we think that's going to be very good for investors. And they're also buying back a lot of stock. And it's, as I said, a defensive business that even in a tougher economic environment, we think should do pretty well.
Stagflation reminds people of the 70s. And of course, there were years of lousy returns from the stock market in the 70s. So I guess that's got to be at the back of people's minds.
Yeah, and I think, again, that's in a tougher environment like this. I think looking at value stocks, companies that trade at lower multiples tend to hold up better in a period of inflation. Businesses that offer essential products, which we think both Jameson and Superior do. And I think having a company that pays a nice dividend is also a good supplement if the stock isn't going going up a lot, at least an investor might be able to collect a 2, 3, 4% dividend yield while they wait. And we think, those are the types of investments people should be focusing on in this environment.
Yeah, apparently Dr. Oz did just get confirmed by the Senate to oversee Medicare and Medicaid. Yeah, I mean, he's a surgeon, he's a legitimate doctor, but he has espoused some
strange views.
Green algae supplements or something in the past. Thank you very much, as ever, Colin. Yeah. Colin Stewart, CEO and Portfolio Manager, JC Clark. The federal Liberals' advantage in the polls over the Conservatives has narrowed to 5 points as of day 16 of the federal election campaign. We got more from CTV's Scott Hurst.
3 weeks to go until Canadians make their votes official on Election Day, and it appears that the race at the top is closing between the Liberals and the Conservatives. That's according to the latest Nanos polling. It shows the Liberals now sitting at about 43% support compared to the Conservatives at about 38% support. And just in the last little bit of polling, it shows that the Liberals have lost ground about 3 percentage points, whereas the Conservatives have gained about 2 percentage points, and that is where the race is closing. When we look more specifically at the regional breakdown, it appears the Liberals are losing some ground in vote-rich Ontario to the Conservatives, and the Liberals are showing some vulnerabilities in the province of Quebec, losing some ground to the Bloc Québécois. Now, when it comes to dealing with Donald Trump and the threat of tariffs, of course, that is a big issue throughout this entire campaign. According to the Nanos polling, Canadians believe the Carney Liberals have the advantage when tension between Canada and the U.S. is high, but you reduce that focus and there's more of a two-horse race as other significant issues come back into play. Of course, jobs, cost of living, housing, taxes, and crime. So it appears that the gap is closing at the top between the Liberals and the Conservatives, but another important number from the Nanos research shows that 2 in 10 Canadians say they don't plan to make up their decision until the last few days before they have to vote, which means even as the gap is closing 3 weeks out, there could still be a lot of change before Canadians actually make their voices heard on Election Day. We'll send it back to you.
Scott Hurst, our colleague at CTV News. Up next, China's objections to the new U.S. tariffs stalled a deal to sell off TikTok and keep it operating in the U.S. That's ahead.
I cannot believe this is real life.
My logical brain is done damage.
Is everybody ready to race? We're on the Amazing Race!
All new Amazing Race, Wednesday, 9:37 Mountain on CTV.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Double View Gold's Hat Project is potentially one of Canada's largest porphyry copper gold projects, with 477 million tons inferred and 150 million tons indicated copper gold resources, and a significant potential for scandium, an in-demand critical mineral.
When I acquired the project, the potential for copper was totally overlooked, but my belief was so strong that I actually mortgaged my home to drill it. We hit in the first year.
Double View Gold Core, the one to watch.
If you're frustrated with bloating or gas, your body's giving you signs. It's time to try Align. Align Probiotic was designed by gastroenterologists to help relieve symptoms of irritable bowel syndrome. When you feel the signs, it's time to try Align.
last week, U.S. President Trump extended the deadline for the Chinese firm ByteDance to sell TikTok's valuable U.S. operations. The extension, 75 days. We heard more from Jim Anderson, co-founder and CEO at Beacon. Here's what he had to say.
It's kind of crazy to think that TikTok, as popular as it is, one of the most valuable social networks in the world, companies like Amazon, Oracle desperately would love to have a piece of it, but it's a pawn on the chessboard of the larger U.S.-China relationships. A very important pawn, maybe, if there is such a thing. But clearly, there was a deal about to be done. It was going to be done by last Saturday, but the tariffs just threw that up in the air. And of course, the Chinese government has to sign off on any deal, and they're not going to sign off in the middle of these kinds of tariff negotiations. So hence another 75-day extension. Probably not the last of the 75-day extensions.
What was the nature of that deal? Tell us about it.
Well, it's interesting. There's a lot of reporting on it. There was not anything definitive. The deal was not awarded, but Oracle was widely reported to be in the lead. Amazon wanted a piece of that. And again, these big tech companies, they see this not just as a massively popular application, especially with young people, but a source of AI training material. Remember, the world is headed towards artificial intelligence. If you could get your hands on the data associated with TikTok, train your algorithms accordingly, that's long and the short of why companies like Oracle and Amazon are so interested in that.
Where do Apple and Alphabet fit into this?
Yeah, Apple and Alphabet, of course, they both run the app stores, right? Apple runs the iPhone App Store. Alphabet runs the Android App Store. They're the ones that are actually the enforcement mechanism. The law banning TikTok in the U.S. requires the owners of app stores, and for all intents and purposes, it's just those two companies, to basically take them out of the App Store. Then the U.S. Justice Department came in and said, well, you don't really have to follow that law. And at least seemingly for now, both Apple and Alphabet are content to follow that guidance. But they could decide that the politics might change on this. I mean, they are actively failing to enforce what's required by U.S. law under the guidance of the U.S. Justice Department. What happens moving forward and whether they continue to be comfortable not enforcing that law is an interesting question, because they have to think not just about this administration, but the next administration that might come in that might not look so favorably on the fact that those two companies have not been enforcing the law.
You referred to TikTok as the most profitable social media platform. How much do we know about its financials and its financial performance?
Well, we know very little because it's a private company and it's owned by ByteDance, which is a Chinese-owned company. So there's not a lot of transparency there in terms of TikTok-specific financials. It's just a division of ByteDance. We just know that they've got 170 million U.S. users. That's U.S. alone. They're a massively popular global platform. And, of course, they're advertising supported. And what do advertisers most covet? Young people. And what's the most popular social app among young people? It's TikTok. So, you could say it's one of the most valuable applications in the world, right? And not just today, but for where it goes moving forward. So it is massively important. But again, in the context of global tariffs and potential trade war, just one piece of a much larger puzzle.
How is it fundamentally different than other video apps? YouTube has been around for a long, long time, and there are other video-oriented apps as well. Why did TikTok prove to be such a game changer?
It's the algorithm, right? That's the secret sauce, and that's what really has been at the heart of these debates. Do you get control of the algorithm? And for all intents and purposes, the Chinese government is not going to let a U.S. company have control of the algorithm. It's massively valuable. We don't know exactly what they did, but they've done something. If you've ever used TikTok and you go on and you start scrolling, all of these apps, social and video and otherwise, their goal is to capture your attention, right? The longer they can keep you scrolling on your phone, looking at that, the more they have the opportunity to monetize that attention. And TikTok has done that better than anyone else. And people just sort of know it and they see it and they feel it, but they don't know how they do it. And that's the secret sauce behind TikTok's success.
And the concern is, of course, that under Chinese ownership, the app would become a tool of Chinese surveillance or spying on the U.S. population. Are those concerns legitimate in your opinion?
They are. And not only could that be the case, it might have already been the case. We would have no way of knowing. That's what led to such bipartisan support for the ban to begin with. Remember, Congress, which is remarkably fractious in the U.S. right now, agreed and on a bipartisan basis to pass this ban because of concerns about what the Chinese government might do. And of course, everybody's insisting the Chinese government has not done that. Maybe they haven't, maybe they have, but the concerns are there just like they were when the law was passed, right? At any moment, if the Chinese government goes to ByteDance and says, we want you to do this, it's not really a request. ByteDance has almost no choice but to adhere to the wishes, accede to the wishes of the Chinese government. And, you know, that presents a remarkable risk when you've got 170 million Americans spending close to an hour a day on an app. If they put their thumbs on the scale of what those people are seeing in whatever way they choose to do it, I mean, that's a legitimate concern.
Wow, the scale of TikTok. I hadn't realized that. In any case, people spend an hour a day on the thing. Jim Anderson, co-founder and CEO of Beacon. Up next, we are going to focus on oil prices and the possible impact of a global trade war. Stick with us.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
Have you outgrown your wealth advisor? At Stenner Wealth Partners, we specialize in managing significant portfolios of at least $10 million and higher. Contact us today in complete confidence. We'll be here when you are ready.
I often get compliments with how great and fresh I smell, all thanks to Downy Unstoppables. I am a bit self-conscious with how my clothes smell after cooking. I was concerned that the scent would be overpowering, and it was the complete opposite. It's the perfect amount. 4 weeks ago, we washed my dog's blanket, and it still smells great. I do get compliments with how fresh and clean our home smells. It's changed how often I have to wash my sheets. I genuinely love Downy Unstoppables. One of the best things you'll ever buy.
Looking to maximize your monthly income? Our Yield Maximizer ETFs combine your favorite sectors with a high-yielding income-first strategy to help you meet your goals. More income every month from Hamilton ETFs.
Your home is your happy place. Until you come back to bad odors. Use Febreze plug-in with Fade-Defy technology. It has 2 complementary scents that alternate to constantly fight odors and give noticeable freshness. It even reminds you when to refill, so you can always be sure that your home smells fresh and clean for up to 50 days. Enjoy the freshness of Febreze plug-in and try a warmer now for 99 cents.
U.S. President Donald Trump is threatening to impose an additional 50% tariff on China starting Wednesday if Beijing doesn't withdraw its 34% retaliatory duties by tomorrow. U.S. President Donald Trump says all meetings with China would also be terminated. Now, China is accusing the U.S. of unilateralism, protectionism, and economic bullying. And the nation is calling on representatives of U.S. companies, including Tesla, to take concrete actions to resolve this trade war. The federal government has initiated a dispute with the World Trade Organization over those 25% tariffs the U.S. has imposed on autos and vehicle parts from Canada. Ottawa says the measures are inconsistent with U.S. obligations under various provisions of the General Agreement on Tariffs and Trade, and Canada has since imposed its own retaliatory 25% levy on U.S.-made vehicles that don't comply with North America's Free Trade Agreement. Barrick Gold plans to drop the word gold from its name and change the name to Barrick Mining Corporation. The company says the name change would reflect its changing production profile as it expands in copper mining. The Toronto-based company is currently working on giant copper projects in Pakistan and Zambia. Disgruntled investor Simpson Oil is proposing a full overhaul of Parkland's board. in the latest fight for control of the fuel seller. Simpson is also calling for the removal of Parkland's long-serving CEO Bob Espy. In a letter to shareholders, Simpson blames Parkland's board and management for what it calls a deeply flawed capital allocation strategy and says it aims to fix what it calls chronic underperformance. Parkland, meanwhile, says the move is an attempt by Simpson to seize full control without paying a control premium. Let's get more on the oil market. Oil trading today near 4-year lows. Okay, our guest is Citi Global Energy Strategist Eric Lee. Eric, hard to know where to begin. What are you paying most attention to in the oil market? Thank you very much for joining us. What are you paying most attention to in the oil market right now?
Well, there's a lot going on, but I'm sure you won't be surprised if I say the tariffs. I mean, the amount of the tariffs, you know, we've been looking for quite a large set of tariffs imposed and expecting them to be on the stickier side. And as a result, you know, the read-through to economic growth, the read-through to trade is undeniably bearish for oil demand and particularly diesel demand. So that's definitely been the front of mind.
Yeah, I think you argued that a flat 10% blanket tariff alone would be likely to cut global oil demand growth quite significantly.
Yeah, by perhaps around 300,000 barrels a day. And if we actually end up with effective rates of 15%, 20%, it could be higher than that. And so with, you know, prior to this, our outlook had already been that 2025 oil demand growth might be under 1 million barrels a day, so around 900,000 barrels a day. This hit would take it to, you know, 600,000 barrels per day of growth or below, while non-OPEC plus and supply growth generally is growing well over 1 million barrels a day. So you're really looking at a market moving into oversupply and potentially even deeper oversupply next year.
That's interesting. So the world economy was certainly looking at slower growth anyway, and this presumably could tip the barrel into, or tip, sorry, I don't know where I'm going, but this could tip the balance into a stagnant global economy, presumably.
Yeah, I mean, concerns over recession definitely create a lot of downside risks on the demand side. And at the same time, supply is pretty robust. I mean, it's coming from a lot of places around the world, particularly the Americas, you know, from Argentina to Brazil, Canada, Guyana, Norway, the US, and then OPEC plus, of course. This is the second thing that surprised us over the past week. OPEC plus basically came out saying in May they're going to accelerate the return of their supply to market. So a bit of a double whammy there.
Yeah, it's interesting. What do you think OPEC Plus's game was there? Why would they spook the market like that? Were they just testing to see what the reaction would be to a proposed increase in production?
I mean, it's really hard to say. I mean, a few possibilities. One was that this was coming at the same time as a real push to get some of the producers that had been overproducing their quotas to you know, cut back, compensate for past overproduction, but at the same time be raising quotas. So perhaps some sort of a tit for tat there. I mean, some of the notorious overproducers being Kazakhstan, Iraq, even the UAE. And so perhaps on one level it was a sweetener to say, you know, we're going to start raising these quotas back even more quickly. But, you know, everybody, we've got to get in line. Another possibility is that they're, you know, prior to the recent sell-off for oil, actually the oil had run up from $69, $70 Brent up to $75. Part of that had been some geopolitical concerns, still some uncertainty as to whether you could lose oil exports out of Iran, Venezuela, even Russia, as the US continues to pursue negotiations and deal-making there.
We seem to keep hearing about flat gasoline demand in America, partly because of more efficient vehicles, China because of EVs, Europe EVs as well. But is gasoline demand still growing in other places like India, for example?
It is, but the pace of growth globally is definitely slowing. And may be peaking or may have peaked already. This is definitely on the knife point. As you say, there are some places where it's flat to declining, and some spots where it's still growing, including, for example, India. But now we have to think about how a slowing economy and slowing consumer confidence, potentially higher unemployment, and how that filters through to commuting, whether that might hit gasoline demand as well, and only be, have limited offset from lower gasoline prices.
Talk to us a bit about natural gas prices, from gasoline to natural gas. What is your view on North American natural gas right now?
Well, I mean, after a recent run-up, we had been relatively neutral on the price going into the middle of the year. We think there could be some upside in the second half, and particularly going into next year. Really, two things I'd note. One is that US LNG export terminals have been starting up and coming in thick and fast. But second of all, the lower the oil prices go, the slower US oil production growth might be, particularly out of West Texas. And that means the associated gas production from West Texas drops. So, this is the natural gas that kind of comes for free as you're producing and looking and focusing on oil. If that oil production slows down, gas production associated with that might also slow down, tightening next year's market as well.
Leave us with a final thought. You're not an equities guy, but when you look at the performance of energy stocks right now, does anything jump out at you? Do they seem to be cheap, for example?
Yeah, I won't be able to comment on them directly, but certainly a lower oil price environment is going to be painful for the US producers, oil producers, oil and gas producers. Steel tariffs also add a further blow to that by raising the cost of drilling and completing wells. And we'll see whether the White House will come out with some more facility for the industry. But this does make it a tricky time going forward for them.
Thank you very much indeed, Eric. Eric Lee is the Citi Global Energy Strategist. We have a great interview coming up. We're going to talk to the former chair of the White House Council of Economic Advisors under former President Joe Biden. Jared Bernstein is up ahead.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Quotes about money. Every advisor in every old financial institution has one. Like this gem. A wise person should have money in their head, but not in their heart. What difference does it make if it doesn't end up in your pocket? So, how do you get yours? The answer is zero. Questrade thinks you deserve more zeros. So they changed the game again with zero commission trades. Now go get yours.
We all need fiber for our digestive health, but most Canadians only get about 50% of the fiber they need. Good thing Metamucil gummies are an easy way to get plant-based fiber. 3 gummies have the same amount of fiber as 2 cups of broccoli. Metamucil gummies, the easy way to get your daily fiber.
Interactive Brokers pays up to 3.83% on instantly available US dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available US dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Let's get more from a guy who spent a lot of time thinking and writing about tariffs. We're joined by Jared Bernstein, former chair of the White House Council of Economic Advisors under former President Joe Biden. Thank you very much indeed for joining us, Jared.
My pleasure to be with you.
I'm looking at a chat you had a while ago, pretty recently, with Paul Krugman, and you said it's important for people to understand that tariffs don't reduce the trade deficit. So I guess that's a contradiction right there to what the Trump team are saying. Why is that? Why wouldn't tariffs bring in America's trade deficit?
What I was talking about there was tariffs that are kind of more like we're used to seeing. And the reason they haven't reduced trade deficits, by the way, they certainly didn't do that in Trump 1, in his first administration, where he launched a much smaller trade war. The U.S. trade deficit stayed pretty constant as a share of our economy at around -3%. For one reason is other countries retaliate. So you might dampen their imports, but you're also going to dampen your exports. For another, tariffs can strengthen the value of the dollar. We haven't seen that happen so far right now for other reasons, but that can also make you less competitive, hurt your exports. I think if you implemented tariffs that were the magnitude of what we're talking about now, taking the tariff rate back to what we haven't seen for a century, something like Smoot-Hawley levels, maybe you do something of the trade deficit, but that's a bit like burning your house down to get rid of the cockroaches. It's just not worth it.
Just so destructive. What is are you scratching your head at the magnitude of the Trump tariffs and also the basis on which they were supposed, well, we don't really know how they were calculated.
Well, I'm definitely scratching my head over this nonsense calculation, which they then divided by 2, which shows you that they have a sense of humor. I think we all saw this coming, but I think it's fair to say that the markets, for example, were really shocked by the magnitude of the tariffs. And I think what I am somewhat surprised on, before Trump came into office this time, the second time, I thought perhaps the markets can be a disciplining force. Perhaps if the markets react as negatively as they have to some of his policies, he'll have to draw them down a little. And we haven't seen that at all. And in fact, they seem to be just happily fighting the markets day after day. And I guarantee you that won't end well. In fact, we've already seen that it hasn't so far.
What do you mean fighting the markets? You mean ignoring or downplaying the drop in equities? Sorry, go ahead.
Yes, exactly what I mean. That is, ignoring the signal from investors that they are very unsettled by the extent of these sweeping tariffs. Again, I think if you had more of a scalpel approach, which sometimes can be useful with tariffs, I think a lot of investors would probably be fine with it. But when you have U.S. consumers worried about prices, U.S. investors worry about assets, and U.S. businesses worry about the cost of their production, because so much of what we produce here depends on imports from other countries, including Canada. Then you really have very few people in your corner, and oftentimes an administration will respond to the unpopularity of their position, but they haven't done so. They've been doubling down and digging in even further.
Can we switch to monetary policy here? President Trump, he's done this in the past, has been trying to jawbone the Fed to cut interest rates. The Fed has been studiously careful to avoid, or Jay Powell has been very non-committal anyway, because he has a dilemma, doesn't he? Because inflation is certainly not slain as yet.
Right. We have a number of governors on our Fed, folks who decide which way to move the interest rates, who are already a bit antsy about whether the inflation rate was getting back down to their target before all these tariffs took place. And the Fed has a real challenge right now, a new challenge, which is stagflation. Slower growth, higher prices. That's what this kind of tariff scenario we think will do. And in fact, the Fed's own forecast suggests that they're marking down their growth forecast and marking up their inflation forecast. Well, what's the Fed to do in that situation? If it's slow growth, you cut rates. If it's high inflation, you raise rates. So it's a tough one for them. And I think what Chair Powell correctly said the other day is, I'm going to wait and see where things go. Now, President Trump has already expressed great displeasure with that position. He wants him to cut rates. But Powell very appropriately is protecting the independence of the central bank, ignoring such admonitions from the president.
Could we really get into a stagflation type scenario like we saw in the 70s when the stock market went nowhere for years, as you know?
I don't want to predict something that severe, in no small part, because many of what we call the hard indicators in the economy, so the soft indicators are the surveys and what assets they're doing, the markets to some extent. What we call the hard indicators, the job market, the unemployment rate, the GDP growth, and so on, all of those remain quite strong, quite solid. Now, they also are all backwards looking, so they don't really tell us what's happening around the next corner. And the forecasts are, in fact, stagflationary, meaning that people have forecasters have marked down, they've shaved off some of their forecast for growth, and they've marked up their inflation forecast. But it doesn't necessarily take us to 70s territory. It takes us to slower growth and higher prices than we'd like.
It's interesting just how miserable the 70s were. If we look at the Dow Jones, from 1975 right through to the end of 1979, it dropped, or it was lower in 79 than it was in 1975. But you think it's going too far to say we'll get a repetition of that. I mean, the economy was vastly smaller at that stage as well, and globalization wasn't anything like we have now.
Well, that's true, but we also had a Federal Reserve that was much more on the ball in terms of controlling inflation and particularly inflationary expectations. That is where price setters and wage setters expected the Fed to do its job. And one of the things you're hearing from Chair Powell is that I'm going to do everything I can to make sure that inflation, quote, stays anchored. That means that inflation expectations don't start rising with all of this policy lurching around tariffs. So I think that the economy is structurally more insulated from a 70s kind of shock, but I'm not sure. When you see an administration like this coming up with nonsense formulas like they've done and placing these destructive tariffs on countries across the globe, including countries inhabited only by penguins, small islands in the ocean, you know that they're not doing serious work. You see a level of incompetency there, and all of us are quite nervous about where that takes us.
Thank you very much indeed for joining us today.
My pleasure.
Jared Bernstein, former chair of the White House Council of Economic Advisors under the administration of Joe Biden. Next, we're going to zero in on 3 plays in consumer discretionary stocks, including Keurig Dr. Pepper.
This show to be a bright spot in your day. I want to share all the good stuff that life has to offer.
The Good Stuff with Mary Berg. Weekdays on CTV and Crave.
Every April, something magical happens. This isn't just golf. It's the Masters on TSN. Presented by Mercedes-Benz and the all-new electric G-Class.
Stability is one of the things that makes Capital Direct One Income Trust unique and reliable.
If you're looking to invest, then Capital Direct could be right for you.
Our proven track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards, with Class F hitting 10% annualized return and Class A and C kicking out over 9%.
For consistent returns on your assets, find us online
or give us a call.
CapitalDirect.ca.
Explore tastes of tradition with modern notes and food as vibrant as the scenery. Explore more flavors. Visit Malta.
We created these. We're 4 Canadian friends that quit our jobs because we hated our underwear. We couldn't take the chafing, riding up, and constant adjusting. So we spent 12 months creating our own. They're made with a premium modal fabric that's breathable like cotton, but it won't stretch out. And we designed them to contour and support the boys, preventing sticking. We also made it to Dragon's Den and received offers from 4 different dragons. So visit manmadebrand.com to experience ultimate crotch comfort today.
Mr. Clean Magic Eraser has made my life so much easier. My cleaning routine before was a little hectic. I had to use different products to do the same job, but with the Magic Eraser, it's so much more effective than all the other products. You just add water and you can clean the messes off. Even those stubborn messes. On the burnt-on messes on the stove, in the bathroom, on the shower door, gets the grime out, the soap scum. It's effective, it's versatile, it's easy to use. I really recommend Mr. Clean Magic Eraser.
Focus on your goals. Trust in our ETF experience. BMO has been offering ETFs to Canadians since 2009. BMO ETFs. Build on trust. Learn more at bmogam.com/ETF.
Earlier in Hot Picks, we covered the consumer discretionary sector. We heard from Filippo Falorni, Director of U.S. Beverages and Household Products at Citi Research, and began the discussion with the macroeconomic backdrop and how it will affect consumers.
The backdrop is clearly deteriorating in the U.S. Many companies are starting to talk about consumers pulling back on their consumption levels. Ultimately, look, my space is a little bit more immune from some of these macro backdrop. I cover categories that really are daily use categories, especially in the household product side. So these names have been viewed pretty defensive throughout prior economic downturns. And you saw in the early phase of the market sell-off that these names held up a lot better, especially on Thursday. Last Friday, you started to see all the consumer group, including staples, really underperform as well, as the market is kind of like extending those declines. But look, ultimately, with the macro slowdown, a lot of my companies are going to be relatively more immune compared to the rest of the economy.
Okay, let's jump into your picks. Your top pick is Keurig Dr. Pepper, ticker symbol KDP. Why is that your number one pick?
Yeah, so we moved it recently to our top overall pick because we think the fundamentals of these companies are really underappreciated in the current valuation. So they have essentially two businesses, a coffee business and a refreshment beverage business. The refreshment beverage is more the beverage side, so the Dr. Pepper, Canada Dry, and some smaller brands that they're selling almost entirely in the U.S., like 90% U.S. exposure. So much less at risk from tariffs and from international trade wars, and that business is growing significantly in the mid to high single-digit range. It's been an area of strong growth for the company. They continue to gain share within the U.S. beverage business from Coke and Pepsi, and they continue to expand their distribution. So that part of the business has been very solid. The coffee side has been a little bit softer over the last couple of years, but ultimately the company has provided pretty conservative guidance within coffee, and coffee is one of those areas where, because of the cost inflation moving up, there's opportunity for KDP to take pricing. They've assumed pretty significant volume elasticity for pricing, but ultimately, if they're actually able to take price and consumer doesn't change their consumption behavior significantly in coffee, they could actually have upside both on top and bottom line.
Okay, number two is Monster, ticker symbol MNST in the U.S. market. Why do you like Monster?
Monster plays in the energy drink category. That's almost 95% of their sales exposure. And that category has been particularly solid in the U.S. We've seen some softness last year when you started to see some concern among low-income consumer on the category, but now it's started really to reaccelerate significantly in the U.S. A lot of it is also the fact that this category historically for the past decade didn't really have a lot of healthier options. And now there's been all these new brand introduction. They have zero sugars, they have better for you energy, and they've really expanded the consumer base of this category. And then Monster, being the number two player globally after Red Bull, have still a solid opportunity from a market share standpoint in the US, but even more in the international market. If you look at the US market share, it's about 32% compared to Red Bull at 33, 34. So pretty much neck to neck with Red Bull in the US market. International internationally, Red Bull has over a 35% market share versus Monster only a 10% share. So it's a healthy category, and they have significant market share opportunities that makes it to us a very compelling story.
Okay, and your third pick today on Top Picks is perhaps the best known name in the beverage industry, Coca-Cola.
Absolutely, yeah. So look, Coca-Cola has been our topic of over the prior year. We moved it a little bit lower, but it remains our favorite multinational within the group. So multinational clearly have a little bit more risk from this global trade war. From a tariff standpoint, there's not a lot of direct implication for Coca-Cola, given they produce almost entirely locally in every country. But there is some risk from anti-American brand sentiment around the world that we've seen. I would say Coca-Cola remains our favorite of all the multinationals because their actual fundamentals remain very solid. They have about 40% of sales in emerging markets, which they can actually drive volume and price growth. And even in the US market, they've been able to diversify their portfolio away from carbonated soft drinks, which is their main product that everyone knows, into better for you categories. More recently, they've acquired Fairlife, which is essentially a dairy protein-based drink option, including Core Power, which is their core SKU. And they've really been able to grow that part of the business a lot faster than the core carbonated soft drink side of the portfolio. So even the US market, they're actually able to grow volume, which has been pretty remarkable. And then internationally, they do have a lot of opportunities in emerging markets.
We were joined earlier by Filippo Falorni, Director of US Beverages and Household Products at Citi Research. Just a quick reminder of where the markets ended the day today. Early on, US stocks plunged, then bounced off the lows. The NASDAQ ending just in positive territory. Today, we saw quite the rally in tech stocks, the S&P 500 down. For the year so far, the S&P is now off almost 14% in 2025. The NASDAQ is down just over 19%. And Toronto is down so far this year about 7.6%. And you can see it lost about 1.4% this year. The Nikkei has tanked in 2025 in Japan, has tanked 22%. And Hong Kong stocks were battered today. They fell 13%. They're off about 1% this year. Thank you very much indeed for watching The Close. Have a wonderful evening.
The Close is brought to you by Enterprise Mobility. We find roads that take your business new places.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Did you know serums are concentrated with powerful ingredients to visibly improve your skin? Try Olay Super Serum for 5 powerful ingredients in one. It hydrates, improves texture and evenness, while also firming and smoothing. Try Olay Super Serum.
Representation in media is important.
There's a lot of people with disabilities that don't feel seen.
I'm a music producer. Having a disability, it's not really shown in the industry.
I make media representing women in wheelchairs.
AMI is a broadcaster that strives to change the way people think about disability.
I'm a very loud and proud deaf woman, and I want to be able to make a difference.
Watch inclusive and accessible content on AMI TV or stream now at AMIplus.ca.
Harvest Healthcare Leaders Enhanced Income ETF. Maximize your monthly cash flow from Canada's leading healthcare ETF. More income from healthcare leaders. Harvest ETFs. Income happens here.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters. The core of a portfolio. They're meticulously crafted to endure. Capital Group, actively different.
was deliberately built for, and that is the job that was given to the Secretary of Treasury. Step up and do your job. And if Donald Trump has any... Donald Trump should listen to his Secretary of Treasury if his Secretary of Treasury will do his job. That is the question. And if none of them will do their jobs, Congress needs to do its job and take away this authority from Donald Trump. And I just want to be clear, we're running out of time on this. Every single day that goes by, every hour that people are saying, I'm not investing there, I'm laying off workers, every single minute